It is 9 a.m. on Wednesday, February 24th. This is Yahoo Finance Live. I'm Julie Hyman, along with Miles Udland and Brian Sozzi. We're seeing a little bit of a pullback in futures this morning, but earlier we had seen a pop in the futures. Right now, Dow futures column little changed here, down just about 0.25%. So we'll see how that progresses through the morning. As we've seen in recent sessions, the Nasdaq is the underperformer once again. Jay and Kathy save risk assets, at least momentarily. A sell-off the yesterday spread from big tech to Bitcoin was forestalled after Jay Powell said rates are staying low. And Kathy Wood's ARK stepped in to buy Tesla and talk up Bitcoin. But who's going to save them all? We'll break down the latest retail earnings. Lowe's and TJX, the parent of TJ Maxx, both reporting their numbers this morning. And an Indian renewable energy unicorn plugs into the hot U.S. SPAC market. We'll speak to the chairman and CEO of Renew Power. But first, let's talk through the last 24 hours because it's really been fascinating action, and that continues once again into this morning after we saw a steep sell-off early yesterday in sort of risk assets. A lot of things rolling over from Bitcoin to Tesla to big tech to a lot of the stuff that has been bid up as all of the hot money has poured into the market. Really pulling back yesterday. We heard Jay Powell's testimony. He'll be giving testimony once again today before Congress, where he once again gave reassurances that the economic recovery is going to take a while. Rates are going to stay low. And then ARK, which has really become dominant in many areas of those risk assets. Kathy Wood, the head of ARK, coming out and saying she still supports Bitcoin's price, and also her fund making some purchases there. Didn't hurt either that Square said it had bought $170 million worth of Bitcoin, just over 3,300 Bitcoin. So, Miles, as you look at this sort of rotation, I mean, these cycles are happening quicker than ever, if you could call that a cycle, the action that we saw over the course of the session yesterday. But, it'll be interesting to see if that sell-off in tech in particular and some of these risk assets comes back.
Yeah, and I think it's also going to be interesting to see how focused the market remains on the ARK holdings. Obviously, that was a big part of the story on Monday. It was a big part of the story all day yesterday. Obviously, the story improved quite a bit throughout the trading session. But when we were on the air in the first half hour, 45 minutes or so of the trading day, you go through some of the biggest holdings in many of those ARK funds, and we were looking at double-digit percentage losses, which were in many cases totally erased throughout the trading session or more than cut in half. So we'll see how much pressure, if any, kind of remains in that space. And also just to go back to the Bitcoin point, you mentioned what we saw from Square last night. Also this morning, MicroStrategy coming out saying that they've acquired another $1 billion worth of Bitcoin. Their holdings in Bitcoin now worth about $2.1 billion. That company's market cap is right around $7 billion. So now we have a rough idea of what multiple the market assigns to a company's Bitcoin holdings. I guess it's 3x or so. And we can argue about that. Of course, the Bitcoiners in my mentions think that the way that that's valued on the balance sheet is 1-to-1, and that's obviously not true. It's a multiple of whatever that holding is, and the market will assign a different multiple for each company. For MicroStrategy, it's 3. But I do think all of that with the Square, with Kathy Wood talking about Bitcoin, certainly firms up maybe some, I'm sure it wasn't many, but maybe some concerns that folks had about just how serious corporate America was or is and remains, will continue to be about its involvement in Bitcoin. But again, it's also another interesting thing we discussed yesterday, Sozzi, the way Bitcoin is now a major part of the overall market story. For years, we were all like, it's just a sideshow, but it's a part of the risk story on a given day. And the decline we've seen in Bitcoin from its weekend highs early this week absolutely set the tone. And maybe this fundamental news on a couple companies acquiring more can level things out a bit.
Yeah, I can't deny, Miles, or even argue that Bitcoin is now part of the broader investment thesis, even if people are not directly or indirectly invested in Bitcoin. But I do think, at least for today's session, the focus will remain on 10-year yields, and it's a very important session. We've had the 10-year continue to rise this morning. Last time I checked, about 1.42%. So again, that rise continues, and it's important to see if it continues to rise from here. Can the market rally back today after Powell's comments? I just got a note from Matt Maley over at Miller Tabak. He notes that What Powell tried to do yesterday essentially is, provide a safety net for the market should 10-year yields continue to rise. So given we have those, I would say, dovish comments from Powell yesterday, can the market somewhat ignore the rise in 10-year yields, and can we get a bid back under stocks? I think it's very important. Or does the market take its cue or go back to just keep taking its cue from the rise in the 10-year and completely ignore what Powell had to say? And that's why I think it's very important today.
Well, he'll have the opportunity to say it again today, and most likely will repeat himself today. Something else as I think about, as we talk about the 10-year yield and talk about Bitcoin, is this continuing struggle to sort of find a correlation between Bitcoin and anything, right? I mean, if it's looped in with risk assets, would it then fall whenever risk assets fall? It doesn't seem to always be happening, right? So that continues to be one of the sort of many conundrums when it comes to figuring out cryptocurrencies and how to trade them. Something a little more bricks and mortar, so to speak, a little more concrete that we can talk about are the retail earnings coming out this morning and that have been coming out this week. We heard from Lowe's and TJX this morning. On the Lowe's side, that company continued to see strong same-store sales up 28%. That's above analyst estimates, people fixing up their homes. That's been driving demand for Lowe's. Over at TJX, that company's earnings and sales did miss estimates. So even though, as Brian Sozzi talked to us about the other day, TJX has been one of the retailers that has managed through not just the past year, but the past several years a little better than some of its competitors. Let's bring in Jeroen Martis. She's Director of Consumer Research at Refinitiv. Jeroen, it's good to see you once again. And so as you look at, let's focus in on this morning in particular first. I mean, it seems like when it comes to the home improvement retailers, they really have been the beneficiaries of this trend of people fixing up their homes. And when you look at Home Depot and Lowe's in particular, do you think that they have also done the right things, or have they just sort of benefited from that trend?
Definitely, they've done the right things. One key component in order to survive the pandemic and to remain competitive in the retail space has been the omni-channel experience. And these are companies that have invested in the omni-channel experience way before the pandemic, and therefore were in a much better position compared to a lot of their peers. Home Depot yesterday saying that digital sales grew about 83%. But even though consumers went online to make those purchases, they still gravitated to the stores to do the pickups. Like over 50% of those orders were pickup in stores. Lowe's today reported also strong digital sales of 121%. But in general, what we're seeing is that the retailers that are beating earnings and estimates, like Home Depot and Walmart, they've all been very vocal that they will continue to invest into the technology because this is key and this is where the future is heading. They're telling us that even after the pandemic, they believe that a lot of these consumer behaviors will remain permanent. And in a survey with Maru Blue Public Opinion, Refinitiv did discover that Americans, about 70%, will continue to shop online even after the pandemic.
Jerome, what has surprised me before, and I think has left me scratching my head, is the strength that has continued, or that continued into January and even February. Home Depot called it out. Lowe's called out strength on its press release this morning. The sales strength has continued into February. TJ Maxx called it out. Even dusty old Macy's called it out yesterday on its earnings call. Do you think we're looking at a spring consumer spending boom, and what is driving that?
In terms of the home stores like Home Depot and Lowe's, it's a little bit more seasonal because they always tend to get a boost because of gardening and also outdoor barbecue gear. So they're definitely going to continue to see that strength. And consumers, when we look at the projected winners for 2021, are continuing to invest in the stay-at-home experience. It's like you said, the numbers have been very robust. Look at Crocs yesterday, right? They've done a really good job and market themselves as a comfort shoe. And consumers are right now choosing comfort over fashion. And that's the theme that we're going to continue to see throughout 2021. 2021 will be more of a transition year, and then we might start seeing some of the recovery in 2022. So as for the year 2021, the outlook still shows that the stay-at-home stocks will continue to do well, like the Home Depots, the athleisure, and items that are offering consumers more comfort.
Jordan, I'm curious though, as things change in 2022, I mean, as well as anybody, the retailers aren't exactly the most nimble group, and I'm worried if, or should investors be concerned rather, that they get caught with an inventory glut. They get caught flat-footed with maybe the speed with which those stay-at-home trades cool off, because I think we're all ready to no longer stay at home. And is there a risk that this 90, 180-day lead time on how you're merchandising your store ends up with yet another version of a store people don't want to shop in?
Absolutely. And I think what you're saying is already being reflected, right, in the performance that we're seeing in the stock market. Investors are already shifting their gears. They're going from pandemic stocks to reopening stocks, even though these retailers are still beating and posting robust numbers, because everybody is in an urge to see that reopening happening. But ultimately, even though governments open economies and retailers are opening stores, the consumer decides when it's safe again to return to the mall. And they're telling us that even after COVID, they are still planning to avoid crowds and shop online and practice social distancing measures. So we're seeing is that in terms of the inventory levels, like you asked, that's always an adjustment. Even for TJ Maxx, that was an adjustment, right? And they're going into the year with leaner inventory levels. Macy's, they had to cut significantly the amount of inventory cost cuts in order to beat earnings estimates. So this is a never-ending story for them in order to adapt and change. And that's why a strong omni-channel presence is what saved those retailers going into the pandemic, because they were able to use their stores as fulfillment centers and their proximity to the consumer. So it's a never-ending shift, and we're going to continue to see the shift as the retailers reopen in order to adjust again their inventory levels as consumer spending and consumers' behavior continues to shift.
Jerome, really, to your point on inventory, I walked into my nearby Macy's over the weekend. It was really completely empty, and I think that reflects the fact they cut about 30% of their inventory coming out of the fourth quarter just to save on costs. So that really, I think, ultimately raises the question, and I'll put it to you, do you think consumers are looking at really strong levels of inflation in apparel in the first half of this year? Because if they're holding less inventory, they're going to have to push up prices if they want to make their sales.
In terms of apparel, yes. But when Macy's reported yesterday, they saw a lot of strength in their home goods. And that's what helped them, beat earnings estimates. So we're still seeing that strength is there. Even in TJ Maxx's numbers today, the home goods was the only one that saw positive double-digit growth, again, reinforcing that the strength is there. So the retailers are focusing on the areas of strength. And then in terms of apparel, that those sadly are not being sold. In fact, the department stores lost a lot of their market share in apparel to the discounters. Target stole a massive millions in market share from the department stores as consumers made that shift and are now purchasing athleisure wear at Target as opposed to the department stores. So it's remarkable how long the department stores have been surviving and have been working on their survival. They've been doing that by cutting costs, whereas Home Depot and Lowe's, they've actually gained more cost. Home Depot saying that in 2021 they've only added $2 billion in additional costs because of compensation enhancements, and still on top of that, and still gaining $2 billion in costs, they still managed to post impressive earnings. So these companies, Home Depot and Lowe's, who've done their homework and invested in the omnichannel experience, are much better positioned. And let's not forget, even post-pandemic, when consumers start feeling more comfortable, they're going to allow those professionals to come into their house and remodel their kitchen. So they still have room to grow even post-pandemic as consumers become more comfortable in allowing the professionals into the house to fix it.
Yeah, that's really going to be the key, isn't it? And that's one of the big questions for not just these companies, but pretty much all companies, what's going to happen after all of this. So that's an interesting look forward. Jaron, great to see you. Thank you so much. Jaron Martis is Director of Consumer Research at Refinitiv. And as we take you to break, just wanted to mention one other developing story that we continue to watch this morning. That has to do with Johnson & Johnson. The shares of 1.4%. The Food and Drug Administration staff said in documents out this morning that the company's one-shot COVID-19 vaccine appeared safe and effective in trials. This is as expected, and this paves the way for approval of that vaccine, which is likely to be used probably more outside of the U.S. than within it. When we come back, we're going to be talking about GameStop, the actual company, not just the stock for once. We'll be right back.
Welcome back to Yahoo Finance Live on this Wednesday morning, and futures under just a smidge of pressure here. We'll see how things go as we open up. Let's take a look at shares of GameStop this morning, though. The stock is up just about 0.5%, and we've got some actual fundamental news for the business. CFO Jim Bell is going to resign from the company in just about 1 month at the end of March. Now, the company did not give a ton of details in its release. Bell joined GameStop, or rather was appointed as the CFO of the company in June of 2019, which is, I guess, just a month or so before, based on the timeline that, as far as we know, that Roaring Kitty, Keith Gill, began acquiring his stake in GameStop. The stock back then was trading in the single digits, $4, $5, $6 per share, as we just saw on the screen. GameStop right now trading in the mid 40s. Now, that the company's CFO is stepping down is maybe not a huge surprise, because one big thing, Brian Sozzi, did not happen, or has not happened yet in the last few months, which is that GameStop has not come to market by issuing additional shares. The Finance 101 textbook tells you that when you see your share price rise 5, 7, 8, in this case 10x, you are supposed to come to market and issue shares to raise more capital with less dilution than would have been possible. And I think that while raising capital at $480 per share probably wasn't reasonable, it's been at 45-ish for a couple weeks now, and there's been radio silence really from the company.
Well, Miles, I think my mom actually figured this one out. And let me just read this text I got from her at 6:47 a.m. this morning. Mr. Bell from GameStop is leaving next month. I guess things got too much for him. And I think that is part of the issue here. So thank you, Mom, for that text really early this morning here. To your point, yes, you should have came out if your GameStop CFO raised some form of capital and follow the playbook that the AMC team put out when things were really going crazy. They essentially saved their company. So kudos to AMC, not so good for GameStop. And the next shoe to drop here could effectively probably be the CEO, George Sherman. George Sherman hired this CFO. And if you're reading the tea leaves, the reason why the CFO is likely departing is because Ryan Cohen is on the board. He got 3 of his board members put on there. He holds about a 13% stake in the company. And this has all the writing or really suggests it is Ryan Cohen running this company and making the decision. So I wouldn't be surprised if George Sherman, his days are numbered leading the company.
The fact that your mother is texting you earlier in the morning about GameStop, it explains so much about you, Brian Sozzi.
Yes, it does.
I have new insight
yes, it does.
into the roots of Brian Sozzi. I would mention as well, there was some reporting by Bloomberg this morning that it might not only have had to do with the lack of fundraising and sort of striking while the iron was hot for GameStop. It might have also had to do with one of the Roaring Kitty fundamental theses behind this stock, which is that it should be turning more into an e-commerce play. According to Bloomberg's reporting, Jim Bell was not on board as much with that vision, and that's part of the reason why he is resigning. Who knows if that's the case, or if there was also this inability to or unwillingness perhaps to raise money in the market. But that's an interesting point as well, especially given, again, that has been, for the folks who have been longtime bulls, that has been one of the core things that they have talked about, and something that has not really materialized for GameStop.
Yeah, well, and I think, as Brian outlined, it's an activist situation as well. And there's clearly tension between existing management and Ryan Cohen and his team. And we've already seen a couple of appointees join the business within the last month who have ties to Chewy and Ryan Cohen's previous endeavors. One imagines that those are not the last hires that will kind of come from that sphere of influence. And to that point, Julie, if Jim Bell and George Sherman don't have a strong view on how to remake the e-commerce business, then their argument would be, why would I raise capital to have money that I do not know how to put to work? Which is, again, not really a great argument for you remaining as the CEO or CFO of a company when, again, your stock has gone up in value about 10x in the last year, and you have not, done a major capital raise because, again, that math means that you can raise the same amount of money you would have had to raise previously with 10% of the dilution in the existing shareholder base. So, as Sozzi said, does not take a rocket scientist to figure out some of the challenges here. Though, again, as we discussed at the time, not credible to come out in the hundreds of dollars per share and raise capital. I absolutely do not think that late January, first week of February, they had to come out and do something. But now that the dust has settled, you have to come out and do something more than nothing. Even though, yes, their quarter's wrapping up, they have earnings coming up in a couple of weeks, you cannot just sit there and do nothing at a time like this. All right, off for a short break here. Futures lower on this Wednesday morning. We're back with more. And the opening bell right after this.
futures here in the U.S. pointing to a slightly lower open. This even as we had some comments yesterday from Jay Powell saying economy is going to take a little while to improve. Rates are going to stay low for a while. And as we got some positive incremental news on the vaccine front this morning, Johnson & Johnson's vaccine getting an endorsement from the FDA, although it's not yet gotten to final approval. Let's now talk about what all of this means for the markets and bring in Brian Nick. He's Nuveen Chief Investment Strategist. Brian, it's good to see you. So we've got this sort of push and pull, if you will, right? We have this economic optimism on the one hand. We have positive vaccine developments. We have an improving trajectory, it looks like, for the path of the virus in the United States. And then we got rising bond yields on the other hand. I don't know if that's the only sort of thing in the negative column at this point, but how are you thinking about that balancing act?
Yeah, I think they go together. If you asked us 6 months ago to kind of game out base case upside, downside, this would be the upside scenario. Where we are right now is the upside scenario. We've had better than expected news on vaccine, on fiscal stimulus. The Fed has become incrementally more dovish. And the only real, I think, source of risk, obviously aside from COVID at this point, is the bond market's fear that the Fed is going to pull out of the situation early. And Jay Powell's on Capitol Hill today. He was on Capitol Hill yesterday, doing everything he can to disabuse markets of that notion. The Fed almost intentionally wants to be behind the ball a bit, be perceived as maybe not even believing that the economy is going to do as well as it's going to do, to try to, increase those inflation expectations maybe a bit more, but avoid the kind of tantrum with respect to pulling back on QE and raising interest rates, neither of which I think the Fed is even thinking about doing this year.
Brian, speaking of tantrum, all eyes continue to be on Bitcoin. Should investors avoid the volatility in Bitcoin when investing in stocks?
It's very hard to place Bitcoin into any kind of asset allocation model because, as you said, it's so volatile, and it's very hard to kind of optimize for what the right size should be. So we don't think it's an investment. We think it's sort of a speculative play that people can do sort of outside their core nest egg or 401k portfolios. If you want to own Bitcoin, do it as sort of more like a hobby and don't think of it as something that's going to complement a portfolio of stocks, bonds, real estates, other assets that tend to be more stable and deliver more certain returns over time.
Brian, coming back to that outlook and that upside scenario, are people still too conservative on sort of how the economy might play out? I mean, does that seem to be where the balance of risks lies as you're thinking about it?
I think we are seeing Wall Street sort of frantically revise up 2021 GDP forecasts. After the retail sales number we got last week, Q1 2021 GDP forecasts are getting frantically revised up. So we may be approaching what I think is a more appropriate reality here. The other big ingredient, obviously, is how big is the fiscal package going to be? If it really is 1.9 trillion, that's not a number that a lot of economists had baked into their forecast for this year. They maybe were saying 1 trillion. It was going to have to get through this whole kind of sausage making process. But if it's really going to pass, sort of like the way it was proposed, that's a much bigger hit to GDP, a positive hit to GDP this year. So I think, in that 6 to 7% range is realistic. That would obviously be the best year we've had in several decades, I think 35 years in terms of GDP, bouncing back from last year. But I think the key is how investors are reacting to it. I think the rise in interest rates is probably appropriate given what we know is in the pipeline for growth this year. Maybe what people are not as focused on is the rise we should be expecting to see in corporate earnings. We just got a really good Q4 report that I think set the expectations a little bit higher for 2021. But if we can get into some semblance of reopening or normalization of some of the service areas of the economy, Q3 and Q4 earnings are going to look really good. And there's going to be more room for the equity market to rise. So if people are being too conservative by pulling back on stock portfolios after the performance, the run of performance we've seen, maybe we think that they should probably think about staying in.
Then we have the opening bell this morning, River North Ringing, which is an investment management firm. Brian, if the economic outlook looks good, at some point then one would think that we'll see a more sustainable so-called reflation trade, right, where we see a lot of the closed businesses start to reopen, the stocks improve, et cetera. Maybe we start to see more of a sell-off in tech as well. We've seen fates in that direction that haven't quite stayed put. When does that start to happen, and should people be making those investments now in anticipation of that, even though it hasn't quite happened yet?
Yeah, the second half of last year, the first part of this year has been more friendly to the cyclical versus defensive trade, the value versus growth trade. But tech's going to be a big part of the U.S. market regardless. It's been an underperformer this year. I think tech, if you think of it as almost like a bond, it's a longer duration asset. than a lot of these other companies because the earnings are just so high. So when you're discounting them at a higher interest rate, it takes a bigger hit to the current value of the stock. So I think that's why you're seeing that this inverse, correlation between interest rates and the relative performance of technology. But in an environment where we're kind of reopening, you could see a rotation away from some of those areas that performed well last year because of the unique nature of the economic structure last year. And I think more towards some of those names that are either reflationary in and of their own right. So it could be the energy stocks, which have done obviously quite well, or even companies oriented around more infrastructure, more investment, and just services, things that people haven't really been able to spend money on. So some of those consumer names that are more related to, say, maybe travel, leisure, hospitality. I think we're seeing a mix of that start to perform better. We certainly are incorporating more of that in our portfolios this year rather than the very heavy growth overweight we had during most of last year.
Brian, anyone on your team tossing about the potential for double-digit GDP growth in the second and third quarter? I've seen some estimates out there as high as 8%, but I've been surprised by some of these retail earnings. Consumers appear to be spending very aggressively here in February. Certainly, we're seeing the rise in 10-year yields suggest inflation. Is that double-digit growth off the table?
I don't think it's off the table, but the fact that we got such good consumer numbers in January mean that we might see the growth numbers spaced out a bit more. If you had sort of a weak first quarter and then a sort of a boom because of the stimulus and the reopening in Q2, Q3, I think you can hit 10 or 11% GDP annualized for one quarter. But I think the fact that the first quarter now is being revised up, you have this. I think the Federal Reserve estimate that's been a pretty good one is currently at 9 or 10%. If that's what we're going to get in the first quarter, we're not going to get double digits in the second and third. It's just sort of a sequential thing that's happening, and maybe the growth's being pulled forward a bit because of those stimulus checks.
Brian, good to see you. Brian Nick, Nuveen Chief Investment Strategist. Appreciate it. All right, let's take a look at what's going on in today's market. Ines Foray is watching the action force this morning, although at the open here, Ines, not much price movement overall with the indices.
That's right, not too much. We are seeing the Russell 2000 down about 0.8%. We're looking at the Wi-Fi Interactive Board. We're seeing the Nasdaq down about 0.5%. If we just take a look right now at the sector action, we're seeing that we're looking at technology, utilities that are selling off right now. And on the Nasdaq, we're looking at some of the big cap names. Apple down more than 1%. You've got Amazon, Microsoft also lower. Tesla up 3%. Tesla yesterday ended the session down about 2%. Of course, it seems to be moving in tandem with Bitcoin since Tesla is invested in Bitcoin. MicroStrategy, also another company that's invested in Bitcoin. So we're seeing now a lot of these movements in tandem with Bitcoin. When we take a look at what's happening with the cryptocurrency right now, Bitcoin falling below 50,000 a coin. It was above 50,000 earlier this morning. If we also take a look at some of the airlines have been doing well over the last couple of sessions, the reopening stocks, the travel stocks, the cruise line operators as well. We're seeing the airlines today in the green as well. And if we just take a look also at some of our trending tickers, because these are some that we've been watching, Workhorse, an electric vehicle company, down 10% yesterday. It was down more than 40%. It failed to win a USPS contract for next generation vehicles. Oshkosh is the one that won that contract. That stock up 8% this morning. Julie, Miles?
Yeah, that's been a really interesting story and on our trending tickers list on Yahoo Finance. Thank you so much, Ines. Appreciate it. Well, coming up, we are going to be speaking to the largest renewable power company in India. It's going public through a SPAC here in the U.S. Stay tuned. Indian Prime Minister Narendra Modi has said that his nation aims to have 40% of its energy sourced from renewable sources by 2030. There's a company that's already providing 5 gigawatts of clean power capacity in that country, and it's going public through a SPAC here in the U.S. Renew Power is the name of it, and Sumant Sinha, the founder, chairman, and CEO, is joining us now. It's going to go public through a combination with RMG Acquisition Corporation 2. It's a SPAC deal, and it's a large one. Mr. Sinha, thank you so much for being here this morning. So for those who are not as familiar with the Indian renewable power market, it sounds like that you all are the dominant player there with that 5 gigawatts of capacity. Is that solar, wind, and where in India are you located? Do you have those sources? What's the market there look like?
Yeah, sure. Thank you so much for having me on the show, Julie. So look, the Indian power market is actually the third largest market in the world after China and the US. And in terms of renewable energy capacity, we are the fourth largest in the world after Germany as well. But we're growing the fastest among all countries in the world, both in power demand as well as in renewable capacity additions. And so we really have a very solid base in terms of the market size, which is going to grow quite substantially over the next many years. And Prime Minister Modi has set a target to get to, by 2030, 5 times the current capacity of renewable energy. And so there's going to be a significant growth in our sector over the next many years. As a company, Renew is very well placed to capitalize on that opportunity. We are, in fact, the largest company currently. We have more than, as you observed, 5.5 gigawatts of commissioned capacity. This is a mix of both wind and solar. And we have a very integrated execution model. We do everything end-to-end ourselves, from development to construction to procurement and eventually to asset management as well. And that allows us to be a little bit more profitable than our competitors in the market. And so really that's our company. We expect to grow quite rapidly over the next several years in line with market growth. And so really that's our story, Julie.
What makes your model profitable?
Well, you know, in India, the interesting thing is that renewable energy is now the cheapest form of new electricity in the market. It's significantly cheaper than coal-based power. And the way power purchase agreements are granted is through competitive auctions. And so you bid the tariff that you think makes sense, that allows you to get a good return. And so we bid in various auctions, we win capacity, and then we construct that capacity with these long-term assured power purchase agreements, which guarantees us access to long-term cash flows. And so really, it's those tariffs that we bid and the cost that we incur to set up the projects that allows us to make the kind of margins that we need to make to continue to invest capital profitably and keep growing.
So from the SPAC, you'll raise $610 million in net primary proceeds. How do you plan to spend that money?
Well, you know, as I said earlier, the Indian market is growing very substantially. And as I said earlier, there is going to be a 5x growth in the next 10 years. We're going to go from 90 gigawatts of currently installed renewable energy capacity between wind and solar to 450 gigawatts of capacity. So we already have a pipeline of another 4.5 gigawatts that we are constructing right now. So some of the capital will go for that. And as we look to the future beyond that, we can certainly use more capital. So some of this capital will go for that as well. So really, most of it is going to go for building out new capacity and really making sure that we get to a size that will then allow us to generate sufficient internal capital that will keep allowing us to grow and be the number one player in the country.
Sumant, it's Miles here. I want to ask broadly about the Indian economy right now and the business climate there, because I think when you talk to U.S.-based investors, particularly venture investors, they are more excited about the opportunities in India than pretty much anywhere else in the world, geographically, at least as far as they see it. I'm curious if you could just maybe outline for us today, as we sit here, February 2021, what the growth prospects are like, the business climate there, and how you guys are fitting into that broader picture.
Yeah, sure. So, you know, the Indian economy had been growing before the COVID pandemic hit last year at about, let's say, 6 to 7% a year on average. Of course, COVID, put a dent in that. But the reality is we recoup most of that growth again in the next financial year. And so we expect almost 13% GDP growth in the next financial year, which starts in India on April 1. So we'll really be back to where we were pre-pandemic. From that point on, the government has actually recently come out with a program or decided in terms of its policies to really give a significant fiscal stimulus through increased spending for infrastructure. And that's really terrific because what that means is it's going to actually lead to productive capacity creation in the economy, make the economy a lot more efficient, with a strong focus as well on the manufacturing side. So between all the efforts that the government is putting in terms of fostering faster growth, and with the very robust ecosystem of startup companies in India, sectors like ours, which are growing very rapidly, I'm pretty convinced that we're going to continue to grow at maybe 7 to 8% a year for the foreseeable future. If we do that, and I'm pretty convinced that we shall, then in actual fact, what that means is that there's going to be sufficient power demand growth as well. And we will be looking at robust power demand growth of between 5 and 6% every year, which is in turn going to lead to a doubling of India's power demand over the next 12 to 14 years. And the question is, where is that power supply going to come from? The answer is that it's going to come from renewables now, because it's so much cheaper than coal-based power. And that's really good news for the global, for the world as a whole, given all the climate change issues.
And as you talk about that cost, how much, subsidies are a big issue here in the U.S. with government subsidies for a lot of renewable energy sources. Is that the case in India as well? And in other words, if you're looking at that cost advantage that renewables have, is that partly because of government support?
No, actually, that's not true at all, Julie. What I'm talking about is fully costed power plants, whether renewables or coal. And the reality is that without any subsidies whatsoever, renewables is now significantly cheaper than coal-based power. And so therefore, as we look at the future, the reality is that renewables will become the de facto default choice for all new capacity additions in the power sector. There is actually no need for us to add more coal-based capacity at all. And therefore, in fact, in the last 2-3 years, you've actually seen no new coal starts being announced at all, because in addition, nobody really wants to fund coal-based power plants either. And so therefore, the entire capacity addition is migrating towards renewables. And as I said earlier, with robust power demand growth of 5 to 6% a year, that is going to lead to this big imperative and this big impetus for renewable energy growth in the future in India.
Really fascinating stuff. Thank you so much. Sumant Sinha is Renew Power founder, chairman, and CEO. That merger with RMG Acquisition 2 is expected to close in the second quarter. Thank you so much, sir. All right, we're going to take a quick break. When we come back, we will be checking on the European markets. Stay with us.
All right, welcome back to Yahoo Finance Live. We see U.S. stocks here down as we get the session underway, but not a lot to write home about. The Nasdaq, the biggest loser, off about 0.6%. The Dow and the S&P basically unchanged here. Let's turn our attention to what's happening over in European markets. Earlier in the session, we saw the pound rallying, the dollar continuing its slide. Yahoo Finance's Oscar Williams Group joins us now with the latest on everything happening overseas. Oscar.
Well, Miles, it's been a bit of a choppy session for stocks here in Europe. We had a quiet open at the start of the session, mostly positive, but not much momentum. Things did start to improve as the morning wore on, but just in the last hour or so, we've seen markets turn to the red after the US futures market dipped, and with this slightly weaker open, as you were just describing. All in all, though, a pretty tight range around the flat mark either side. The broad narrative is still the reflation trade. We're seeing airlines and cruise stocks moving higher today in Europe. Meanwhile, defensive stocks like utilities are falling. As you said, the pound continues its pretty stellar run against the dollar. It hit a new 3-year high above $1.42 earlier this morning. It's the best performing G10 currency against the dollar so far in 2021, and it's at the moment on its longest winning streak since 2015. Now, this pound strength, caused some issues for the FTSE 100 earlier in the session. FTSE 100 gets a lot of its earnings from in dollars, and so a strong pound and a weak dollar doesn't do well for stocks on that index. Since then, though, we've had the pound pull back to trade broadly flat against the dollar. The FTSE 100 briefly went positive earlier today, but it is mildly negative as we speak. Miles, back to you.
All right, Yahoo Finance's Oscar Williams Group with the latest on everything happening in overseas markets. All right, we're off for a short break here on Yahoo Finance Live. A lot more coming up on the other side as we watch stocks slightly lower on this Wednesday morning. All right, welcome back to Yahoo Finance Live on this Wednesday morning. We've seen a lot of trading action in some travel names this week. Earlier, we saw airlines, hotels, cruise lines all rally big time, really, on Monday. And one company that's in focus here as they go through an executive transition is Marriott. Stock today is up about 2%. And Brian Sazzi, I know you're getting set to talk to their new CEO coming up here on Yahoo Finance in just about an hour or so.
Yeah, that's right, Miles. I'll just touch upon the stock movements. We have seen a recovery in these hotel stocks. Hilton shares up about 16% year to date. Marriott up about 14%. So investors, even I think the sell-side analyst community, they have positioned for a strong second half recovery in consumer demand, in business travel, in group bookings. But there are a lot of challenges that remain in the lodging industry. Certainly, in addition to demand, a lot more costs have come into the business just to keep the rooms clean. So I'm looking forward to talking to Marriott's new CEO, Anthony Capuano. He was officially appointed yesterday. He, of course, takes over for Arne Sorensen, who passed away on February 15th after battling really for some time with pancreatic cancer. So I think he put it best, though, on the earnings release yesterday. He said it was a bittersweet moment. Certainly not the situation we would like to come in as CEO, but Capuano is a very, very experienced executive. He's been at the company since 1995. He has led their development, has helped add thousands of properties to the portfolio. So this guy, he certainly knows what he's doing, guys.
And Sazzi, just quickly, the story for the hotel space and the travel space was all about Airbnb and how that was going to change everything. That was pre-COVID. Right now, we're trying, the hotel business is trying to get through a very acute, unprecedented crisis. But how much does that Airbnb question come back in? When does that come back in, I guess, for maybe some of these brands?
It's still top of mind, Miles and Julie, in the lodging space. But one business that Arne Sorensen launched when he was CEO, and I remember when he did launch it because a little after then, I believe he came into the Yahoo Finance headquarters to discuss it, and has since grown. They are now renting entire homes. And this fun fact, buried in the last earnings call, they now have 25,000 units available to rent, entire homes in their business. So obviously a little bit different approach than what Airbnb does, but quietly and under the radar, this home rental business is becoming a real business for Marriott. Is it moving the earnings needle yet? No, but could it in a couple of years? Might be.
Interesting times. I think a lot of people maybe forgot that VRBO existed long before Airbnb, and so there's been an opportunity there for some time. Be interesting to see how everyone moves into that space. All right, we're off for a short break here. A lot more coming up on the other side on this Wednesday morning. Stocks marginally lower here as we get the week's third trading session underway. We're back right after this. All right, just before 10 o'clock here in New York City on this Wednesday morning. Welcome to Yahoo Finance Live. Miles Upton here, joined as always by Julie Hyman and Brian Sozzi. Let's take a look at where stocks are trading this morning. We are still seeing stocks under a little bit of pressure. Of course, we had that big turnaround during yesterday's trading session. When we were on the air at about this hour yesterday morning, the Nasdaq was off close to 3%, in excess of 3% at one point. And we saw the major averages erase most all of those losses throughout the day. So we'll see how things shake out here. Still some unsettled trading, I think, to say the least, within the market. It bears careful watching, I guess we should say, as we continue along here. Another thing that we are, of course, watching carefully on a daily basis now, that is the price of Bitcoin. Continuing to see some pressure in the Bitcoin space, at least relative to those records that we hit late last week and over the weekend. 55,000 was the high there. Now Bitcoin trading right around 50,000, and the swings have been in the $1,000 increments over the last several days. This is not news for folks who have been following the Bitcoin space for some time. The volatility is well known, well expected, and I don't think it's going to really go away anytime soon. Of course, as the price per Bitcoin goes up, well, then the increments get larger. So then we become talking about $500 and $1,000 swings, whereas previously we may have been talking about $50 and $100 swings. So we'll see how that evolves. But again, $50,000 per coin. I think everyone's pretty much going home happy on this one. Let's take another look also at what's happening over at ARK Invest. This is Kathy Wood's investment firm, and there's been a lot of attention in the last handful of days on the holdings within the funds. ARK-K, the main ETF that ARK has, under a little bit of pressure this morning, off about 1.7%. We had seen ARK-K fall about 10% from its highs at one point during Tuesday's trading session, but just a huge rally during yesterday's session and in a number of the constituents as well. You look at the biggest holdings of ARK, obviously well known for its Tesla position. Kathy Wood yesterday joining Bloomberg to talk a bit about acquiring more Tesla during yesterday's trading session, talking up the prospects for Bitcoin, which ARK has been involved in. But if we look at the handful of largest holdings within ARK-K, Tesla and Unity Software right now are the only two of the 15 biggest holdings that are in the green. All the other names continue to be under some pressure. Twilio's in there, Baidu, Square is down about 8% following its earnings last night. That's a reversal from the after-hours action that we saw. So still some pressure there, still some unresolved tension, I think is the best way that I've at least been thinking about this market over the last handful of sessions. And we'll kind of see how that plays out as we wrap up the trading month. Just 2 more days until we say goodbye to February. But let's talk a bit more this morning about what's happening on the consumer front. We've obviously talked quite a bit about how Wall Street is upgrading its outlook for economic growth this year. We've seen the market certainly price in extremely optimistic outcomes, and fourth quarter earnings certainly starting to back that up. But consumers are still materially lagging, I think, where Wall Street is at in this recovery. Yesterday, we got some data from the conference board showing consumer confidence, a very slight uptick from the prior month in February. But as we see on this chart, consumer confidence has really done nothing over the last couple of months. We had a couple of highs in September, October, November. Things appeared to be turning around. And then, as public health experts warned, a massive winter surge. It got cold. It's been very snowy. Obviously, the weather has been also unprecedented. You think about what's been happening in Texas as an example of that. And it's not been a great couple of months for most consumers. We also have about 10 million fewer jobs in the U.S. than we had a year ago. And Julie, I know that ultimately consumer confidence doesn't necessarily track where the S&P 500 goes. But there is certainly a question in my mind, at least, as to how this tension resolves. I can't imagine that consumers remain about as cautiously optimistic as the word the conference board used while Wall Street continues round. It would seem, right, there has to be some meeting in the middle, or we're all just going to catch up massively to where investors are.
Well, I would say a couple things. First of all, I want to bring up the fact that we just got new home sales in the last few moments. January new home sales, 923,000. That's the annual pace. It's above estimates. It's up a little more than 4% on a year-over-year basis. So whatever consumers are saying in terms of confidence, they are doing things like making purchases, right? And we always have to talk about that gap between how consumers feel, what they're saying, and what they're actually doing. Now, we also know, of course, a lot of them are holding back on spending. We did see those retail sales in January, but we also know the savings rate has gone up. The other thing I would say is there seems to be this emerging discussion and debate over messaging and tone from the CDC and other public health officials that perhaps they are being overly cautious when it comes to some of their current guidance on coronavirus, particularly for individuals who've gotten the vaccine. And so I think that speaks to the consumer confidence issue as well, that, if people are still feeling afraid to go out, once those sorts of concerns are perhaps resolved a little bit more, then perhaps you see the unlocking. I saw a good analogy yesterday. I can't remember who did it, or I would give credit, on Twitter, that talked about how, the CDC also tells you only to eat your steaks well done. And most of us don't do that, right? That there is this sort of public health priority that tends to be more conservative. And then there's the stuff that people actually do. Because coronavirus is new, because it's scary, because it's deadly, people have tended to follow the letter of that guidance, at least people in the Northeast, where we saw the virus first hit really hard, maybe less on the rest of the country. But you do wonder, as people try to sort of get adjusted with their real life reading of that guidance, if you'll start to see that consumer confidence number change.
It does amaze me. And to your point, Julie, the confidence measures, they will say one thing, but consumers, at least right now, the early anecdotes we're getting from these retail earnings, they're out there spending, and they're spending in a big way. Maybe not so much in apparel, but certainly within the home department. TJ Maxx, their home goods division, 12% same-store sales increase in the fourth quarter, and the momentum looks to have continued into February, which is obviously good for TJ Maxx, but it gives a strong indication on the consumer. And an interesting stat I just got from Jefferies retail analyst Brent Thill. He ran our survey recently. He said 20% of respondents engaged in do-it-yourself home improvement projects last year and bought a drill for the first time. So you have people at home, I think folks that do have money, that are maybe not really being captured, I think, effectively in the confidence measures. They're out there and they're buying lots of stuff and really spending a lot on home improvement projects. So clearly they have money and they're getting it from somewhere.
Yeah, and Julie, too, I think that whole messaging conversation is one that we'll probably have for many years after the pandemic is over, and look back and say, for obvious reasons, things in 2020 weren't handled a certain way. But the way with which you've had to have course corrections from authorities that have both been not listened to and then not trusted and then contradicted themselves, and how that all fits into this picture of sort of where we are all trying to head. And I think what's interesting as well in this, to bring it back to the economy, is that the data still reflects, I think, not exactly reality, because as you mentioned, you leave the Northeast, things are mostly open. Things are pretty much, I wouldn't call them normal, but you wouldn't say, oh, there must be a global pandemic going on. And so the numbers, however, reflect more of what I would think is the lived reality, what seems to me the lived reality here in New York City, which is very much a pandemic vibe. And so how that all squares, I think, as we get into the second half of this year, certainly get into this summer, is going to be a fascinating dynamic to see. And again, it's why we continue to ask most of our guests, are we still being too conservative as it relates to potential economic growth in the second half of this year? All right, let's stay on the economy and talk a bit more about everything happening in the markets. We're joined now by Kristen Bitterly. She is the Regional Head of Investments for North America at Citi Private Bank. Kristen, thanks for joining the program this morning. I'd love to start with rates and what you guys are thinking about the signal we can reliably say is coming from the long end of the bond market, and how you're trying to decompose some of those pressures that maybe have investors worried, or maybe folks are just looking through.
Yeah, so the price action that we've seen, obviously, in broader markets, and particularly within rates, this has been driving everything over the past couple of days. And this question about, okay, should we be worried about inflation, the curve steepening, what does that mean for growth stocks? And so in terms of how we've been positioned going into this, we've actually been pulling back from some of what we call the COVID defensive stocks that have really seen a lot of a run over the past 12 months, and then rotating into what we call COVID cyclical. So we've been doing that rotation, and we've also been positioning our portfolios in anticipation of some of this inflationary concern as well as rising rates. Because as the data gets better, so some of the things you were just talking about, so the consumer savings rate, the average savings rate in the US is twice the amount it was last year. As we think about this pent up demand, and when the 15% of the global economy that's currently shut down, when that actually comes back online, what does that mean? So looking at our portfolios, basically, if you're looking at this curve steepening, what things are punitive? It's cash and duration. So where we're positioned right now is we're trying to find ways of augmenting income without taking on duration. And we're actually trying to convince people that cash is punitive, because when you look at it on an inflation adjusted basis, you're almost guaranteed to lose value.
Well, seeing that people have seemingly been pouring money into lots of stuff with that has a higher return, maybe they're getting that message that cash is punitive right now. I want to pick up on the discussion that we were just having about consumer confidence. I don't know where in the world you are, but this sort of perception that maybe we're a little skewed here in the Northeast in terms of how open the economy is. Both anecdotally and the actual data. How optimistic are you in terms of economic growth right now?
So I'm in the Northeast as well. So in terms of, I'm here in Brooklyn. So in terms of my own perception of it, I can say that I definitely feel that 15% of the global economy is still definitely shut down, where it may be more open depending upon climate. I think that consumer confidence, we still see, so yes, there's certain parts of the market where people are pouring money into the market, and we've seen that, but we also do see that hesitancy in terms of getting invested. And so I can understand that consumer confidence kind of being right in the middle, that there is improving data, right? So you have this element of vaccines, the distribution of vaccines. You also have more vaccines coming to market, right? And more efficacious treatments. So this idea that you could see a summer that would be a little bit more normal, I think is something that consumers are getting comfortable with. And they are starting to think about planning things like vacations and how basically they're going to be coming back to normal in a post-pandemic world. Well, we've seen spending. So you guys were mentioning kind of the spending in terms of home improvements and the first time someone bought a drill. We've seen that type of spending, but obviously there still is this pent-up demand, and there still is a pent-up demand for all of those really heavy hit COVID cyclical industries, which is something that will drive the consumer behavior. And I think ultimately something that will be a reinforcement of whether we actually see strong consumer confidence.
Kristen, is too much being made out of the rise in 10-year yields? Not as if the 10 years at 4%. This is 1.4%. It remains very low historically. Are you at that point where 1.4% is triggering you to make changes in your portfolios?
You know what I think the market is wrestling with right now? So when we look at the 10-year where it's at, we almost have to go back and say, look, the 10-year in December of 2019 was at 1.9%. So the economy was functioning very, very well. Technology and growth stocks were actually continuing to dominate the market and grow. And so I think what the market's wrestling with right now is whether this rotation that we're seeing, is it a rotation or is it catch up of COVID cyclicals? So the price action that we see today, obviously you're seeing some of that rotation. You're seeing financials perform very well. You're seeing tech hurt a little bit. But I think one of the questions that we're all struggling with is really kind of pivoting more to real earnings as opposed to expectations. And so what I mean by that is, yes, you can see why financials would perform well with the curve steepening. You can see parts of, once the economy reopens, those sectors actually doing particularly well. But I think one question on everyone's mind is, so when you look at some of these companies that have been dominating the market, so let's talk about like the big five, right? So like Apple, Amazon, Microsoft, Google, Facebook. When you look at them, they're right now around 18% of market cap, but they're 25% of earnings. And so in terms of representation from a contribution of earnings standpoint, you could almost make the argument that they're underrepresented. And so I think the focus and what everyone's going to be watching very closely is, can these companies actually continue these really stellar earnings and continue to deliver even as we move to a post-COVID world?
Kristen, something you flagged to us is that all your clients, or many of your clients, are asking about if we're in a bubble, how that fits in here. I think everyone likes talking about it because it's a big, fun word to say. And related to that also is the crypto conversation. All this speculation that happens not just in financial markets, but tangential to financial markets. How are you guys talking through, some of those concerns, or maybe the FOMO, perhaps, that some of your client base is having if they are not really allocated to those kinds of areas?
Yeah. So the question about are we in a bubble and where to put capital to work, I think you always have to put it into perspective. My colleague, Robert Buckland, did a really great piece, an op-ed piece in the Financial Times that walked through just putting it into perspective compared to 2000, for example. And if we look at the price action, not just over the past, I think everyone's looking at this price action since March and since the depths of the pandemic. But if we take a step back and we actually look at over the past 3 years, what price action are we seeing in equity markets? Well, the past 3 years, you can say the NASDAQ is up 90%. So 30% per annum, that's actually very, very strong. We all would agree with that. But going into the tech bubble, it was completely different. It was around 300%. US equities up around 36%, so 12% per annum. Once we get outside the US, though, it's a very different story. So emerging markets up 12% over that time period. The DAX flat. UK equities are actually negative over that same time period. So I think the one thing is when you're looking at, are we in a bubble? There are parts of the market that, yes, feel that way, look that way, seem overheated. And that's why I go back to, are these parts of the market, are they delivering on earnings or not? And the other thing is to focus on, where haven't you seen some of this snapback? Where are you looking from a relative valuation standpoint that's attractive? And an example of that, global healthcare. So global healthcare, you would think in a pandemic, right? In a pandemic, healthcare would absolutely be rallying. But what we've seen is on a relative PE basis, it's at the lowest levels relative to global equities in about a decade. So we like healthcare for a variety of reasons, not just because of the pandemic, but more of a demographic argument. But it's a strong sector, high free cash flow generating. So there's areas of the market where it makes a lot of sense to invest, not only short term, but long term.
All right, Kristen Bitterly is the Regional Head of Investments for North America at Citi Private Bank. Kristen, great to get your thoughts this morning. Thanks so much for joining the program. We'll talk soon.
Thank you.
All right, off for a short break here on Yahoo Finance Live. You see the NASDAQ losing a bit of steam, off 1.2% now as we head into the second hour of today's trading session. We're back with more on that right after this.
get a check on stocks as well as some of our trending tickers right now. We are seeing stocks pull back. And once again, we've got this divergence that we have been seeing quite frequently in recent weeks between the Dow and the Nasdaq, with the Nasdaq down much more over the course of the session as we start to see a rotation out of some of the big cap tech stocks. Nasdaq today down 0.9%. The S&P is only down about 0.25%. And the Dow is barely down at all. In terms of some individual movers that we're watching closely, we continue to watch this story with Workhorse Group, the electric vehicle maker, which lost a contract from the U.S. Postal Service to provide it with transportation to Oshkosh Defense. Workhorse has said it has requested more information from the Postal Service on why it did not win that contract, but the shares are down sharply. Oshkosh shares are trading higher. And then also in electric vehicle news, we're watching Fisker, another electric vehicle startup. It said that Foxconn is going to be making or assembling cars for that company. And so they've got a memorandum of understanding to jointly produce more than 250,000 vehicles a year. Not clear more details on that exactly where the cars are going to be assembled, when that's going to start happening. But those Fisker shares are trading higher by 17.5%, and they are also on the trending ticker list on yahoofinance.com. All right, we'll be right back speaking with the head of ShareCare. Stay tuned.
All right, welcome back to Yahoo Finance Live on this Wednesday morning. As our viewers know, SPACs have been the hottest trend in markets of late. And we have another announcement, or had one just a couple of weeks ago. ShareCare will come public in a merger with Falcon Capital Acquisition Corp. And ShareCare CEO Jeff Arnold joins us now to discuss. Jeff, thanks so much for joining the program this morning. I'd love to start just with kind of where ShareCare fits into a theme we've discussed a lot with a number of companies. I think of it as broadly digitizing the healthcare space. I don't know if that's how you guys are thinking about it, and just maybe where some of our viewers have probably come into contact with ShareCare without even knowing it.
Yeah, sure. Well, I've been in digital health for most of my career. I started WebMD back in 1998. And I think what's really exciting for digital health now is we're moved beyond just being able to get trusted content, but to be able to really leverage technology now to bring the ecosystem to the palm of the person's hand. So instead of having to go to the hospital website or download the insurance company's app or only think about your benefits during open enrollment, technology is now enabling us to put all that together in one place directly to the person.
Jeff, it's Julie here. I was going through your investor presentation, and indeed, it seems like you guys do a little bit of everything when it comes to digital health. But from what I was gathering, it seems like the largest proportion of your revenue comes from services directly to healthcare providers and insurers, if I'm understanding that correctly. What is that relationship, and what services are you providing to them?
Yeah, so think of ShareCare as this idea of all together better. So we're all together better when we can bring the ecosystem to the palm of the person's hand. We're all together better when we can move away from the sea of apps to integrated platforms. And we're all together better when we can go from my health to our health. And our business looks almost like a wedding cake. We're on the bottom. We have a big enterprise business where we service government, large health plans, and employers. And what we do for them is in this single platform, we provide them with benefits and healthcare navigation. We provide them with digital therapeutics, so we have interventions to help get better outcomes, and we provide advocacy services.
Jeff, there's been a good number of digital health companies that have emerged during the pandemic and really growing aggressively. As a veteran in the space, do you expect there to be a roll-up moment where a lot of these companies, let's say such as yourself, acquire other companies and combine to grow bigger, or ultimately these players, again, such as yourself, just become part of a bigger healthcare company?
Yeah, I think ShareCare's aspirations are we want to be the front door of healthcare, and so we deploy this one integrated platform to these big health plans that reach millions of members. We announced the largest Medicare Advantage plan this week in South Florida. But I think more is better here. What's happened historically in digital health is that clients have really suffered from vendor fatigue. How do I buy all these different point solutions? How do I make the data interoperable? How do I make the user experience easy to understand? How do I make it affordable for all? So the ShareCares of the world have come along and said, technology is now here where we can provide you this one integrated platform that can help educate people on what their baseline looks like. For us, that's their real age. We can help educate people on their real time, so be able to do holistic tracking, but more importantly, be able to use technology to take health plan members and employees on a journey that helps them understand their numbers, manage their risk, manage their conditions, understand their benefits. And I think the goal of all this technology is to use technology to get that triple aim of improving outcomes and lowering costs and improving satisfaction, but more importantly, get people to move from episodic to everyday.
Jeff, I want to turn to the SPAC structure, because one of the questions I've had as we have had this explosion in SPACs late last year and coming into early this year is, what would have all these companies done had there not been a SPAC boom? So I would ask you, as someone who's also been through an initial public offering with WebMD, what was your plan before this whole SPAC boom, or earlier on? Were you planning an IPO and then you switched?
Yeah, well, if there's a silver lining in the pandemic, which is hard to see, has been digital health. As people more so than ever are self-aware of their risk. This has become a must-buy for CEOs in investing in a culture of well-being. We had the scale to go public. We'll do over $396 million in revenue this year. We're EBITDA and cash flow positive. We had a board meeting in Q4 and said, look at what's happening in the market for digital health and the investor demand that's out there. We should hit the dance floor too. And we started getting approached by various SPACs, and I didn't know much about SPACs at the time. But as I started to get educated about them, I saw some benefits that I thought were really attractive. One, being able to talk to investors for an hour and really be able to explain healthcare, because healthcare is super complicated. We thought for ShareCare that was a great benefit. Being able to share forecasts. We've had a big COVID boom in digital health, so to be able to tell how our revenue is accelerating and how we think that is going to last for forever forward as in within this new normal. And then we've found some really quality SPAC sponsors. In our example, it was Falcon, who was led by Alan Mnuchin, who's got amazing capital markets expertise. They had good experience with SPACs. Is Jeff Zdansky, his partner, and Harry Sloan had done the DraftKings SPAC. They had done the Skills SPAC. And so, being able to talk to investors, having capital market expertise, having SPAC success in the past, we saw as real benefits, as well as getting public a little bit faster.
Jeff, just finally, before we let you go, I want to ask maybe like a broader question, just looking kind of through your experience about where you see like medical content going, if that makes sense, with WebMD and just think, I mean, you've seen digital content go from something that doesn't really exist to pretty much all we consume all day. I don't know if that's an ambition you have, a ShareCare being more integrated with consumers, but I'm curious how you see this space as a veteran of it.
Yeah, so I think trusted information is obviously really important. I mean, we're in a space where the information has to be, right 100% of the time. I think being able to take that trusted information and be able to data-driven dialogue. So no two content experiences are the same. Your content experience is different than my content experience, and being able to go where the person's at. So whether it's at their job or through their health plan or as a patient or on social media is going to be key. I think artificial intelligence is going to unlock the next explosion of where we're going to be able to take data and not just be able to create dialogue and educate people, but we're going to be able to create insights. And so this idea of, using AI to be able to optimize my diet, by taking pictures of my food and then being able to figure out what's the right diet for me, or be able to optimize my mood. I mean, I can literally take a picture of your face and tell you what your height and your weight and your BMI looks like, and start to track different elements of your smile to track your mood, to be able to provide interventions, all the way to where I think the new UI is going to be no UI, that everything is going to be done on voice commands. So you're going to be able to say, when was the last time I had an eye exam, refill my prescription, schedule my doctor's appointment. And this idea of sharing care, what I think this is going to mean over time is that I share my data with ShareCare so that I can optimize my health, but I'm also sharing my data in an anonymous way so I can optimize our health. And I think this is going to become our Operation Warp Speed, and is going to be what the essence of ShareCare means over time and how we build community that lasts forever.
All right, I'll make sure to smile for the camera so I look happy, healthy, and I get a good report from my medical team. All right, Jeff Arnold, CEO of ShareCare. Yeah, Jeff, I appreciate the time this morning. Hopefully, congrats on the transaction. Hopefully, we'll talk as you guys get into the quarterly rhythm of reports. Appreciate the time.
Absolutely. Thanks for having me. Take care.
All right, let's take a look at markets. As we head to break, Dow has now turned positive, S&P basically unchanged, NASDAQ off 0.6. We're back with a lot more on Yahoo Finance Live coming up right after this.
The world recently lost a titan in global business, and above all else, a good human being that touched many lives worldwide. Longtime Marriott CEO Arne Sorenson unexpectedly passed away on February 15th after an extended battle with pancreatic cancer. While the Marriott team continues to mourn the loss of Sorenson, it announced a successor as CEO this week to lead the company forward. Joining us now is Marriott's new CEO, Tony Capuano. Tony, good to speak with you here. I think you put it best in the press release yesterday announcing this decision. This is a bittersweet moment for you. What was your reaction when you got that call that you would be succeeding Arne Sorenson?
Well, good morning, Brian. Nice to see you again. To state the obvious, it was humbling, but also energizing. If Arne were here, he would tell us to continue to move forward. And I think our associates, our customers, our guests around the world, they are anxious to help us achieve the sort of recovery that they hope for. As you and I have discussed, people are anxious to get back on the road. And part of my new responsibilities is to do everything we can to ensure that guests feel safe and feel confident as they start to travel again.
I think a lot of people would still be surprised that Mr. Marriott, he's still at the company, he's the executive chairman. Have you had a chance to talk to him, and what has he told you about assuming this position?
Well, your first question, I think I've spoken to him a dozen times in the last 2 days. He is a very engaged chairman. He loves this company, and he is an extraordinary role model in terms of continuing to carry the Marriott culture forward. And I think that's been his principal message, that this company has thrived for nearly a century, and the fundamental foundation underpinning that success is this notion of putting people first, of taking care of our associates around the world. And he has encouraged me to adopt my own leadership style, but through the lens of that culture, which is really the company's true north.
You had a chance to really work with Arne hand in glove for many years. How did he help prepare you for this position?
Well, you're right, and it was a profound privilege for me. There are so many wonderful attributes that Arne had as a person, as you pointed out, and certainly as an executive and a leader. I think authenticity is an attribute that comes to mind. As Arne met folks, whether they were partners, associates around the world, they knew with confidence that he was engaged in the conversation, that he cared about them, that he cared about what they had to say. I think secondly, maybe intellectual curiosity. Arne was a continuous learner. You rarely saw him without a book under his arm. And I think it was that curiosity that made him such a global citizen and such an engaged leader.
Well, Arne was also a bit of a road warrior. On the road for over 200 days out of the year. How will you spend your first 100 days as CEO?
Well, I wish I could tell you I could spend all 100 on the road. That would be my strong preference. I want to get out and meet with our partners and visit our hotels and connect with our associates. Unfortunately, I don't have the absolute latitude that I had given the closing of some of the borders, but I will get out on the road as schedules permit. I've got a whole schedule of virtual meetings with our partners, with our general managers, with our business councils in the coming days. And I'll continue to engage with our senior leadership team around the world and make sure they have all the tools and all the resources to help us drive demand.
Talk to us about the state of the Marriott business. We've seen a rally this year in shares of lodging companies. Your stock's up close to 14%. Hilton's up close to about the same. Are you seeing green shoots of a recovery in the U.S., but also China? I know China is a very important market for Marriott.
Yeah, maybe I'll start with China, because I think China gives us all so much optimism about the near-term future of travel. As I'm sure you know, we have nearly 400 hotels in China. In fact, we just opened our 50th hotel in Shanghai. And because the country has done such a good job on virus containment, we're seeing occupancy levels return to nearly pre-pandemic levels. But we are also pragmatic as we look at other markets around the world. We see that when there are spikes in infection rates, it has a fairly chilling effect on demand patterns. We are, as you rightly point out, seeing some green shoots in markets like the US, certainly led by leisure transient demand, but we're seeing those green shoots in business transient as well, and that's quite encouraging.
The business travel environment, has it been changed forever because of the pandemic?
Well, as you know, Brian, lots of folks have lots of opinions about that. We tend to have our opinion about the future of business travel informed by what we hear from our customers. And while I think leisure will continue to lead the recovery, we are quite confident about the medium to long-term future for business travel, and we don't think there is a fundamental and permanent change in demand for business travel. In point of fact, what we hear from our business transient customers is they can't wait to get back on the road, to meet with their business partners and to meet with their customers.
It seems as though, just having followed Marriott through the years, since the Starwood deal, you guys are always getting questions on the number of brands. 30 brands in the portfolio? Do you still like the fact that 30 brands? Do you still like that fact that you have 30, or do you want to slim down a bit?
We love that we have 30 brands, and I think the principal driver of that love is this notion of breadth of choice, both from our consumers and our owners and franchisees. Our consumers have lots and lots of trip types, and they may very well in the course of a year for a business trip stay in one of our select brand hotels, and then they may take their vacation with their family in a premium or luxury brand. Similarly, for our growth partners, our owners and franchisees, they often want to continue to grow their portfolios within the Marriott ecosystem, and giving them that breadth of choice, I think, is a tremendous advantage for us.
I think the last time I talked to you was August 2019, believe it or not, in our headquarters in New York City. It feels like a lifetime ago.
That's right.
And we talked a little bit about the budding at the time home rental business. Now that business has now reached 25,000 units, luxury homes in many cases. Is that moving the needle financially, and what are your plans for that business?
It's not particularly material financially today. But we think it is a really important complement to our core lodging business. As you'll recall, when we launched in 2019, we only had about 2,000 units. Now we're 25,000 units. Ideally, by the end of the year, we'll even be growing across Asia Pacific. And the value proposition for us is whole home rentals only. We're not doing home sharing in the traditional sense. We're really focused on the upper end of the market, whole home rentals. The value proposition, I think, is really predicated on safety, on service, and of course, a link to our Bonvoy loyalty program. And the reason I say it's a great complement to our core business, we know from talking to our customers, for certain very specific trip types, they prefer a home rental. And the Homes and Villas platform really allows to keep them within the Marriott family for all of their trip types.
All right, we'll leave it there for now. Tony Capuano, Marriott's new CEO. Good to see you. Congratulations on this appointment.
You too,
Look forward
Brian.
to following your CEO journey. Very well deserved. Stay safe. We'll talk to you soon.
Well, thanks very much. I hope our next visit is in person.
Yes, that would be very good. Maybe inside a Marriott hotel. We'll talk soon.
Absolutely. Thanks, Brian.
All right, coming up, Yahoo Finance sheds a bright light on the next big 21 names in business in a new series. Stick around.
Hi, my name is Young Kim, representing California's 39th Congressional District. If someone like me can do what I do and be able to give back to this country and to the community that I love, I know the American dream is very much alive and it's real.
Representative Young Kim, 21 to watch in 2021, definitely among the most moderate members of this freshman class. How do you get along with those colleagues, though, that seem more inclined to pick partisan battles? Because you seem so focused on the common ground.
I am very focused on finding common ground. You're right. That's why when I went to Washington 2 years ago, when I was first running in 2018 cycle, I had learned about Problem Solvers Caucus. And so I had known about the work they did, how the Problem Solvers Caucus was able to negotiate a bipartisan relief effort in December of last year. This is exactly what I went to Washington, D.C. to do. I came to Washington to get things done in a bipartisan way. So I kept my promise by hitting the ground running, like with my like-minded members on both sides of the aisle.
What part of your background, either being having an immigrant roots or owning a small business, have been most helpful to you in navigating Washington so far?
I think I say both. As a mother of four, I think I've learned naturally to be a negotiator, to fight for a win-win solution. When one of your child gets into an argument with the other, I'm also a Libra, born in the year of Tiger. So I call myself a Tiger mom, someone who is able to negotiate and judge productively and constructively, and to try to find a solution that works for all of them. And so I think that really helps me.
I mean, it's no secret, and listening to you, you can see why. We've got folks like Leader McCarthy saying that he looks to members like you as the future of the party. Is it possible for both you and Donald Trump to be the future of the party?
I think so. You know what? I represent my district. And I look like the district, which is very diverse. My district is like 1/3 Asian, 1/3 Hispanic, and 1/3 Caucasian. And I speak one of the very diverse languages. There is like about at least 17 different languages being spoken in my district in Southern California. But I am my own person. And I've always run on my own record. And, President Trump is very unique, to say the least. He is very opinionated. I supported his policies, but not necessarily his rhetoric or his attitude or the way that he delivers his remarks. But again, I think at the end of the day, we all get elected to do the right thing for the right reason. I believe I'm the future of the Republican Party, bringing diverse, unique, different perspective. And I want to be able to use my common sense background and be able to stand up for what I believe is the right thing to do. Once you're elected, you are elected to represent all people, whether they voted for you or not. So my priority will be just stand firm, listen to everybody, both sides, but at the end of the day, people elected me to represent them. They need to trust me that I am doing the best in my power to do the right thing for the right reason. We're not going to agree on everything 100% of the time. This is why I ask people, remember what President Ronald Reagan said. You don't have to agree on everything, but if you agree with someone at least 80% of the time, that is a damn good thing. We can get a lot of things done. And I learned early on, if you don't care who takes the credit, you can get a lot of things done.
When I was listening to you just talking about how few Asians there are in Congress and all the news that we've had recently, there's just been this spike in violence really against Asian Americans. And I would love to know your thoughts.
especially during the pandemic, because the coronavirus originated from China. Unfortunately, Asian Americans have been the target of hateful comments. It was unwarranted because coronavirus was not caused by any one ethnicity or any social class, as you know, but because the Asian Americans were unfairly targeted, it was compounded and I guess inflamed further when President Trump referred to coronavirus as a Kung flu. I looked at him and I said, you know what, I support his policies and I think he has been a great president, helping our economy as strong as we've seen before the COVID. But when he called it Kung flu, I said, enough is enough. Leaders' words have consequences, and the leaders has to be very sensitive about what they say. That comment was very insensitive, and I called him out on that. And I wanted to make sure that, we love immigrants, we love diversity. And this pandemic was not caused by any one ethnicity or any group of people. I wanted to make sure that my community know that I'm with them, I understand, and that message had to be sent.
Representative Young Kim, Republican of California, and Jen Rogers, who did that interview, is with us. Now, Jen, it's so interesting hearing that interview and hearing her quote Ronald Reagan, right? When it definitely feels like the party of Trump now, not the party of Reagan. And so if she's someone who is going to stand up to Donald Trump, can you survive in today's Republican Party?
It's really hard to do. And you can hear her there a couple of times, really, whether it was talking about coronavirus and attacks on Asian Americans, or even just the polarization in the way that he speaks. I mean, she said he was a great president, but she definitely takes some shots there. And I think that the reason we put her on this list, she's one of 4 Republicans in California that flipped their districts from a Democrat to a Republican. They made inroads there in California, right, which is just thought of as the bastion of Democrats. And that actually gives her some protection, Julie, as we've seen with those 11 Republicans that did side with the Democrats in voting to take away Marjorie Taylor Greene's committee assignments. A lot of them have faced pushback in their communities, but the Californians, it's a little bit different. And she hasn't had that impact. And that might give her a little bit more leeway here to become her own person, as she says she is.
Well, she did win her election, so that's something that is an endorsement of at least some of what she's saying. We'll see if it can last. Thanks so much, Jen. Good to see you. And we'll be right back with more on Yahoo Finance. Stocks are mixed at this point. We are continuing to see the Nasdaq push down, although it's up off its session lows. And that's even as we see a recovery in the Dow and the S&P 500. The Dow's now up 0.5%. The Nasdaq's gone pretty much nowhere for this whole month. It's kind of been a curve downward. So that's something to continue to keep an eye on. And this, of course, as we have seen bond yields push higher over the course of the month. Now they're above 1.4%. That's something that investors are watching keenly. And so we will too. All right, on behalf of myself, Brian, and Miles, have a great day, everybody. Keep it right here on Yahoo Finance.
Welcome into live coverage here on Yahoo Finance. Happy Wednesday, everybody. I'm Zach Guzman alongside Akiko Fujita. And right now, a mixed picture on Wall Street as the Nasdaq remains in the red after yesterday's early morning jitters. You can see the Dow and the S&P in positive territory, though. The same story holds. Tech names still under pressure, though. That sector down in today's session. But Bitcoin seeing some relief after Square CEO Jack Dorsey doubles down on the crypto with yet another purchase to add to the company's holdings. Why he's just as bullish as ever. Plus, Fed Chair Jerome Powell back in front of Congress for day 2 of 2, this time in front of the House Financial Services Committee. What he's saying this time about being more accommodative and what it means for your portfolio. And Crocs, better and arguably badder than ever. The company reporting record revenues to beat on its top and bottom lines. But can the clog company keep that momentum up? The CEO of Crocs will break that down for us a little bit later on in the show. But first, I want to start things here with Jack Dorsey, as I said, coming to the rescue for Bitcoin, with Square announcing it bought another $170 million worth of Bitcoin, this time at an average price of about $51,000 per Bitcoin. The new haul adds to the company's prior purchase of $50 million in Bitcoin. That now brings Square's cash equivalents up to about 5% held in Bitcoin. Take a listen to Jack Dorsey endorsing the move and the future for that cryptocurrency on the company's earnings call.
Our thesis around Bitcoin is really quite simple. We believe the internet will have a native currency. The internet has broken through so many barriers all around the world for every industry, and we do think money and currency are a big part of that future. And it doesn't take a lot to imagine that certainly that will exist and that it will be Bitcoin.
So Square doubling down there, Akiko. There's also business intelligence company MicroStrategy, which really kicked this trend off, buying another $1 billion worth of Bitcoin. That announced today. It literally raised that money selling convertible notes explicitly to buy Bitcoin. So they're tripling down. But so far you got them, Tesla, Square, and MicroStrategy CEO Michael Saylor predicted other companies would follow. But so far, not much to speak of.
Yeah, Zach, it's interesting to see how we've seen this classic bull versus bear debate around cryptocurrency, particularly Bitcoin, play out over the last several days. Yesterday, we were talking about the institutional names like the Janet Yellens and Bill Gates, saying essentially that they believe there is a lot of concern around the volatility and speculative nature of the currency itself. Now you've got those three names you mentioned, but also Cathie Wood from ARK Invest really doubling down on her conviction plays. And this is an interesting one to watch here, because she's invested heavily in Tesla as well as Bitcoin. And we have seen those two really move in tandem. Bloomberg out with some interesting data on this front, looking at ARK's innovation ETF, seeing record outflows as we have seen the price of Bitcoin fall, along with Tesla shares falling. Investors, according to Bloomberg, withdrew $465 million from ARK's innovation ETF alone. Cathie Wood certainly not fazed by that, though, said she is doubling down on Tesla as well as Bitcoin, adding to her positions in both of those plays. So what we're seeing right now are those who have long been bullish on Bitcoin really saying, well, we're seeing the dip here. We're going to see that as an opportunity and get in, and that is lifting the price today.
Yeah, and I mean, a lot of doubling down there. You mentioned Cathie Wood, that whole side. You think about how both of those worlds are converging. We heard her talk to Jen Rogers here on Yahoo Finance about her bets on cryptocurrency, Tesla making that big bet on Bitcoin. Now those worlds converging. You wonder about diversification when it comes to ARK, now kind of added on top of each other. But MicroStrategy, I'll just highlight this too, just the size of it, because we saw Square now 5%. Tesla's Bitcoin purchase was about under 9% of their cash equivalents. When you look at the size of MicroStrategy, though, that company, about a $7 billion market cap. They now have 90,000 roughly Bitcoin there, $4.4 billion worth of Bitcoin. So they're almost, well, more than half their market cap is now just in Bitcoin. So that's essentially become a Bitcoin company now publicly trading. But very interesting to see all of those bets kind of stacking up here. And interesting, as you point out, to kind of see that come in the backdrop of what we're hearing from Fed Chair Jerome Powell back in front of Congress again today. He was asked yesterday about Bitcoin and cryptocurrencies, what the Fed could be doing there, and want to bring on our own Brian Chung, who's been watching all of this play out as he's in front of the House today. And Brian, it was interesting to see him respond to some of those interesting questions coming from congressmen and women. But today, a lot of the same messaging, I suppose, in terms of the Fed being more accommodative for longer.
Yeah, absolutely. And just to kind of maybe transition from the point that you were just talking about on Bitcoin, no specific commentary from the effectively the nation's top economist about where he thinks Bitcoin kind of plays a role in this economy. He's kind of tried to dodge that question before, but he did talk about a digital dollar and maybe the opportunity for the Fed to further explore some sort of central bank issue currency even this year, but said that there's still legal questions about whether or not the Fed has the authority to do that. But yes, broadly speaking, the economic outlook from the Fed chairman, mostly the same as exactly what he had told the Senate Banking Committee in his testimony yesterday. He said that they've been very specific in saying they're not going to lift off until they see conditions just right, but said that they haven't tried to be specific about asset purchases, their quantitative easing program. There could be some flexibility on that front, but the need for accommodative policy, at least for right now, according to Jay Powell, is clear. They need to get the employment numbers back to where they were pre-pandemic. Here's what he told the House Financial Services Committee.
If you include people who were in the labor force and indeed working in February and a couple of other adjustments, you get to almost a 10% unemployment rate. So there's a lot of slack in the labor market and a long way to go to maximum employment.
And this is all coming as a slew of other Fed officials are also set to speak today. In fact, Lael Brainerd, Fed governor, is speaking at Harvard right now. She's talking about a pretty staggering statistic showing that if you were to disaggregate the overall unemployment rate, if you take the lowest wage quartile, the lowest wage quarter of the country, they're facing depression-era levels of unemployment, get this, at around 23%, something to really keep in mind with that K-shaped recovery. And there's also Fed Vice Chairman Richard Clarida set to speak later today. So a lot of Fed commentary coming this week, Zach Nikiko.
All right, Brian Chung bringing us the latest there as we listen to more from Fed Chair Jerome Powell. Appreciate that. As we're seeing all that play out, though, it does seem like the message from the Fed is at least resonating a little bit when you look at maybe some of the spreads in the bond market, particularly what we saw back in the 2009 crisis, looking at the spreads between the 3-month and the 3-year yields. Showing that this time around, people are listening to this idea of staying lower for longer. That spread now is only about 20 basis points, meaning the market's only maybe factoring in 1 rate hike over the next 3 years. So what does that mean for the market and your portfolio? Well, here to answer that with us is our next guest, Katie Kaminsky, Alpha Simplex portfolio manager and chief research strategist, joins us right now. And Katie, that's the messaging we're hearing from Fed Chair Powell, talking about being accommodative, really needing to stay there, not thinking about raising rates. What does that mean, though, in terms of maybe if he's not able to stick to that and if he catches the market perhaps by surprise here?
Yeah, this has been an interesting situation because, to be honest, bonds have been extremely boring for the last couple of months until a little bit recently. We've seen some of the lowest signals for bond trends since April last year. And we're just now starting to see a pivoting in direction with the steepening that we've seen recently. What's been very interesting today with the testimony, it sort of stepped back and said, everything's fine. But yet today we're also seeing new highs, or at least 1-year rolling highs in some of the yields in the longer term bonds in the US. And the reason why people are so concerned and why he's addressing this is the markets have said something different from what he's saying. If you look at price direction, the reflation trade that's happened since last year, it's sounding some alarms. People are asking questions. Why has this been such an incredible move? If you look at copper prices, they're the highest since 2011. Oil has been massively moving. So if that's the case, you're seeing sort of this steepening of the curve that's just short term. And we're wondering, could that continue at some point? We're sort of at a low point right now, but could this be the beginning of some more of a spread on the longer end, perhaps less so on the shorter end?
So, Katie, if there is this divide between how the Fed chair at least publicly sees it versus how the market's interpreting it, how do you view it? If we're looking at the 10-year right now, to your point, it's above 1.4%. We haven't seen those levels since February of last year.
Yes, we're seeing it as this is an indication that this reflation trade has bugged the market a little bit. And you're seeing that in the equity market as well, because there's a divergence between which equities are being affected by the recent turbulence. You look at the markets today, tech is down more, things with longer term growth oriented cash flows. If rates were going to eventually on the longer end be going up due to inflation or something that we're not really pricing in, this could affect growth companies and tech a little bit more. So rate sensitive industries, rate sensitive companies are definitely affected by this. We're actually seeing that bonds are at an inflection point, and we need to keep watching to see which direction this trend is going to go.
It does seem like, that has been the messaging, or maybe not the messaging, but the market sense for a little bit, right? We've been hearing from some of these market watchers. Goldman Sachs, I think, moved their expectations forward in terms of when we're going to see that first rate hike. So, I mean, it's been happening maybe on the back burner for a while, but what does it mean for the market? Because we're still pretty low. I mean, what's the level where maybe on the 10-year you'd start to see people think about shuffling some money from equities back over to treasuries?
Yeah, that's a good question. I think the level and the rates at which the Fed is either going to act on either direction are sort of up for question right now. I think it goes both directions. What's the level where they might need to intervene because yields have gone too high already? And the longer end is something that a lot of people are talking about. So, and then in the same sense, at what level of unemployment and what level would the Fed come in and say that we could actually consider raising rates? So right now, the indications are that they're not going to do anything for quite some time. The markets, I think perhaps the data point that's been the most fascinating to me is more just the relative moves recently, that longer term yields have been moving much more than the shorter end, which has less control by the Fed. And that to me is suggesting that the market and the Fed's short-term outlook could be different and that people are uncertain about the longer term versus the shorter term right now.
So, Katie, let's talk about how you're positioning yourself in the context of that. We've really seen the reopening trade pick up steam over the last several sessions. I'm looking at the airlines right now, all up in a big way in the session right now. How are you positioning yourself there? And is it too soon to get so excited about these names, especially sort of given the debt level, the balance sheet? The expectation seems to be that activity may pick up, but these companies certainly have a long road ahead to come back out and dig themselves out of the hole they were in as a result of the pandemic.
Yes, that's a good question. And what I would say is that we're seeing positive sentiment has been coming back in the last couple of days. There's been some turbulence, but all in all, there seems to be also some positive news. I mean, the Fed's commentary in some sense is very calming. You're also seeing some positive news about vaccines right now. Again, the Johnson & Johnson news today. And so there is some positive sentiment for some of these names that have sort of a long way to go, given what we've endured for the last year.
Okay, Katie Kaminsky, good to talk to you today, Alpha Simplex Portfolio Manager and Chief Research Strategist. Let's turn our attention to two stocks we are watching on the move right now. We're going to start with Lowe's here, trading lower even as home improvement and DIY projects continue to fuel sales in the more recent quarter. Same-store sales climbed 28%, while the company earned $1.33 a share on $20 billion in revenue. Online sales continuing to be the big story here, 121% growth in the quarter. But CFO David Denton warning home improvement sales are likely to decline this year as more people get the COVID-19 vaccine and spend less time at home, potentially why we are seeing that stock lower. Another name we're watching today, TJ Maxx, moving on earnings there. It is trading pretty flat right now. Closures stemming from COVID-19 restrictions continuing to create a drag on sales there. Open-only comp store sales down 3%. The company's home goods stores, the bright spot in the quarter, posting a 12% increase in sales, but that was offset by weakness in some of their other brands, as well as TJX Canada, the discount retailer, reporting net sales of $11 billion and said some of those temporary store closures dragged down fourth quarter sales by $950 million. Coming up, we're going to be turning our attention to the fight against COVID-19 and the very latest developments on the Johnson & Johnson vaccine with news out of the FDA. We'll be right back. Johnson & Johnson moving a step closer to getting approval for its COVID-19 vaccine. The FDA backing the drug maker's own study, which showed the single-dose vaccine was 66% effective. All of this is coming as we continue to see a rapid decline in COVID-19 deaths as well as cases. And we're really starting to see the impact of that in nursing homes that were really first in line for the vaccine. The latest data compiled by the COVID Tracking Project pointing to a dramatic decline in deaths linked to long-term care facilities. Let's bring in Dr. Tom Tsai. He is a senior fellow at the Harvard Global Health Institute. Dr. Tsai, it's good to talk to you today. Let's start with the developments on the Johnson & Johnson vaccine. This is pretty much confirming what the company has already said about its vaccine. But as we move a step closer to getting the green light for a single dose vaccine, how significantly do you think that will ramp up the rate of vaccinations right now?
Kiko, thank you for having me on. I think the news from the Johnson & Johnson FDA today is really excellent news and very encouraging news. Overall, we're above our 50% goal in terms of meeting that national vaccination target of over 100 million vaccinations by the end of April that the Biden administration has set out. Now, with a third vaccine available, it will only increase the likelihood that we'll be able to meet that goal and really be able to suppress the pandemic as we go into the summer. The efficacy is pretty good for the J&J vaccine, at about 66% overall, but in the United States, about 72%. Keep in mind, before the excellent news from Moderna and Pfizer, most studies were estimating around a approval for a vaccine that was about 70% effective. So I think we are just recalibrating to just the really excellent initial results from Pfizer and Moderna, and the Johnson & Johnson vaccine is not just adequate, but more importantly, it can help truly prevent severe cases of COVID-19, prevent hospitalizations and deaths, which are in this phase are the most important metrics to consider.
Yeah, that's important to tease that out when we're talking about efficacy on the vaccine front. It's also interesting to kind of couch this as vaccine race versus cases race, but also the variants that we've been watching as well. And I know your guys' department has been looking at a new variant in California. There's that one, as well as the UK variant, South Africa. There's a lot out there. So how important is the race to get the vaccine out to prevent some of those variants that could even be down the road from happening in the first place? What are you seeing on the variant front?
It's incredibly important, Zach. The vaccinations are a key part of the strategy. And while they may have slightly reduced effectiveness with some of the newer variants, they are still overall very effective in producing the severe complications such as hospitalizations and deaths. So first and foremost, the vaccination strategy, rolling that out widely is important regardless of the variants. The other part is that we've been seeing cases go down across the United States, hospitalizations go down. We're seeing our deaths go down as well. And all this is very encouraging. And the other part is that we've been focusing on not just widespread masking across our communities, but also better masking and better ventilation. So all these mitigation measures that had been working for the last year, they can still work with the new variants. So that layered strategy that's been a big public health focus over the last year still remains critically important. Just that we have now an even more powerful tool with the vaccines available. So this is a time to really keep the foot in the pedal and continue to accelerate our public health interventions, our adherence to masking, including better masking, double masking, or even N95 respirator masks if they're available. Continued vigilance around, maintaining good, physical distancing, good ventilation indoors, and then couple that with a widespread vaccine rollout. But the vaccination news today is very encouraging. It's a newer modality that requires a single dose, and I'm very enthusiastic that by the pace of the vaccine rollout that we've seen over the last several weeks.
We saw a lot of resistance initially in vaccines and long-term care facilities when you compare it to how quickly things moved along in hospitals. And yet this new data that we just pointed to out from the COVID Tracking Project seems to suggest that we have seen the rate of deaths from COVID-19 in these nursing homes down at a very dramatic rate. What does that tell you about the timeline with which we're likely to reach herd immunity. I know we're talking just one sector here, but there was so much focus there largely because of the elderly as well as the outbreaks that we saw in the early days of the pandemic.
Yeah, Kiko, I think part of the concern early on was that with the initial focus on healthcare settings, there was actually a slight delay in ramping up the pharmacy partnerships with vaccinations to the long-term care facilities. However, really over the last month, we've seen the vaccination rates increase significantly in long-term care facilities. So now over 6.6 million vaccinations have occurred in long-term care facilities. And that's not just for the residents, but also importantly for the nursing home staff that work there. So initially the rates there were a little bit lower, but we're seeing those rates start to increase as well. So that two-pronged approach of focusing vaccinations on the residents in the congregate settings and long-term facilities, as well as the staff who work there, and then potentially can transmit the virus from a community back into those long-term care facilities. Breaking that chain of transmission with the vaccines is incredibly important, and we're making a really good progress in that front. So I think that is a strategy that will continue to play an important role, and it's encouraging to see that number start to change, not just from vaccinations. We see that from a real meaningful outcome for individuals, which is seeing the cases go down and the deaths go down.
Dr. Tsai, real quick before we let you go, we had a guest on yesterday talking about the push and the importance of getting vaccines out to the developing world as well to prevent more variants from coming, and the costs that could come with more lockdowns around that if that variant were to spread around the world. How important does the J&J vaccine maybe play a part in that, considering the cold chain, and how real is that risk for the U.S. and other developed countries out there too?
Yeah, I'll answer that second question first, which is that it really is a real risk. And you've learned over the course of this year that no country is an island from the sense of being able to truly protect yourself from the transmission of new variants, and especially as travel is increasing with air travel, that global perspective as opposed to just a national perspective is important to consider. So this is a global fight against a pandemic, not just country by country. And the global vaccination strategy also has to follow in place. Initially, it was concerns because of the cold chain requirements for Pfizer and Moderna, that there'd be limited applications to lower resource settings, and the Johnson & Johnson vaccines, and including some of the other ones on the pipeline that don't require the cold chain, the very cold freezers, or even being single dose, being easier to administer. All these are important factors that will increase the supply to other countries around the world. And the WHO collaborative around COVAX and the plans by many developed countries to allocate a portion to the rest of the world is incredibly important.
Absolutely. All right. We'll leave that there. Dr. Tom Tsai, Senior Fellow at the Harvard Global Health Institute. Appreciate you coming on here to chat with us today. We're going to take a quick break here on Yahoo Finance Live, but when we return, breaking down expectations for DoorDash in their first opportunity to report financial results as a publicly traded company. We'll spotlight what the street is expecting right after this. Welcome back to Yahoo Finance Live. We are spotlighting DoorDash shares here today as the company is set to report its first earnings report as a publicly traded company. The stock is off slightly since its IPO back in December. It's up today. So what should we expect when they deliver their update? Here to break that down for us is Stephen Fox, Fox Advisors founder and CEO. And Stephen, you say a beat's achievable. It's interesting because the street's predicting 215% growth year over year. That's what happens when a lot of people are ordering food here in the pandemic. But talk to me about what you're expecting to hear when they report.
Yeah, thanks for having me. We've ordered a lot of food as well, so we expect going forward that 215% growth is sort of in the rearview mirror. I think the key number is actually how they do sequentially. So we're modeling up about 7% quarter over quarter, and if you think about what's happened with the pandemic, we think that's a reasonable expectation, and probably, given some of the lockdowns you've seen in the U.S., beatable.
The question is really how much of that momentum can be sustained as we get more people getting vaccinated, as people start to go out more and more. What do you anticipate on that front? Do you think the concerns around that momentum are overblown, or could we see a significant pullback in activity?
So I think consensus is expecting that momentum slows. It's just a matter of what degree you expect it to slow to. So if you look out to next year's numbers, the year over year growth is somewhere in the 30% range, depending on how you look at it. More importantly, I think, are going to be how they manage that growth. So, for example, are they going to invest more, and what are the unit economics going to look like? I think one of the biggest surprises out of the box for DoorDash is how profitable that they've been able to be while growing so fast. So as growth slows, what does that mean for EBITDA margins, conversion margins, et cetera?
That's a very good point. And I think, people might overlook the fact that their tech has gotten better too, kind of prompting people to add things on to the orders that they've already made. You also point to Grubhub notching their strength in cities. That's something that DoorDash has always kind of differed on, and maybe focusing on more smaller cities, shall we say, in the suburbs. Talk to me about maybe how that growth might play into this first update we get from them.
Yeah, so there's a lot of layers to peel on that onion. So first of all, if you think in terms of adding more restaurants, adding more merchants, the company, when they went IPO, had about 390,000 merchants on their network. They are providing different types of services for those merchants. They're providing different type of AI and ML that they're continuing to improve on to not just help the merchants, but also help their couriers drive better earnings. You got to remember that this company employs more than 600 engineers that are focused on improving things like courier earnings, network liquidity, helping the restaurants with their websites, and restaurants that don't want to use the DoorDash couriers. They're providing services for them as well. So there's a lot of things that they're doing in order to improve their business model.
Steve, what do you see as the new revenue drivers for the company? We're talking about food delivery right now, but to the point you make in your note, there's a lot of investor questions around how DoorDash can leverage the network it already has to get into other avenues of delivery. You talk about pharmaceuticals, flowers, groceries. What do you think are the most likely channels, at least if you talk about this fiscal year?
Yeah, so I think there's a couple of things in there. It's important to remember when you look at their business, there's a few key headlines we're going to be looking for. One is going to be around subscriptions. Another is going to be around unit economics. A third is going to be around merchant expansion, and the last is around investment plans. On the investment plan side, that goes to your question, which is one, how have they grown their subscriptions? How are they incentivizing their 18 million plus consumers to take a subscription model, which has a pretty attractive payback period for DoorDash going forward? And then to your other point, how are they going to expand beyond food delivery? And they've made some initiatives around groceries. Obviously, that's a huge TAM to go after. Pharmacies and florists are also going to be as well. And the other thing that's interesting is 99% of their sales are still in the U.S. They have some initiatives already in Canada and Australia. There's been some news reports that they may be interested in going into Japan. Going into these geographies on a greenfield basis is going to cost some money. So how they plan to expand geographically beyond the U.S. is going to be important as well.
Yeah, and the one update too we got kind of new heading into this report a little bit ago was their investment in a food robotics company, one that we spotlighted here on the show, Chowbotics. Talk to me about maybe that, because that would be different than the delivery model. You got machines out there basically pumping out food. That's a totally different entry point for DoorDash.
Yeah, so similar to how you would look at autonomous vehicles going on to the rideshare networks for Uber and Lyft, I think you should think about robotics as sort of providing maybe, less than 10% of deliveries in the future. It's going to go after specific purpose type of delivery where where they can best leverage that investment. It's not going to all of a sudden in 5 years be robots delivering all their food, but there's a lot of opportunities to automate and at the same time still make their couriers more profitable by taking away less profitable routes for them. So I think it's something to watch. It's interesting to talk about. The investments there I don't think are going to move the needle for me and you when we look at the company, but they clearly want to invest in this area going forward, and it makes sense.
Okay, we'll be watching when the company reports after the bell on Thursday. Stephen Fox, Fox Advisors founder and CEO. It's good to talk to you today. And a programming note, we will be speaking to the CFO of DoorDash, Prabir Darkar, joining us this Friday after reporting on Thursday. That's at 11 a.m. Eastern, right here on Yahoo Finance. Coming up, President Biden meeting with Republican and Democratic lawmakers to address the global chip shortage. We'll dig deeper into the White House plan to address some of the vulnerabilities we've seen play out in the supply chains. We'll be right back. President Biden is set to sign an executive order this afternoon to address a global chip shortage that is hampering manufacturing in everything from cars to game consoles. Let's bring in Jessica Smith, who's been following this story for us out of Washington. And Jess, it sounds like the initial action is really about reviewing the vulnerabilities in the supply chain, but the long-term goal is really to bring manufacturing back to the U.S.
Right. And the chip shortage is really the urgent need that
the administration is trying to address right now, but it does look beyond that, and it looks at other goods that, if there is a shortage, that could pose an economic or a national security risk. You'll remember at the start of the pandemic, we saw those shortages of PPE. Those are the issues that the administration says it's trying to avoid. So the administration today is calling for a 100-day review of supply chains for semiconductors, rare earths, pharmaceuticals, and large capacity batteries. The executive order will also call for a more in-depth review of 6 different sectors. That's defense, public health, information technology, transportation, energy, and food production. So the goal with all of these reviews is to find potential problems and then take steps to get ahead of them or to solve those problems. Lawmakers over the past few years have really been highlighting the issue of the U.S. becoming too dependent on countries like China for critical goods. Just yesterday, Majority Leader Chuck Schumer said he's directing the chairs of the various Senate committees to come up with a bipartisan bill that will help the U.S. outcompete China. He specifically said this would protect the U.S. supply chain, calling out the chip shortage. He also said that he wants to help the U.S. get ahead on things like 5G and AI. Let's watch.
Enhance American competitiveness with China by investing in American innovation, American workers, American manufacturing. Invest in strategic partners and alliances, NATO, Southeast Asia, and India, and expose, curb, and end once and for all China's predatory practices, which have hurt so many American jobs.
Schumer says he wants this bill to pass at some point this spring. And President Biden is talking to lawmakers about all of this today. He is meeting with lawmakers about the supply chain issues at 2 o'clock, and then he's expected to sign that executive order at 4:15. Zach Nikiko.
All right, Jessica Smith bringing us the latest there on the chips front in Washington, D.C. Appreciate that. Well, from chips to Crocs, coming up, we're going to be chatting with the CEO of Crocs as that company posts record revenue as demand for those clogs continues to soar with celebrity partnerships. We'll break all that down right after this. Stay with us. Welcome back to Yahoo Finance. We are keeping our eyes on shares of Crocs. That company delivering a top and bottom line beat, but shares are in the red here slightly. The clog/sandal company reported a record of $411.5 million in revenue, up more than 56%. That was a record, as I said. Crocs said it expects revenue to rise 40 to 50% in the first quarter and between 20 to 25% for the full year. The stock has more than doubled over the last year. So for more on the future of Crocs, I want to bring on that company's CEO, Andrew Reese, joins us now. And Andrew, congrats on hitting that record. I guess a lot of questions around what's driving the demand here for Crocs, because as we've highlighted on the show a few times, they're comfortable shoes, but some people might say that might be tied to the pandemic. What are you seeing in where this demand is coming from?
Yeah, great question. Thank you, Zach. I would say, look, I think our demand is coming from a fundamental repositioning of the brand and the company. We've been at that for about 5 years now, and we've really started to see traction. Frankly, we were seeing traction ahead of the pandemic. We had a great 2019. And then I think the pandemic hasn't hurt, right? So we did a lot of things during 2020, appealing to frontline healthcare workers. We donated over 860,000 pairs of shoes to that community. That was extremely well received. We've also done a lot in terms of sort of broader philanthropic efforts, raising money for Feeding America, et cetera. But importantly, I think what's happened a little bit in the pandemic, casualization has increased. Digitalization has increased, and we're really well positioned for digital consumption. And people are really loving what we're offering them. So we're very optimistic about the future. And as you referenced in your intro there, have guided to between 40 and 50% growth in the first quarter.
When you talk about a fundamental repositioning in the brand, you've also really sort of pursued these high-profile partnerships with celebrities. Zach just alluding to the partnership you have with Post Malone, but how has that allowed you to expand the demographic that you reach? I imagine that is much more of a play for a younger consumer who you hope to keep on board with the Crocs brand.
Yeah, I think, look, collaborations, and we've done a lot of them. You highlight Post Malone, but last year that also included Justin Bieber, included KFC. So we collaborate with a very broad variety of individuals and brands, and that allows us to appeal to a broad variety of consumers. One of the great things about Crocs is our audience is extremely broad. It could be teenagers, it could be mums and dads, it could be kids, and we use our collaborations as a way of engaging all of those different audience members and bringing them into the brand and exciting them about what we're offering. And it's been incredibly effective. And, I think it's also a tool and a mechanism that will last, right? So we've got a lot of opportunities to continue to do that. And we have an incredible lineup of collaborations for this year.
Yeah, on the demographic front, it does seem like teenagers seem to be playing a rather important piece of the Crocs brand here. I'd be remiss if I didn't highlight gibbets, those things that you can pop into the holes in Crocs to really personalize them. And I don't know a lot of older people who might be doing that to personalize their shoes out there. Maybe I'm wrong. But is that really where you're seeing the acceleration right now? Is that younger Gen Z on top of millennials? Talk to me about that.
Yeah, absolutely. So that just absolutely helped. And sorry, I didn't address that in the last question. But yes, I think we've really managed to engage that younger millennial Gen Z consumer. And you're right, they are a really important consumer base. They consume a lot themselves, but they also influence a lot of people, right? They have incredible social media presence. They influence people. They influence their parents, their siblings, et cetera. So we've engaged them. They're coming into the brand in a significant way. They do love gibbets. They do love personalization. So behind gibbets is that kind of global mega trend of personalization. They absolutely love it. And so we've really brought them into the brand. And importantly, as we increasingly emphasize our sandal business, we have new introductions both last year and this year. This is a two-strap sandal, which is actually introduced next month, but that is also gibbetable. So we're extending the element of personalization into sandals, which we think will be incredibly well received.
I like that term, gibbetable. Andrew, let me ask you about a conversation we were having before the break, which is this discussion around bringing supply chains back closer to home. And this is something we have heard from so many different companies across sectors. The lesson learned from the pandemic is that you want manufacturing closer to home. You operate internationally. You've got production lines in about, half a dozen countries. How are you looking at the mix right now, given what played out over the last year?
Yeah, that is a really good question, and we're looking pretty hard at that, right? So, the majority of our production today is really Vietnam, so that's a long way from this market, right? But also, we do have a very big business in Asia as well, so it's obviously much closer to that market. We use also production in Bosnia and Mexico and other places to be closer to market. And as we go forward, I think you'll see us and probably most other companies continue to evolve our manufacturing footprint to balance cost with certainty of supply and also being closer to market and be able to move faster. One thing we do see, the consumer environment moves faster and faster kind of every year, and ability to react to that is rewarded. So if we can react faster, we're confident we'll get rewarded for that.
Well, I can attest to the comfort of your shoes. As somebody who owns a pair of Crocs, I will admit to it. Zach, maybe getting on board with the brand too. Andrew Reese, CEO of Crocs. It's good to talk to you. Appreciate your time today.
Great, thank you.
We've got much more coming up here on Yahoo Finance Live. On the other side of the break, we're going to talk about the big moves in the EV space. We'll be right back. Welcome back to Yahoo Finance Live. The Nasdaq turning positive in the session after being dragged down by some of those big tech names. Right now, up about 0.3%, while the Dow hitting a high in the session, up 240 points. Let's bring in Inez Ferre, who's tracking the very latest on that front, as well as the EV space. Inez.
That's right, Akiko. And just taking a look at our NASDAQ board right now, NASDAQ 100, we're seeing that Tesla is up more than 4%. Tesla, which had been losing over the last several sessions, today in green territory. Part of this has to do also with the move in Bitcoin being a little bit higher today. It's below $50,000 per coin. But nevertheless, just looking at some of the NASDAQ players, we are seeing that some of the big cap names are still a little bit under pressure. You're still seeing a bit of sell-off when it comes to tech. But as you mentioned, we are looking at the EV space. Workhorse down 10%. Over the last 2 days, this stock is down 50%. This is because the company failed to win a USPS contract for next generation vehicles. Oshkosh is the one that got that contract, and Oshkosh over the last 2 days up more than 13%. Today, we're seeing gains of more than 6%. We also are watching Fisker, another electric vehicle company, of more than 24% after signing a deal with Foxconn, that's the Apple supplier, to make some 250,000 vehicles annually. So that deal sending this stock higher. And then just taking a look at the Dow, because the Dow earlier touched new intraday highs. We are seeing that Chevron energy stocks are in the green today. Chevron up more than 3%. We've got industrials that are leading higher, Boeing up more than 5%. We do have this laggard Home Depot down more than 4%. Home Depot yesterday was also down. Lowe's beat on the top and the bottom line today. Strong same-store sales, but still the company warning about margin headwinds. Zach, Akiko?
Yeah, the DIY home improvement boom continuing, at least according to Lowe's latest numbers. Thanks so much for that, Inez. We've got much more coming up in the next hour of Yahoo Finance Live, including a conversation with the CEO of Intuit, the company out with its earnings reports today. And we are seeing a big pop in the stock, up nearly 3% in this session. We'll be right back. Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman, and we are seeing all three major indices now in the green. The NASDAQ turning positive now in the session, up about 42 points. The Dow hitting another record, up 245, and the S&P 500 up 23. We saw earlier in the session, big tech continuing to drag down the broader markets lower. Apple, Microsoft, Amazon, Facebook, all trading in the red. Rising rates also rattling investors. The yield on the 10-year Treasury topping 1.4% in the session. That is the highest level we have seen since February of last year. And Bitcoin staging a comeback, if we can call it that. Bitcoin bulls adding to their positions with the cryptocurrency still trading below that $50,000 level, but crawling back. And we also have sportswear, Columbia Sportswear looking ahead to a bounce back in the second half of the year. We're going to get a snapshot of the apparel and footwear company with the CEO of Columbia, Tim Boyle. He'll be joining us later this hour. We begin, though, in Washington with House lawmakers getting ready to pass the COVID-19 relief bill this week. Let's bring in Yahoo Finance's Jessica Smith again, who spoke to one of the bill's architects and joins us from Washington. Jess.
Yeah, Kiko, I talked to the House Ways and Means Committee Chairman Richard Neal. His committee put together the pieces of the bill that have to do with stimulus checks, the expanded child tax credit, and unemployment benefits. And there are some differences between what Neal put together and what his counterpart in the Senate, Finance Committee Chairman Ron Wyden, want to see. The current bill phases out those benefits. It ends those enhanced unemployment benefits at the end of August. Wyden wants to see them last through September, as President Biden originally proposed. So I asked Neal if he'd be open to extending those benefits. Here's what he had to say.
I think that we have to adhere to the rules of reconciliation. And I think that what the Ways and Means Committee put out and actually implemented in the CARES Act is the good mirror image that we want to create going forward. So I'm always open to the idea of improved legislation, but I think that what we did in the plan that came from the committee is pretty remarkable.
I know Senator Wyden raised the concern that they could expire in the middle of August recess, and so you have a cliff at a really bad time. What do you say to that thought process?
Well, I think that those are reasonable concerns, and if they can be addressed, we should. And at the same time, recall that I think there's a bit of a safety valve that's built into the legislation because some of the funds in other categories have not been fully expended. And recall that when we wrote the CARES Act, we were trying to buy time. And when you consider that what we did in December with the $905 billion package, some of that is yet to make its way into the economic system. So I think that I could be moved based upon a pretty accurate assessment, but I also think that it's important for us, once we copper fasten this legislation, to go forward with it.
Would you be open to considering automatic triggers at some point for those enhanced benefits to avoid these cliffs that we see every little bit?
Challenge there is always one of the challenges you have in legislative life, and that is to make sure that you don't overdo it and to make sure that you don't underdo it. I think the nature of unemployment right now, given the pandemic, is considerably different than what we would believe to be conventional, largely because I think there are a lot of people on the sidelines that are itching to get back to work. And I think as the economy quickly improves this summer, that's likely to happen. I mean, most of us who follow this, when you consider that credit card debt has been paid down, that people have set aside some of this emergency money for savings. And I think as people make their way into the workforce, again, considering labor participation rates ought to be what drives the decision making. So I'm open to talking about them. I don't know that right now, given we're on the precipice of getting this legislation done, we should do it.
So Neal isn't exactly against extending those benefits, but the question is if it is actually doable. Now, the House is planning to vote on this bill on Friday, and CEOs are encouraging Congress to get this done. Today, more than 150 CEOs wrote a letter to congressional leaders calling on them to pass a relief bill modeled after President Biden's plan. You can see here the CEOs of Google, Goldman, Lyft, Blackstone, Wells Fargo, and many others were on the list. The letter said that previous relief packages were essential, but more is needed for a durable and strong recovery. Akiko.
Okay, that bill getting the big thumbs up there. We'll see if how it moves forward later this week. Let's turn our attention now to shares of Intuit, because we are seeing a big pop in the session, off of its session highs, but still well above 2%. The company falling short of some Wall Street estimates in the most recent quarter, though. The company behind TurboTax and QuickBooks reporting net income of $235 million, or 68 cents a share. Revenue was down 7% to $1.6 billion. Let's bring in the CEO of Intuit, Sasan Goodarzi. We've also got Yahoo Finance's Brian Sozzi joining in on the conversation. Sasan, it's good to talk to you. Clearly, as a company, you're not where you want to be when you compare it to where things were pre-pandemic, but it does feel like you've got some momentum going, especially in the small business and self-employed group. Walk me through how you would characterize this most recent quarter and the outlook ahead.
Sure. Well, good morning. Thank you so much for having me. I'm actually quite proud of the performance of the whole team. You know, in the small business and self-employed group, we actually grew double digits, 11%. Our online ecosystem actually grew 22%, and Credit Karma is off to the races and performed very strong. And within tax, we are seeing very encouraging early results. The reason we were down 7% for the quarter is because the IRS opening shifted to February the 12th. So a lot of our revenue shifted to the third quarter. It's actually why our revenue guidance for the third quarter is to grow between 53 to 55%. And so when you normalize the quarters, and then when you look at our year, we've guided that we'll grow between 15 to 17%. So on the high end, about 9 billion by the end of the year. So we're excited about the possibilities. More importantly, we're excited about our innovation and delivering for customers. Sasan, take us through how you are seeing the state of small businesses. You said a stunning stat on the earnings call last night. About 25% of your business or your small business customers have 50% less cash in their bank accounts. Are you seeing any recovery in this customer base? Yeah, thank you for giving me the opportunity just to talk about how much we collectively need to help small businesses. First of all, their performance is different depending on the state that they're in and the industry that they're in. If I just use United States as an example, so, for instance, states like Florida, Texas, Arizona, Georgia are recovering much faster than states like California, New York, and Michigan. And then if you double click on that, the industry matters. The industries that I think it will sound obvious that are just continuing to fall behind are education, fitness, restaurants. They're really struggling to get back to where they were. So we see that within our base. And then if you double click again, the stat that you just shared is very real. And we represent the small businesses around the globe and the United States. And 25% of those in our base, their net deposits is down 50% year over year. So although there has been recovery, we're better off today than we were in March of last year. We're really nowhere near where we need to be to help small businesses be at the level of performance that they expect of themselves. Who is better off, Sasan? Last year, we had, 8 million people open brokerage accounts for the first time. Has that really the democratization of the markets, are you seeing that play out in a lift in your tax business this year? Yeah, we are. Several years ago, we declared both transforming the assisted segment with our TurboTax Live, which is in essence enabling any customer at a click of a button to have an expert come to their phone to help them get their taxes done, or actually give us all their documents so we can get their taxes done for them. Within that, the investment community, self-employed and Latinx are under-penetrated segments that we declared and focused on. And we're actually starting to see the benefit of that, to your good question around the rise in retail investors. In fact, we're seeing a huge rise in the US, in India and Brazil. Although we don't serve consumers in India and Brazil, we have small businesses that we serve, and we're seeing an incredible increase. And our offering within TurboTax Live is actually benefiting from the rise of retail investors. And so we'll see how the season plays out, but we're excited that it was a declaration for us a few years ago, because now our offering is robust to help them get their taxes done.
Yeah, and Sasan, I mean, it's a crown jewel of brands really in the financial software space. You got TurboTax, QuickBooks, Credit Karma, and Mint. Mint, the last one, in my opinion, doesn't really get talked about enough in terms of helping people manage their personal finances. But when it comes to TurboTax and what you're going to see today, how big of a piece is that brand playing a role in guiding to 15 to 17% growth for the full year? Because how complicated tax season might be for Americans, or how important it is in this environment.
And it's playing a very important role. But I would share with you that all of our offerings and our platforms are playing a role. Credit Karma is out of the gate strong, and that contributes to the guidance that we provided. The QuickBooks platform is playing a very important role, and as is TurboTax, and particularly TurboTax Live. There's about 86 million out of the 160 million filers in the United States that have somebody else help them do their taxes, and it's about a $20 billion opportunity for us, which is why with the TurboTax platform now in our 4th year, the expertise comes to you wherever you are, whenever you want it, and really helps you get your taxes done with confidence. And I think the only thing I would add is now with Credit Karma, we can go beyond taxes to really help make ends meet, help you get out of debt, and help you save money with products like credit cards that are personalized for you, home and auto insurance and loans, and free checking and savings accounts that help you really manage your financial life. So we're really excited about bringing our platform together, singularly focused on helping consumers with financial freedom.
Adding to Zach's point there, no question you're going to see an uptick as we get closer to tax day, but we've been having a lot of conversations on the show around the complications of tax filings this year, whether it has to do with enhanced unemployment benefits, whether it's about gig workers and how much money they need to set aside for the filings themselves. I wonder how you look at the education element of all of this, and does that provide some additional avenues for revenue when you look at the business model overall, and just how many people rely on your software?
Sure. I would touch on 2 aspects. One is we've been significantly investing in AI, particularly machine learning and knowledge engineering, to be able to turn all of these rules and nuances for each customers into very specific questions that they need to focus on. In addition to our technology investments, this is where our experts come in. We have experts on our platform that ultimately can see the power of AI. It delivers insights to them, and then they can more accurately help consumers with whether it's unemployment benefits, whether it's the investments that they've made in the last year, if they moved across states. All of those things, the combination of AI and the combination of expertise on our platform really is helping consumers answer the tough questions that they have and feel confident that they're getting their taxes done right and getting their maximum refund. So
Sasan, you actually just finished integrating Credit Karma into 26 million TurboTax returns. What type of products do you think will come out of that integration? Those are some pretty big numbers.
Yeah, so our ultimate goal is we want every consumer to be able to have the power of data in their hands, which means that you can get access to credit cards that are right for you. And specifically what that means is everybody gets access to credit cards, but the question is, do you get approved or not? And with all the data that we have, we want to make sure that you can hit a pre-approved button and you're done, you get the access to the credit card. We want to make sure you can get access to personal loans that are right for you, that you qualify. Same thing with auto and home loans and insurance. And so the number that you cited is there's a couple of things that we are doing. We're bringing the power of our data together to put it in the hands of the consumer. So we have about 3,000 tax attributes and financial attributes per consumer that we can leverage to, in essence, deliver personalized offerings that are right for them in their hands. We have like 55 million W-2s, 28 million 1099s. So we're bringing income data together with the credit history and spending history that Credit Karma has. They see $5.5 trillion of spend history over the data platform that they've created. So we're combining their data with our data, which is where that 26 million number that you mentioned comes in, to be able to deliver personalized experiences. And all that means is it's a win-win-win. It's a win for the consumer because they actually get access to what they need and they don't get declined. It's win for the partners on our platform because they ultimately are able to offer their products and get the performance that they're looking for. And it's a win for us because ultimately we'll be able to monetize over time. But we're really excited about moving beyond tax and having an app where you can truly help consumers achieve financial freedom by saving money and getting out of debt.
All right, Intuit CEO Sasan Goodarzi bringing us all that alongside Yahoo Finance's Brian Sozzi. Appreciate you taking the time here to chat with us today. Be well. We're going to take another quick break here on Yahoo Finance Live, but when we return, digging into the battle currently going on between TikTok and the American social media company Triller. Their CEO will join us on the other side of the break. Stay with us.
Hi, I'm Mike Liu. I'm the founder and CEO of Triller. I'm most excited about 2021 as we're building a large audience and tools that will help our creators build the best content.
Tell us where you are on the roadmap of Triller. You know, you have really conquered the music scene. You are dabbling in TV, in sports. You know, if you were to map it out right now, whereabout are you on the journey?
There's never been a better time to be a content creator than in 2020 and 2021. You just have to have your phone, have something to say, and there's an audience that you can find out there for you. And we're just getting started. I mean, for us, we see ourselves as a pretty young company that is often compared to a massive giant that's worth $180 billion. And we're just, keeping our heads down and trying to build great products for our users.
Yeah, of course, that company that you did not name is TikTok. You've been around since 2017. As you have seen last year, which a lot of it was shadowed by TikTok and the threat of a ban, right, from then President Donald Trump. Tell me how, in retrospect, that really buoyed Triller.
Sure. No, that's a great question. So for us, I'll use a very old Wayne Gretzky quote, which is we like to skate where the puck is going to be, right? And what we built from a product and a positioning perspective was, a platform that was similar to TikTok, but also very different in a lot of ways, which is why we attracted our own audience. So it was more of the world and our audience that really saw us as the successor of TikTok. And it was something that we were trying to build our own unique voice, but I think from a product position perspective, we were the closest than anyone else, right? It wasn't Facebook, it wasn't Snapchat, it wasn't Instagram. It was Triller, this very small, young company that, is grabbing that worldwide voice.
And then when it comes to the revenue side of things, can you give us a sort of an update on how much you were able to make in 2020 and even looking ahead for the rest of this year?
Sure. So, this is a little bit sensitive, but I'm happy to share that, for 2020, we actually did pro forma of over $100 million for 2020. And right now we're on track to make a minimum of 2x that this year. So again, if you think about our company, it's not just about a user base that's growing, it's being able to monetize a user base. That's ultimately what's most important for our company. And for a company that's never done it before and only a 3-year-old company, but we put together the Mike Tyson fight last year, which became the 8th largest pay-per-view fight in history, right? So that goes to show how well we can leverage our audience, and we hope to do that with more and more events, concerts, sports, live TV. And I think that's the future is very, very bright for us.
If you had to distill, in one sentence, who is the Triller user, how would you describe him or her, they?
The data shows the majority of our users are Gen Zs, right? Between the ages of 16 to about 26, I would say it's about 80%, 70% of our user base. But there's obviously like outliers from that. But from that perspective, what we're showcasing is even within that segment, there are people that are interested in things that traditionally maybe they weren't marketed to, right? Like the reason where the Jake Paul, he actually got more hits as a meme when he knocked out Nate Robinson than Tyson did, right? And that's attracting a new audience of younger boxers, right? And people who are training physically to accomplish something.
Yeah, and as you look ahead, you are expected to go public via SPAC in the coming months at a valuation, I think, has been reported between $3 billion and $6 billion. Can you speak to that potential exit that's in the works now?
So unfortunately, I cannot talk about that due to a lot of legal reasons. We are a company that is really primed for a potential public offering, given that we're generating revenue, given that we have tremendous growth, given that our closest competition is, even at those numbers, 50x in terms of valuation of what we are. So if I was an investor and I look at those metrics, right, company that's generating revenue, huge upside potential, would I want to invest in that company? And I think a lot of the investors will say yes.
If you were to define Triller in 2021 in a couple sentences, what are you most looking forward to with the company?
Yeah, we want to entertain you. We want to, find content that you're going to find really compelling. And we want the next superstar to come out of Triller, right? We want that the next Justin Bieber or the next Chris Brown to be discovered through Triller. That's our motto since day one.
So let's bring on Yahoo Finance's Melody Hom for more on her discussion there with Triller. And Melody, you got the first time we heard that out of him, a minimum of doubling revenue. It's interesting for a company at this stage to be doing that. What else stood out to you in that discussion?
Yeah, and I do need to point out, this was a long interview that we did condense, and he mentioned and addressed the concerns with Universal Music Group. Universal Music Group actually pulled all of their song catalog from Triller because they claimed that Triller did not pay for the rights and did not keep up with those payments. And there's an ongoing battle too, right? With them ginning up their user base. They claim that they have 50 million users, and it turns out it may be closer to 25 million. So all that to say, we have to take that revenue number with a grain of salt. They are not public yet. They have not actually filed any financial disclosures that will be necessary, right? When investors do hold them to that higher standard. I do have to point out that they have been really good at diversifying their portfolio mix, in order to expand beyond the TikTok kind of teeny bopper, lip syncing, dancing sort of era, which TikTok has also been able to do. Triller is going really heavy into boxing, into investing in shows like the D'Amelio family, J-Lo, really paying kind of top tier celebrities to create content here. We'll see how long that's sustainable though.
Okay, well, they face increasing competition in the space. Melody, appreciate you bringing us that interview today. Coming up, we're going to be talking about a bounce back in retail, specifically looking at Columbia Sportswear. We're seeing the stock up about 1% today. The CEO of the company, Tim Boyle, will join us after the break. Welcome back to Yahoo Finance Live. It has been a tough go for many retailers across the board as COVID-19 restrictions dramatically reduce in-store traffic. Columbia Sportswear saw sales drop 4% in the most recent quarter, with earnings off 14%. But the company forecasting a big bounce back, projecting 20% growth in sales for this year. And we are seeing the stock up more than 1% today in the session. Let's bring in the CEO of Columbia Sportswear, Tim Boyle. We've also got Brian Sozzi back in on the conversation. Tim, it's good to talk to you today. Give me a sense of where you are in this bounce back story. Certainly, it sounds like you think a lot of momentum is going to return in the second half of the year.
Well, you know, our company is comprised on the revenue side from our own direct-to-consumer business, both brick and mortar as well as e-com. But the bulk of the business, and historically the business, has been supported by wholesale sales globally. So in 2019, we had about 40% of our sales outside the U.S., and many of our markets are still in turmoil with COVID, but there's a number of markets that are open and quite robust. So when we look across the landscape, we see great opportunity for the outdoor business specifically. So we make stuff to go skiing and hiking and fishing, and those are the primary products that the company makes. And you know, during COVID, there are only a few things that you've been encouraged to do. One of them is outside activity. And so thank God we aren't making, you know, neckties and sport coats for work. And that's what supported our business. And that's where we see significant demand from consumers to be casual as well as performance outdoors. That's right, Tim. It's not a good time to be in the necktie business, even though I am wearing a new one right now. But how do your order books look like? What do they look like for spring and fall 2021? Well, you remember the business is an advance order system for retailers. So we concluded our order book sometime July, August of 2020, when things were still quite unsettled. And we're in the process of concluding our order book for fall 21. But frankly, we have a lot of orders on hand already. So formerly, prior to our growth of our own direct-to-consumer business, we would issue bookings reports on a very frequent basis, a couple times a year. And we understood that confused investors because our own retail stores, obviously, we report the revenue when that sale happens, and people were confused. So we spent a lot of time discussing our order book. Today, we just give very high-level guidance and say the business is so complex when you include the geographies, the categories, the channels. So we just give guidance at a very high level, and is a part of that guidance.
Yeah, and Tim, I mean, as an outdoor sportswear brand, you might have expected sales to not be down 4% in Q4, but you guys have quite a bit of cash on hand here, $791.9 million to be exact by the end of the year. You seem confident, though, as Akiko was talking about there. You not only approved a cash dividend, but also $400 million in share buybacks. I guess that sounds very confident, but is there a reason maybe to go that route rather than maybe investing in the supply chain? Talk to me about the decision there around how you're going to be using the cash.
Well, as you know, we're very fortunate to have such a strong balance sheet. Our board has been for years preaching fortress balance sheet, and frankly, when the pandemic hit in March of last year, or February, when other companies were contracting, we were able to really stay focused on what it is that we do, and with a high degree of confidence. So our business is going to continue to invest not only in supply chain efficiencies, and remember that we, like everybody else in the footwear and apparel business, utilize subcontract factories throughout Asia and Central America. So that doesn't require investment, but inventory management, order management, efficiencies all through the chain are really important, and we'll continue to invest there. As well as, consumers now are buying products and learning about products online. So we have to have a very robust and up-to-date system of not only taking orders, but explaining our sometimes quite complex products to consumers. And that's where we'll be making the bulk of our investments over the next several years. Tim, speaking of online, I was on your site this morning, and I sense there's a style shift underway on Columbia Sportswear. Maybe a repositioning a bit to more streetwear. Take us through that. How has the brand changed over the past year?
Well, we've always prided ourselves on our innovations and our performance as being points of differentiation. We talk always about there being plenty of apparel and footwear companies globally. Nobody needs another one. You better have a point of differentiation if you're going to be good at this, and you're going to be recognized. So we spend a lot of time on the performance aspects of the products, but at the end of the day, many of our consumers are buying the products to walk their dog or to maybe just to hang around in their house casually, be in their backyards, etc. So we have to have a point of differentiation, which for us is innovation. We talk about the insulations we use, the reflective fabrics on the inside, the sun deflector fabrics on the exterior. So we have a lot of complex product characteristics to talk about. But at the end of the day, many of our products are used for everyday use, and they have to be comfortable and look good.
Tim, you were very vocal of the previous administration and its China trade policy. You look at the new administration, President Biden has made it pretty clear he doesn't intend to have a drastic difference from the previous administration when it comes to the tariffs on Chinese goods coming in. What kind of headwinds does that create for you as you look to really build on the momentum from the economy opening up, and yet have to really look at the costs that are adding up from the tariffs?
Well, manufacturing products in Asia and distributing them globally requires an incredibly complex web of sources. So as it relates to merchandise coming into the U.S., what you're talking about, these tariffs, which don't exist outside the U.S., in other words, products coming from China going to Europe or other countries that don't have those kinds of prohibitive tariffs, we don't import very much merchandise from China into the U.S. It's a small percentage. The bulk of our production is spread around Asia, including Vietnam, Bangladesh, Indonesia, and other countries. So we have a quite broad sourcing base, but we have a big business and a big opportunity to sell our products in China. So additionally, the company's based in Oregon, which is primarily an agricultural part of the country, and frankly, a big market for our products that are grown here in Oregon is China. So we have to have a relationship with an enormously large market like China, which is going to be beneficial for really all of our citizens of the United States as well as the world. And we need to keep China close, in my opinion, to make sure that we work together on a number of projects, not the least of which would be the vaccine and COVID itself.
All right, Tim Boyle, Columbia Sportswear Company Chairman of the Board and CEO and President, alongside Yahoo Finance's Brian Sozzi. Appreciate you taking the time here to join us today. We're going to take another quick break here. On the other side, highlighting the SPAC boom, what that means for companies out there investing in some of the companies looking to go public, as well as a spotlight on a new company going public via SPAC. The CEO, the co-CEO and co-founder of Origin Materials working on carbon capture will join us after the break. Stay with us. Welcome back to Yahoo Finance Live. If there is a word so far to be crowned the word of 2021, I think SPACs might be that. At this point, I'm not sure I need to tell you what it stands for, but special purpose acquisition companies have been raising a lot of money out there, taking a lot of companies public. In fact, for the month of July, we saw the number of dollars raised by SPACs alone soaring 20 times to $24.26 billion. That was more than all of the money in SPACs in 2019. It's raising interesting questions about how that's impacting VCs out there who normally would have all of these startups basically to their own. And a lot of questions for what it means for retail investors out there, as well as opportunities to get into some of these companies a little bit earlier are now out there. Join us to discuss all that. With us is Bradley Tusk, Tusk Ventures founder and CEO. Bradley, appreciate you hopping on here to chat, man. I mean, it's interesting because these are new. I mean, not a lot of people had really even heard of SPACs before, I guess, halfway through 2020 when they started to take off. But talk to me about how it changes the way investors should be looking at some of these companies looking to go public.
Yeah, I mean, I think if you're a VC, like anything, there are kind of pros and cons to the SPAC boom, right? So a con could be that you might have now more competition in terms of who wants to invest in different startups. It's probably especially prevalent for growth equity venture capital investors, more so than early stage. But at the same time, I think, and I've had this conversation with my team, and I bet every other VC has too, which is, by definition, when you're a venture capitalist, 40% of your stuff is going to go to zero or pretty close to it, and you just accept that as a cost of doing business. And now all of a sudden you're like, look, there's so many SPACs chasing so few companies. Maybe all of a sudden these things that we just kind of assume we're going to go to zero now have a second life for them as a SPAC target. And so it also may be a way to get liquidity on things that you had already in your mind written off.
Bradley, I thought you had some interesting comments recently when you're talking about the competition that you referred to in this space. Give me a sense of how competitive it is behind the scenes. To your point, there are so many SPACs who are really targeting specific companies, and oftentimes these companies have their pick in terms of how they want to come to the market.
For sure. I mean, you hear all the time now when you talk to different startups, not just that they've heard from one SPAC, but they've heard from 3 or 4 or 5. And it actually gets to, I think, kind of the key point of all of this, which is if you raise a SPAC and you then have real strategic value to the company that you want to do the acquisition or merger with, then it makes a lot of sense, right? If you can give them something that they need, access to a new market, new types of expertise, new types of products, whatever it is, then all of a sudden, you're an attractive partner for them. If all you have to throw at them is money, and there's all these SPACs now that got raised simply because someone else raised one, so people just kept doing it, and you have nothing to offer other than that your money is green, I think you're either going to not get something or you're going to overpay. And in either situation, you risk the SPAC not being approved and losing the money you put in.
Yeah, when we talk about risks, it's interesting because a lot of people would point at this being a risk by itself of all this money pouring into SPACs right now. And they can look at it and they look at the graph and they say, generally that trend would point out or stand out to us as maybe alarming. And then other people might point out that it's an easier route to trade publicly, might not have to go through the same process to check all the facts and figures. How alarming is it actually, though, when you step back? Maybe retail investors now having access to this that might not be as nuanced in that relative to normal VCs.
Yeah, I mean, look, overall, I think it's not super alarming to me. Here are the two kind of risks out there. Risk number one is SPACs are raised and then they can't find the right company to combine with, or the valuation they have to provide in order to do the deal is so high that the original SPAC investors reject it. In that case, the people who ran the SPAC lose the money they put into the deal, but the retail investors and everyone else gets their money back. That's part of the attractiveness of SPACs in the first place. So there's risk, but it's really mainly to sophisticated parties who should be knowing what they're getting into. The second area would be you're just going to see a lot more companies now become public companies, and there's at least a concern that some of those are brought to market prematurely, or the standards for which it takes to become a public company will go down. And as a result, people who then invest in that company may long-term lose money. simply because it's not as vetted or as strong as other things that are out there. So, look, that's certainly a risk. But with that said, if you're going to invest in any sort of public equity, you're holding that risk, and you've got to do your homework and your diligence, and you better have a good reason for anything you do.
How do you think this shifts the game for VCs then? I mean, you understand both sides of the coin as somebody who invests on the private side, but also helps companies go public. I imagine you've got a lot of portfolio companies who are looking at just the boom saying, well, maybe we can think about our exit. We can think about going public 5 years sooner than we thought we could.
Yeah, well, look, it's two things. Some of them companies say that we can go public sooner, or, hey, here's a solution because we're not getting the interest we need from VCs in later funding rounds. Or the other thing is, and I'm sure every VC has sort of a similar story of how do you politely email, text, call up your portfolio companies and be like, have you ever considered a SPAC? Because when you're saying that in a way, you're probably saying, we're not super confident in your ability otherwise to take this all the way through. This seems to be an easier path. Why don't you pursue that? So I think you've got to approach it in the right way. But there are definitely founders getting calls like that from their current investors. And then there are also founders who are saying, I can get liquidity and move my timeline up by 2 years, 5 years, whatever it is, and it makes sense for them.
Yeah, I'm sure some very awkward conversations might be happening here as we see maybe companies going this route, but always interesting to get your take. Bradley Tusk Ventures founder and CEO, thanks again for joining us on that. I want to put that discussion into practice here because no doubt there are a lot of companies who are going public via SPACs. The latest one here on our show is carbon negative products maker Origin Materials, going public through a SPAC with Ardius Acquisition to value the combined entity at nearly $2 billion. Origin makes carbon negative feed materials out of wood residue on their goal to replace fossil-based materials in a wide range of goods. Joining us right now is the CEO, co-CEO and co-founder of Origin Materials. John Bissell joins us right now. John, thanks for taking the time. A lot to get into, not just the idea of going public via SPAC, but also what your company does, which is pretty interesting in trying to capture carbon and go in that direction. I guess we'll start with what you do, just because to me it stands out rather than some of these boring companies going through SPAC. We'll start there. Talk to me about what Origin's trying to accomplish.
Yeah, sure. So we really see ourselves as a mission-focused company that has developed technology to enable the world's transition to sustainable materials. And what we do is, as you described, we take lignocellulosic or wood inputs, we convert those into the building blocks that can be used to make all sorts of different materials and chemicals. We're using non-food sources, hence the wood. And that gives us a low carbon footprint. It gives us a strong cost advantage, which is important in all businesses, but particularly in materials and chemicals. And the products that we're starting with is really, we're starting with PET, right? So PET is an interesting material because it's a high quality product. It's used in all sorts of goods, packaging, textiles, right? Apparel. And what's interesting about PET is it already has one of the best end of life answers when it comes to materials. It's recycled. It's one of the most highly recycled materials that we use as a species. And so being able to take such a high quality material that can be recycled so effectively and making it carbon negative really felt like a win-win.
So building off our discussion on SPACs, I mean, you're talking about that PET plastic, which I think you started developing there with your partnership with Nestle, right? I mean, talking about a plastic water bottle that was a little bit better for the environment. But this round or this kind of deal to go public via SPAC also came with a private investment of $200 million from a partner of companies, a spattering of companies, including Nestle and PepsiCo. So talk to me about the decision to go public via SPAC. What made you want to do this now, since it sounds like you had those partnerships in place that could have had you guys growing for a bit more on the private side?
Yeah, I mean, I think that from our perspective, there are a couple of different advantages to SPACs, right? And this is comparing it to either a typical IPO or raising capital in the private markets. With a SPAC, you get first of all, there's the typical things: access to high certainty of close, relative speed. The public markets have lower cost of capital, generally speaking, than the private market. So that's attractive for a capital intensive business like ours, right? We need to actually put a bunch of steel on the ground in order to produce the products that we sell to our customers. And so those are all attractive things. But I think the other really interesting part of and perhaps adding on to the conversation you were just having, the other interesting aspect that we experienced was our process put us in front of a lot of really, really sophisticated investors. And that was important for us, right? In our business, which is a technology-heavy manufacturing business, you really want to have very sophisticated investors investing in each round, and you saw that a little bit with the pipe, right? You saw some of the most sophisticated investors on the planet really were investing in the pipe, and so the SPAC gave us the ability to talk to a wide variety of those kinds of sophisticated investors instead of it being driven by just a single conversation or something along those lines.
John, it really does feel like there are so many companies who are scrambling to get ahead of regulation as they see tier of talks of a carbon tax, further disclosure rules. I'm wondering how that has led to an uptick in activity for your company. How significant has that been?
Yeah, it's been an incredible sort of run up of urgency over the last, I'd say, sort of 12 to 18 months, give or take. And what we've seen is just overwhelming amounts of demand, frankly speaking. That was actually a significant driver. There's a bit of a question earlier. It was, well, why SPAC for fundraising, but it's also why now, right? Why raise additional capital right now? And for us, it is our customers, and I'm speaking broadly, right, have really gone from this is an important strategic initiative to this is a problem that really needs to be solved very, very quickly, right, from their perspective. And so that was part of what was driving the urgency to go get significant additional amounts of capital in order to put more steel in the ground to produce more of these carbon negative products for our customers.
When you talk about the innovation in this space, there has been so much money poured into technology for carbon capture. And when you look at the overall number in terms of how much carbon needs to be removed, I mean, it does seem pretty daunting. I'm looking at the UN numbers, 100 billion to 1 trillion tons of carbon dioxide that needs to be removed. What do you say to those critics who say that carbon capture is not the long-term answer here? That's really just sort of the quick fix that people are going for because they don't want to be taxed on the other end on their carbon footprint.
Yeah, I mean, I think we're focused on the scale of the problem, right? And how do you match the right kinds of technological and manufacturing and sort of business tools to the scale of that problem? And for us, that's a massive opportunity, right? We're going after, as you say, not only is it a huge carbon problem that has to be solved, but we're talking about materials which are some of the most consumed materials by humankind. And trying to pair the two of those. How do we take this huge problem and this huge quantity of materials that we use and back them up to each other and sort of solve the problem with the volume of materials, right? And so I think you're right that there's a massive scale of problem. It's not clear to me that in any way, shape, or form that we should only be trying to pick sort of the single winner in this category. So, which is, I think, maybe one way of framing the question you just asked is, should we only try one kind of solution? I think the answer is, this is such a large problem. We need to be doing everything that we can possibly figure out how to do. And from a business perspective, there is more than enough room for lots and lots of companies to be extraordinarily successful and essentially the next generation's major industrial companies, right? In the process of solving this climate problem.
Yeah, and to your point, we've seen so much VC money flow into this space. Appreciate you joining us today. John Bizzell, Origins Materials co-CEO and co-founder. Coming up, we're talking about Facebook and its news partnerships, its business model being put to the test over in Australia, how that's likely to potentially create a template for how they do business in other countries. We'll discuss after the break. reaching a deal with the Australian government, as well as publishers and regulators, restoring news content to its platform after the company removed all of its news content from Facebook earlier in the week over a dispute with lawmakers. And Zach, we haven't talked much about this one, but it's an interesting one in that it is playing out in Australia, but could have significant implications for the way that Facebook operates in a number of other countries. And sort of the bottom line here, for those of our viewers who have not been following, essentially, it is really about how much Facebook should pay for the content on its platform. Australia specifically, legislators moving forward with legislation that would require these platforms to take part in negotiations with media companies over the payment. If they can't come to an agreement, then they would have to bring in an independent arbitrator who would then pick a compensation plan from one of the sides. And some interesting discussions happening here on the sidelines of all of this. The Wall Street Journal, a number of other news outlets reporting that Australian officials, while having these discussions with Facebook, have also been speaking to their counterparts in Germany, in Canada, as well as France, as they look to try and regulate the way in which Facebook brings in the news on their platform, because the thing is they simply don't pay enough or pay at all.
Yeah, and I mean that's a big problem for Facebook or some of these other companies when you go from not paying at all to paying for something. Question around how much they should be paying, but I mean it's an important piece, at least for Facebook, in terms of why people even go to that platform. A Pew study back in 2020 highlighted that 36% of Americans, not Australians, Americans get their news from Facebook, and that's higher than what we see on YouTube or Twitter. So I mean it's I guess uniquely catered to being a destination for news when it comes to social media out there. But it is interesting because then you think about, what does that mean for Google? What does it mean for Reddit? What does it mean for any internet company out there that's really sending traffic to some of these news sites?
Yeah, no question. Facebook isn't the only company that is clearly going to be targeted by some of these regulations. But to your point, because so many people get their news from Facebook, they have been kind of the easy target here. It's going to be interesting to see how this really does affect the bottom line for the company, because the argument has long been that Facebook abuses its dominance in the market to try to avoid some of these fees that are necessary for a lot of these news organizations to be able to continue to get their stories out. That's going to do it for Zach and I in these 2 hours. But a programming note coming up here on Yahoo Finance, we've got the exclusive live stream host for the fully virtual Daily Journal annual meeting. That's happening from 1 to 3 p.m. Eastern. Charlie Munger, Daily Journal chairman and Berkshire Hathaway vice chairman, will be taking shareholder questions directly from our very own Julia LaRoche. You certainly don't want to miss that. That is coming up next here on Yahoo Finance Live. Before we go here, let's do a final check of where the markets are. We are seeing green across the board. The NASDAQ, the big one we've been watching, just given how big of a drag the big tech names have been on the index there. But we are seeing it in positive territory, as well as the Dow and the S&P 500. That does it for us here on Yahoo Finance Live. Much more coming up on the other side of the break.
Hello and welcome. You're watching Yahoo Finance Live for this special exclusive coverage of the Daily Journal's annual meeting of shareholders. I'm Julia LaRoche coming to you from Miami, Florida. I'm now going to send things over to Los Angeles, where we have the Daily Journal's CEO, Jerry Salzman, and Charlie Munger, chairman of the board, for some opening remarks before the shareholder questioning begins. Charlie, the floor is yours.
As usual, we'll go through this formal agenda very rapidly, and then we'll stay here and answer questions for a very long time. The questions have all been submitted by actual shareholders of the Daily Journal, and Yahoo's just delivering them to us. Ladies and gentlemen, wherever you are, via Yahoo Finance's website, the meeting will come to order. I'm Charlie Munger, chairman, and to my right is Jerry Salzman, CEO. What's all this list of directors for?
Just to let the people know who the directors are, Charlie.
Oh, the directors are Jerry Salzman, Peter Kaufman, Mary Conlon, and Gary Wilcox, who's retiring now, and myself. Ellen Ireland will be Inspector of Elections. We will now propose to make the formal business of the meeting. On December 18th, 2020, the record date, there were 1,380,746 shares of common stock of the company outstanding. The total number of shares represented by proxies at this meeting are 995,682, which are more than enough to constitute a quorum, making the meeting duly held. The first order of business is to re-elect the 4 directors. And the votes are as follows. Charles Munger, 679,481. Gerald Salzman, 660,287. Peter Kaufman, 593, 336. Mary Conlon, 651, 450, 493. Because we have the proxies, those directors are now reelected. The second proposal is to ratify the appointment of our certified public accountant. Baker Tilly, U.S. LLP. And the votes in favor of that are 995, 356, and against 120. That's interesting. Who in the hell is voting against the accountants? But the accountants are duly elected. And we will now proceed to the question period. Go ahead.
Thank you, Charlie. Our first question comes from Michael Wong. Michael Wong asked, in this year's annual letter, you mentioned the share price increase was driven by speculative frenzy and forced index buying. I would imagine that applies to the broad market too. What are the psychological implications of this type of market behavior? What could investors do to cope better with periodical frenziness?
Well, these things do happen in a market economy. You get crazy booms. Remember the dot-com boom, when every little building in Silicon Valley rented at a huge price, and a few months later, they were about a third of them were vacant. There are these periods in capitalism, and I've been around for a long time, and my policy has always been to just ride them out. And I think that's what shareholders do. In fact, what shareholders actually do is a lot of them crowd in to buying stocks on frenzy, frequently on credit, because they see that they're going up. And of course, that's a very dangerous way to invest. I think that shareholders should be more sensible and not crowd into stocks and just buy them just because they're going up and they like to gamble. And of course, Kipling once wrote a famous poem called "The Women," and the concluding line was to the effect that you should learn about women from him instead of yourself. But he says, I know you won't follow my advice. Go ahead, next question.
Thanks, Charlie. Our second question, we have a couple of shareholders who are asking about this latest retail frenzy. So we have Gavin Smith who asks, what are Mr. Munger's thoughts on the recent GameStop short squeeze by social media and the resulting implications on short selling in the future? And another shareholder named Lee asked, Dear Mr. Munger, please share your thoughts on the recent Wall Street Bets GameStop short squeeze. It seems to involve a lot of your standard causes of human misjudgment.
Well, it certainly does, and that's the kind of thing that can happen when you get a whole lot of people who are using liquid stock markets to gamble the way they would in betting on racehorses. And that's what we have going in the stock market. And the frenzy is fed by people who are getting commissions and other revenues out of this new bunch of gamblers. And of course, when things get extreme, you have things like that short squeeze. It's not generally noticed by the public, but clearinghouses clear all these trades. And when things get as crazy as they were in the event you're talking about, there are threats of clearinghouse failure. So it gets very dangerous. And it's really stupid to have a culture which encourages as much gambling in stocks by people who have the mindset of racetrack bettors. And of course it's going to create trouble, as it did. And I have a very simple idea on this subject. I think you should try and make your money in this world by selling other people things that are good for them. And if you're selling them gambling services where you rake profits off the top, like many of these new brokers who specialize in luring the gamblers in, I think it's a dirty way to make money, and I think that we're crazy to allow it. Next.
Our next question comes from Andrew Wilkinson. He would like to know, what do you hope the future of the Daily Journal Corporation looks like in a decade?
Well, I certainly hope that they succeed mightily in their software endeavor to automate all these courts for the modern world. And I think that could happen, but of course that's not a sure thing. I hope the newspaper survives too, and that's not a sure thing either.
Dear Mr. Munger and Mr. Salzman, this question comes from Matthew Peterson, I should mention. He writes, the highly configurable JTI product may help E-suites integrate deeply into new jurisdictions as agencies and citizens become familiar with the courthouse software. Today, the majority of contractual revenue that can be identified is from implementations and licenses. What are the main sources of ancillary revenue expected once the products have gone live, and how meaningful will the products like eFile-It, ePay-It, cloud hosting services, and others become?
Well, we don't really know where it's all going. We do know one thing, and that is the courts of the whole world are going to be taken into the modern age. And as Jerry just said to me at just after breakfast, he wouldn't want to invest in a parking lot by a courthouse for the future because an awful lot of the court proceedings are going to go to the internet. And this is a highly desirable thing. And if you go to a little country like Estonia, the whole damn country is on the internet, and it's a very good idea. So I think you can count on the fact that what we're doing is going to be it's in a big growing field. That's the good news. The bad news is it's not clear who's going to win all the business or how much money is going to be made. Generally speaking, people assume that we're a normal software company like Microsoft or something. We are, in fact, in a more difficult type of the software business than Microsoft. When you respond to software by the RFP process, it's a very difficult, demanding business, and it's less profitable and less sure than what Microsoft does. But we love it anyway. It's doing a big public service. Go ahead.
All right. Our next question, we had a couple questions about JP Rick Guerin. We have Tom Seymour and Thomas Chang, both asking if you all would share a few stories about him and your fondest memory.
Well, he was one of my closest friends for many decades, and he was very good company and a splendid gentleman, and of course, we accomplished quite a bit working together. Rick was part of the group which consisted of Warren Buffett, Rick Garrett, and Charlie Munger that bought control of blue chip stamps when it was widely distributed in an antitrust settlement. And we were together in that for a long, long time. And then Rick and I did the Daily Journal together at another occasion. And Rick was always humorous, always intelligent. I tell a story on Rick that he took the Navy's IQ test, and he got one of the highest scores ever recorded and left early. And that doesn't happen. That's the reason he rose so fast in life. He was just so damn smart. And of course, he was fun to be with because he was always jumping out of airplanes and parachutes and running marathons and so on, doing all kinds of things I would never consider doing. And he was a lot of fun. And he was a great kidder. He loved to kid people. And of course, he was very courageous and generous in helping everybody around him all his life. He was we miss Rick terribly. But he was 90 years of age. He had a long and wonderful run. And of course, when you're as old as I am, when these people go, there's no replacing them. Jerry, can you ever remember Rick down? He was always upbeat.
Always upbeat, yes. And interested and up to speed, and didn't have to take a lot of time to get background information to make his comments. Always on point.
Well, it helps to be able to leave the IQ test early with the highest score.
Our next shareholder question is from Adam Smith from Muncie, Indiana. He asked, now that we are cash flow positive, assuming the software business is investing organically as much as it can, what is the philosophical thinking with respect to capital allocation at the Daily Journal? Are traditional dividends and share repurchases the likely end state, assuming our software business grows into a bona fide company, Or will buying and holding securities from time to time be what the board is comfortable with? Everyone knows this isn't a small cap Berkshire Hathaway, just trying to get a feel for what the long-term capital allocation is.
Well, the business around here that has the most promise is our software business, automating the courts. And we're going to play that as hard as we can, and we hope to do well in it. And our marketable securities are we prefer owning common stocks to holding cash under current conditions. And it's kind of an accident that we have so much in marketable securities.
We had a couple of questions around succession planning. We have one from Ryan Fusaro from New York City. Charlie, he writes, in recent years, Berkshire Hathaway has provided much greater insight into the company's succession thoughts and has made available at the annual meeting the company's leading managers that will steer Berkshire's future. These actions have given some shareholders more visibility and comfort on their investment. Can you provide similar insight regarding the future at the Daily Journal? And would you consider implementing policies like those at Berkshire so shareholders can get to know the up and coming leaders in the organization?
Well, the people doing the computer software are doing magnificently well. The people under Jerry, Mary Jo and Danny, and we hope they'll continue doing magnificently well. But of course, it's a very difficult field, and there's a lot of competition, and we're a very small company compared to our main competitor, and so we can't promise we're going to succeed. All we can promise is we're going to try. And so far as I can tell, we're doing pretty well. Jerry, don't you think we're doing pretty well?
I think so, Charlie.
Yeah. I would go further. I don't think Jerry's surprised that the people doing the work, Mary Jo and Danny, are doing well. But I'm flabbergasted at how well they're doing.
Charlie refers to the course many times. The JTI software has been configured for other judicial and justice agencies, including district attorneys, prosecutors, public defenders, probation, etc. So we have one basic system configured a number of different ways, including workers' comp for a large state in the United States.
Well, it's a huge field in which we have a very interesting toehold, with the strongest toeholds in Australia and California. But we can't promise what the outcome will be, but we're trying pretty hard, and we get some favorable impressions of progress. The one thing I can promise is that I won't contribute much to it because I don't understand it.
Our next shareholder question comes from Simon Jacobs. He writes, many observers see market behavior that reminds them of the dot-com bubble, wild speculation, endless SPACs and IPOs soaring on their first day of trading. Do you agree that there is a close parallel to the late 90s and this is therefore, quote, must end badly?
Yes, I think it must end badly, but I don't know when.
You know, another shareholder, Bill Roberts, asked about SPACs, and he points out it seems like everyone, including actors, athletes, singers, and politicians, are getting into the business of promoting their own SPAC. Why do you think all these SPACs and the promoter, what do you think of all of the SPACs and the promoters pushing them?
Well, I don't participate at all, and I think the world would be better off without them. I think this kind of crazy speculation in enterprises not even found or picked out yet is a sign of an irritating bubble. It's just that the investment banking profession will sell shit as long as shit can be sold.
Richard Lewis from Culver City, California, he asks, Charlie, last February, you spoke about the wretched excess in the financial system. Given the developments over the past year, could you give us an update on your assessment of wretched excess in the system? Where does it appear most egregious?
Well, it's most egregious in the momentum trading by novice investors lured in by new types of brokerage operation like Robinhood. And I think all of this activity is regrettable. I think civilization would do better without it. You'll remember that when the first big bubble came, which was the South Sea bubble in England back in the 1700s, it created such havoc eventually when it blew up that England didn't allow hardly any public trading in securities of any companies for decades thereafter. It just created the most unholy mess. So human greed and the aggression of the brokerage community creates these bubbles from time to time. And I think wise people just stay out of them.
Our next question comes from Achit Patel. He says, Charlie, in your past speeches, you have mentioned the term functional equivalent of embezzlement to describe situations where bubbles can form because both parties involved in a bubble believe the asset to be worth more than it truly is. Can U.S. Treasury bonds be such a case today? And what are the implications since Treasury assets underpin the value of every other asset? Thank you for all you do to educate us.
Well, no, I don't think we have a bubble in Treasury securities. I think they're a bad investment when interest rates are this low, and I never buy any, neither does the Daily Journal. But no, I don't think Treasury securities are a big problem. I do think that we don't know what these artificial low interest rates are going to do or how the economy is going to work in the future as governments print all this extra money. And the only opinion I have there is that I don't think anybody knows what's going to happen for sure. Larry Summers has recently been quoted as being worried that we have too much stimulus. And I don't know whether he's right or not.
Jason Subatki, he asked, previously you have said, quote, it takes character to sit with all that cash and do nothing. I didn't get to where I am going after but I didn't get to where I am by going after mediocre opportunities, end quote. In the past few years, equity prices have increased significantly, and cash has arguably become riskier due to central banking policy. Have you considered amending this quote or lowering your standards?
Well, I think everybody is willing to hold stocks at higher price earnings multiples when interest rates are as low as they are now. And so I don't think it's necessarily crazy that good companies sell at way higher multiples than they used to. On the other hand, as you say, I didn't get rich by buying stocks at high price earnings multiples in the midst of crazy speculative booms. And I'm not going to change. I am more willing to hold stocks at high multiples than I would be if interest rates were a lot lower. Everybody is.
Cyril Tibbeville, he asked, do you think value investing is still relevant in a GDP decreasing world? And what about passive investing?
Well, that is easy. Value investing, the way I regard it, will never go out of style, because value investing, the way I conceive it, is always wanting to get more value than you pay for when you buy a stock. And that approach will never go out of style. Some people think that value investing is you chase companies which have a lot of cash and earn a lousy business or something. But I don't define that as value investing. I think all good investing is value investing. It's just that some people look for values in strong companies and some look for values in weak companies. But every value investor tries to get more value than he pays for. What is interesting is that in wealth management, a lot of people think that if they have 100 stocks, they're investing more professionally than they are if they have 4 or 5. I regard this as insanity, absolute insanity. I find it much easier to find 4 or 5 investments where I have a pretty reasonable chance of being right that they're way above average. I think it's much easier to find 5 than it is to find 100. I think the people who argue for all this diversification, by the way, I call it de-worsification, and which I copied from somebody, and I'm way more comfortable owning 2 or 3 stocks which I think I know something about and where I think I have an advantage.
Norman Bergman, he asked, why is Berkshire Hathaway selling shares of Wells Fargo as quickly as one can, and the Daily Journal has sold 1 share? If it's not good enough for Berkshire, shouldn't we have the same standards?
Well, I don't think it's required that we be actually the same on everything. We have different tax considerations. There's no question about the fact that Wells Fargo has disappointed long-term investors like Berkshire, because the old management, which is now removed, were not consciously malevolent or thieving, but they had terrible judgment in having a culture of cross-selling where the incentives on the poorly paid employees were too great to sell stuff the customers didn't really need. And when the evidence came in that the system wasn't working very well because some of the employees were cheating some of the customers, well, they came down hard on the customers instead of changing the system. That was a big error in judgment, and of course, it's regrettable. So you can understand why Warren got disenchanted with Wells Fargo. I think I'm a little more lenient. I expect less out of bankers than he does.
Atar Khan from Toronto, Canada, he asked, what is the wisdom behind holding bank stocks compared to other stocks? Are they more stable?
Well, I think all stocks can fluctuate, and I do think banking run intelligently is a very good business, but a very wise man was said on an early occasion, our trouble with banking is we have more banks than we have bankers. The kind of executives who have a Buffett-like mindset and never get in trouble are a minority group, not a majority group. And so it's hard to run a bank intelligently. There's a lot of temptation to do dumb things which will make the earnings next quarter go up, but are bad for the long term. And some bankers yield to the temptations. So it's difficult, but it's not impossible, investing in bank stocks successfully.
Jeffrey Malloy asks, what is the biggest competitive threat to U.S. banks like Bank of America and U.S. Bank, both equity holdings of the Daily Journal Corporation, over the long term? He asks, is it digital wallets like PayPal, Square, or Apple Pay? Is it Bitcoin, decentralized finance, or something else?
Well, I don't think I know exactly what the future of banking is, and I don't think I know how the payment system will evolve. I do think that a properly run bank is a great contributor to civilization, and that the central banks of the world like controlling their own banking system and their own money supplies. So I don't think Bitcoin is going to end up the medium of exchange for the world. It's too volatile to serve well as a medium of exchange. And it's really kind of an artificial substitute for gold. And since I never buy any gold, I never buy any Bitcoin. And I recommend that other people follow my practice. Bitcoin reminds me of what Oscar Wilde said about fox hunting. He said it was the pursuit of the uneatable by the unspeakable.
Charlie, you actually got a couple of questions from shareholders about Bitcoin, and one follow-up here. Mark Blakely from Tulsa, Oklahoma, he asked if your opinion on cryptocurrencies has remained the same, and would the Daily Journal consider Bitcoin or any other cryptocurrency as an asset on the balance sheet, similar to what Tesla recently did?
No, we will not be following Tesla into Bitcoin.
All right, we have another shareholder question. Suzanne Erica from Germany, she asks about BYD. BYD is in the Daily Journal stock portfolio with a very big paper gain. The stock has gained so much this year and last year. The stock appreciated probably way more than intrinsic value. How do you decide to hold on to a stock or sell some?
Well, that's a very good question. BYD stock did nothing for the first 5 years we held it. And last year it quintupled. And what happened was that BYD is very well positioned for the transfer of Chinese automobile production from gasoline driven cars to electricity driven cars. You can't imagine, it's in a wonderful position. And that excited the people in China, which has its share of crazy speculators. And so the stock went way up. Since we admire the company and like its position, and we like we have a tendency and we pay huge taxes to a combination of the federal government and the state of California when we sell something. And on balance, we hold in to certain of these positions when normally we wouldn't buy a new position. Practically everybody does that. One of my smartest friends in venture capital is constantly getting huge clumps of stocks at nosebleed prices. And what he does is he sells about half of them always. That way, whatever happens, he feels smart. I don't follow that practice, but I don't criticize it either.
Charlie, we have a similar question from a shareholder named Lee. No last name provided here, but this person writes, Dear Mr. Munger, do you believe the valuations for electric car manufacturers are in bubble territory? Both Berkshire and Li Lu own BYD, a company you spoke highly of in the past. BYD sells at nearly 200 PE. This is cheap compared to Tesla, currently valued at over 1,100 times PE and 24 times sales. I know Berkshire is a long-term owner and rarely sells securities of high-quality companies it owns in its portfolio simply because it's overvalued, for example, Coca-Cola in the past. However, is there a price too high that the company's future profits simply cannot justify? Since we are on the subject of selling potentially overvalued security, could you provide your systems for selling securities?
Well, I so rarely hold a company like BYD that goes to a nosebleed price that I don't think I've got a system yet. And so I'm just learning as I go along. I think you can count on the fact that if we really like the company and like the management, and that is the way we feel about BYD, we're likely to be a little too loyal. And I don't think we'll change on that.
Charlie, Matt McAllister has a question on Costco. He asks, why almost 2 years ago did you believe that the only U.S. stock worth buying, that was the only U.S. stock worth buying at that time? And why did you feel that Amazon had more to fear from Costco than Costco had to fear from Amazon? And if you believe Jeff Bezos is one of the best businessmen you have ever known, would you consider investing early in any of the new projects he will inevitably focus his attention on now that he will not have to be as concerned about the day-to-day responsibilities of Amazon?
Well, no, I'm a great admirer of Jeff Bezos, whom I consider one of the smartest businessmen who ever lived. But I won't be following him. We have our crotchets, and I just don't know enough about it to want to go into that activity. And every investor, when you get into these hard questions, there's a lot of very intelligent, honorable people who reach opposite conclusions. And Costco, I do think, has one thing that Amazon does not. People really trust Costco to be delivering enormous values. And that is why Costco presents some danger to Amazon, because they've got a better reputation for providing value than practically anybody, including Amazon.
Philip Erica from Germany, he asks, how do you control your investments in a world where reasonable companies with a good image, like GE, sink rapidly into the bottomland of the stock market? How do you recognize a potential downfall in a company you hold/invest in? Or is it impossible to realize a deterioration quickly enough to exit without a loss?
Well, I never owned a share of General Electric because I didn't like the culture. And I was not surprised when it blew up. I do think the present CEO is an extraordinarily able man, and the directors made a very wise choice when they put him in charge. And I think the directors of GE deserve a lot of credit for making Larry Culp the CEO. If anybody can fix it, he can.
We have another question. Peter Ferlin from Toronto. Mr. Munger, you famously run investments through your mental checklist. Is there anything that you wish you had added to your checklist sooner?
Well, I'm constantly making mistakes where I can, in retrospect, realize that I should have decided differently. And I think that is inevitable because it's difficult to be a good investor. And I'm pretty easy on myself these days. I'm satisfied with the way things have worked out, and I'm not gnashing my teeth that other people are doing better. And I think that the methods that I've used, including the checklists, are the correct methods. And I'm grateful that I found them as early as I did and that the methods have worked as well as they have. And I recommend that other people follow my example. It reminds me of the key phrase in Bunyan's Pilgrim's Progress. He says, "My sword I leave to him who can wear it." I'm afraid that's
Charlie,
the way we all have to leave our swords.
Charlie, Rhett Madison, he asked, you and Warren have been adept at quickly sizing people up, particularly business leaders and potential business partners. What do you look for in a leader? And do you and Warren have any tricks or shortcuts to size people up quickly and accurately?
Well, of course, if a person is a chronic drunk, we avoid him. Everybody has shortcuts to screen out certain hazards. And we probably have more of those shortcuts than others. And they've served us well over the years. One of the great advantages of the way Berkshire operates is that we associate with a lot of marvelous people. And if you stop to think about it, that is also true at the Daily Journal. What little newspaper company has come through the crisis that's destroying all the newspapers better than the little Daily Journal? And we've had marvelous people here who've helped us do it through very difficult times. And one of them is Jerry Salzman. And Jerry and I have been together how many years, Jerry?
Early 70s.
Early 70s. And it's rather interesting. I recognized early that Jerry could run anything he wanted to run. And when the old CEO of the Daily Journal died, Jerry was managing the business affairs of the Munger Tolles law firm. But he'd previously worked for Rick Guerin and me in running a little mutual fund that we bought control of. And he made a very favorable impression. And I said to Rick, we're going to make Jerry the head of the Daily Journal. And he gasped and said, but he's never had anything to do with newspapers or anything else. I said, it won't matter. He'll be able to do it. And we immediately assented, and we put Jerry in, and he's made every decision wonderfully ever since. That's our system. Tom Murphy used to say his system of management was delegation just short of total abdication. And that's the way we handled Jerry.
Charlie, Caroline Smolinski would like to know, which do you think is crazier? Bitcoin at 50,000 or Tesla's fully diluted enterprise value of 1 trillion? What do you make of these two pricings?
Well, I have the same difficulty that Samuel Johnson once had when he got a similar question. And he said, I can't decide the order of precedency between a flea and a louse. And I feel the same way about those choices. I don't know which is worse.
Richard Saunders would like to know, should there be a tax on buying stock now that Robinhood trades are free?
Well, Robinhood trades are not free. When you pay for order flow, you're probably charging your customers more and pretending to be free. It's a very dishonorable, low-grade way to talk. And nobody should believe that Robinhood's trades are free.
We have a question from Andrew Peak in Weston, Connecticut. Mr. Munger, as a student of Chinese history, my question concerns China. In 1860, GDP per capita in China was 600. In 1978, the year Deng Xiaoping took over, it was 300. Today, it hovers around 9,500. Never before in the history of mankind have we seen such a rapid eradication of poverty, pulling approximately 800 million people out of destitution. You are on record as a zealous fan of the Chinese work ethic and Confucian values system. As we can see from the deteriorating U.S. relationship with China, the Western world does not understand China. What can we do to increase knowledge, understanding, and appreciation of the Chinese civilization?
Well, it's natural for people to think their own civilization and their own nation is better than everybody else. But everybody can't be better than everybody else. You're right, China's economic record among the big nations is the best that ever existed in the history of the world. And that's very interesting. A lot of people assume that since England led the Industrial Revolution and had free speech early, that free speech is required to have a booming economy as prescribed by Adam Smith. But the Chinese have proved you don't need free speech to have a wonderful economy. They just copied Adam Smith and left out the free speech, and it worked fine for them. As a matter of fact, it's not clear to me that China would have done better if they'd copied every aspect of English civilization. I think they would have come out worse because their position was so dire and the poverty was so extreme. They needed very extreme methods, totalitarian methods, if you will, to get out of the fix they were in. So I think what China has done was probably right for China, and that we shouldn't be so pompous as to be telling the Chinese they ought to behave like us because we like ourselves and our system. It's entirely possible that our system is right for us and their system is right for them.
Gavin Smith from Berkshire, England, he asked, Mr. Munger is a champion of Chinese stocks. How concerned is he about Chinese government interference as seen recently with Ant Financial, Alibaba, and Mr. Jack Ma? What, for example, is to stop the Chinese government from simply deciding one day to nationalize BYD?
Well, I consider that very unlikely. And I think Jack Ma was very arrogant to be telling the Chinese government how dumb they were and how stupid their policies were and so forth. Considering their system, that is not what he should have been doing. And no, I don't think that. I think the Chinese have behaved very, very shrewdly in managing their economy, and they've gotten better results than we have in managing our economy. And I think that will probably continue. And sure, we all love the kind of civilization we have. I'm not saying I want to live in China. I prefer the United States. But I do admire what the Chinese have done. How can you not do it? Nobody else has ever taken a big country out of poverty so fast and so long. And what I see in China now just staggers me. There are factories in China that are just absolutely full of robots and are working beautifully. They're no longer using peasant girls to beat the brains out of our little shoe companies in America. They are joining the modern world very rapidly, and they're getting very skillful at operating.
Okay. We have a question from James Lee from La Cañada, California. He writes, it seems likely that the current Fed policy of keeping interest rates near zero will only exacerbate the income disparity in this country by benefiting those who own the financial assets. What do you think we can do to help those who are currently falling behind as a result of this pandemic?
Well, it's hard to know what exact macroeconomic policy is correct because no one knows for sure just how much government intervention is wise and at what point the government should stop intervening. And I don't think we have any great gift at making macroeconomic predictions about how the money, and I think that to some extent the complaint about the rich getting richer as a result of the COVID panic, I think that's a misplaced concern. Nobody was trying to make the rich richer. We were trying to save the whole economy under terrible conditions. And I think by and large, we made the most practical decisions that were available to us. And we made the rich richer, not as a deliberate choice, but because it was an accidental byproduct of trying to save the whole civilization. And it was probably wise that we acted exactly as we did. And it wasn't some malevolence of the rich that caused it. It was an accident. And the next time around, why the poor will get richer faster than the rich, that thing's circular. Who gets rich faster by class is going to vary over time, and I don't think anybody should be too concerned by it. As a matter of fact, what happens is that to make a nation rich, you need a free market system. And if you have a free market system that's trying to get rich in the way recommended by Adam Smith, what happens is that it's a very irritating system because the poverty that causes so much misery is also causing the growth that makes everybody get out of poverty. In other words, to some extent, it's a self-correcting system. And that makes the whole thing very awkward. And it's a shame that the economics textbooks don't emphasize how much a growing economy needs poverty in order to get out of poverty. And if you try and reduce the poverty too much, it's counterproductive. And these are very difficult questions, and most people assume that it's simple. I mean, if we could make the world richer by just raising the minimum wage to $100,000 a second or something, well, of course we would do it, but we can't.
Gavin Smith would like to know, Mr. Munger recently raised the alarm about at the level of money printing taking place. What are his thoughts on modern monetary theory?
Well, modern monetary theory means that people are less worried about an inflationary disaster like Weimar Germany from government printing of money and spending it. And that's monetary money. Now, so far, the evidence would be that maybe the modern monetary theory is right. Put me down as skeptical. I don't know the answer to that one.
Okay. But going back to the Fed, William Roberts asks, the Federal Reserve appears to be supporting asset prices. Do you think this is a worthwhile policy objective given the effect it has on creating financial excesses and income inequality? What do you think the long-term consequences will be?
Well, I don't know how well the economy is going to work in the future. And I don't think that we or the Daily Journal is getting ahead because we've got some wonderful macroeconomic insight. And I do think that I'm way less afraid of inequality than most people who are bleating about it. I think that inequality is absolutely an inevitable consequence of having the policies that make a nation grow richer and richer and elevate the poor. So I don't mind a little inequality. And what I notice is that the rich families generally lose their power and wealth, and pretty fast. And so I don't worry that the country is being ruined by a few people who are getting ahead a little faster than the rest of us. I think the Chinese were very smart. Imagine a bunch of Chinese communists turning a whole lot of Chinese into billionaires in a big hurry. And what do the Chinese communists do with respect to death taxes? The death tax in China is zero. That's what the communists are doing. I think they're probably right, by the way.
We have a question from Simon Jacobs. He writes, many believe that inequality accelerated by this pandemic has reached alarming levels that demands drastic solutions, such as a wealth tax. Do you agree with the premise? And if so, how would you address inequality?
Well, I think any rich nation ought to have a social safety net that expands a little with its wealth. And that's what we've been doing through my whole lifetime, and I applaud the result. And I think the result would have been worse if either party had been in control all by itself for the whole period. In other words, I think the system of checks and balances and elections that our founders gave us actually gave us pretty much the right policies during my lifetime. And I hope that that will continue in the future. But I do think politics is getting more full of hatred and irrationality than it used to be in America, and I don't think that's good.
Alan Smolinski asked, Charlie, many major businesses and high net worth individuals have been leaving California. Can you speak to the causes, the trend, and make some predictions?
Yes, I think that is rising as we sit here. I just see more and more of the rich people leaving. And of course, I think it's vastly stupid for any state to be user-friendly to the rich people. They do way more good than harm. And they lose their money fast enough. You don't need to worry about them. And so I think the policy, Washington State is actually considering a wealth tax at the state level. I think that would be insanity. I predict that if they do that, a lot of people will leave Washington.
Brian Chin from Los Angeles asks, with all the work from home with Zoom and other technology, what do you think the future of commercial real estate looks like?
Well, real estate has always been a difficult field. And some types of real estate in recent years has been particularly difficult. I think office buildings are now in some trouble, and of course commercial real estate rented to stores has been in a lot of trouble for a long time. Apartments have come through better, but I don't think I've got a lot to contribute to it. I own some apartment houses, so I like that investment, provided you've got a perfect management, which is hard to get.
We have a healthcare related question from Abel Teklu. He asks, I was wondering if you could share some thoughts on Haven, particularly why it was ultimately closed and what were the lessons learned?
I don't know anything about Haven. Yeah, give me a new question.
Sounds good. So here we go. I have a section that might be of interest to you. We have David Thompson, and he says, you've said several times that the best way to learn about business is to study the multi-decade financial results of great companies. You've even said business schools that don't adopt this method are doing their students a disservice. Would you mind elaborating on how a professor or individual should go about building a curriculum around this approach? What, for example, would you recommend as course materials?
Well, here's what I meant. And by the way, the Harvard Business School, when it started out way early, they started out with a history of business. They'd take you through the building of the canals and the building of the railroads and so on and so on. And you saw the ebb and flow of industry and the creative destruction of the economic changes and so on and so on. And it was a background which helped everybody. And of course, what I'm saying is that if I were teaching business, I would start the way Harvard Business School did a long time ago. I think they stopped because if you taught that course, you'd be stealing the best cases from the individual professors of marketing and so on and so on and so on. And I just think it was academically inconvenient for them. But of course, you should start out by studying the history of capitalism and how it worked and why before you start studying business. And they don't do that very well. I'm talking about the business schools. If you stop to think about it, business success long term is a lot like biology. And in biology, what happens is the individuals all die, and eventually so do all the species. And capitalism is almost as brutal as that. Think of what's died in my lifetime. Just think of the things that were once prosperous that are now in failure or gone. Whoever dreamed when I was young that Kodak and General Motors would go bankrupt? You know, it's incredible what's happened in terms of the destruction. And of course, that history is useful to know. Next.
Charles H. from New York. He actually quotes a speech that you gave, a commencement address you gave in 2007 at USC Law School. I'll paraphrase here. You wrote, or you said, so if a civilization can progress only when it invents the method of invention, you can only progress when you learn the method of learning. I was very lucky. I came to law school having learned the method of learning, and nothing has served me better in my long life than continuous learning. Charles H. would like to know, what's Charlie's method of learning?
Well, I think I had the right temperament. And when people gave me a good idea, and I could see it was a good idea, I quickly mastered it and started using it and just used it for the rest of my life. And you'd say that everybody does that in their education, but I don't think everybody does. It's such a simple idea. And of course, without the method of learning, you're like a one-legged man in an ass-kicking contest. It's just not going to work very well. Take Jerry. You think the Daily Journal would have hundreds of millions of marketable securities now if Jerry didn't know how to learn something new? He didn't know one damn thing about the Daily Journal when we made him head of it. But he knew how to learn what he didn't know. Of course, that's a useful thing. And by the way, I think it's hard to teach. I think it's, to some extent you either have it or you don't.
Well, Jerry Chang would like to know. Jerry Chang would like to know why are some people incapable of learning new ideas and behaviors?
Well, it's partly culture, but a lot of it's just born in. It's a quirk. Some people have a natural trend toward good judgment, and other people do just make their life is just a series of mistakes over and over again.
Lee would like to know, Charlie, dear Mr. Munger, you have revised your famous talk on the standard causes of human misjudgment with considerable new material back in 2005. Now 16 years have passed. Is there any new material?
No, I would say that of course there's some new material in misjudgment, but by and large most of the knowledge has been available for a long time. What prevents the wide use of helpful psychological insight is the fact that the psychology gets really useful when you integrate it with all other knowledge. And the reason, but they don't teach that in the psychology department because the academic system rewards little experiments that develop more insight into psychological tendencies instead of synthesizing what's already been discovered with the rest of knowledge. The psychology professors don't know all that much about the rest of knowledge, and they have no incentive to master it. And if you don't have mastered the rest of knowledge, you can't synthesize it with psychology. So that's an interesting example of self-learning. When I saw that psychology was necessary and I didn't have it, I didn't just learn the little tendencies and well enough to get A's in psychology. I learned those tendencies well enough to synthesize them with the rest of the knowledge. And that's the right way to do it. But show me a psychology department that knows how to do that. It's one of the most ignorant professions in the world.
Robert McKenzie asked, Charlie, you are known as an advocate for learning from one's mistakes. What did you learn from the Barry Dutton's bookstore building in Brentwood, that deal, and how would you apply that new knowledge or experience in the future?
Well, I think I've learned to avoid zoning work. When I was young, I rezoned some properties very successfully. And I was like Rip Van Winkle. When I tried to come back to it, I found that the world had changed. And I don't think you'll find me engaged in any massive rezonings in the future.
Okay, Vic Aurora asked, what advice would you give to someone who is trying to stay within their circle of competence, but finding that the pace of technological innovation is rapidly reducing that circle?
Well, of course, if they bring in a brand new technology you don't understand at all, you're at something of a disadvantage. And my advice would be if you have a fixable disadvantage, remove it. And if it's unfixable, learn to live without it. What else can you do? You fix what can be fixed, and what can't be fixed, you endure.
Frank Wong from Houston, you are one of the oldest and greatest thinkers of our time. Any tips for someone who wants to work on and improve their ability to hold two opposing views at the same time? Any tips on how to generate insight in these types of situations?
Well, I do have a tip. at times in my life, I've put myself to a standard that I think has helped me. I think I'm not really equipped to comment on this subject until I can state the arguments against my conclusion better than the people on the other side. If you do that all the time, if you're looking for disconfirming evidence and putting yourself on a grill to make, that's a good way to help remove ignorance. What happens is that every human being tends to believe way more than he should in what he's worked hard to find out or what he's announced publicly that he already believes. In other words, while we shout our knowledge out, we're really pounding it in, we're not enlarging it. And I was always aware of that, and so I've accepted these damned annual meetings. I'm pretty quiet.
Ron L. Has a question about Gene Abegg. Gene Abegg seems like he was one of the best bankers of the last century, achieving both extremely low loan loss rates and earning around 2% on assets over a long time period. I think the bankers of today could learn a lot from Gene, but little is known of him. Question: how did Gene achieve incredibly low loan losses over the long term while so many other bankers have failed miserably?
Well, that is an easy one. He was a very smart man. He lived in a particular town. He knew everybody and everything. He had excellent judgment. He cared terribly about not making bad loans or incurring dumb expenses. So he was just a perfect banker if you wanted never to have any trouble. And of course, it really helped to know everybody in town. If I had stayed in Omaha, where I was raised, and gone into the banking business, I would have been a hell of a good banker. Because even as a boy, I knew a lot about who was sound and who wasn't sound in Omaha. And that's the way Gene was in his community. Furthermore, he'd gone through the Great Depression. He'd been a receiver for a bank. Well, of course, that made him very leery of dumb loans. And of course, he hated costs. He was just a very old-fashioned sound thinker. And of course, that will still work. But it's hard for anybody else to. He really knew everything you had to avoid credit losses in a small town in Illinois.
We have a question from Stephen Chen. Charlie, you have been a longtime admirer of Singapore and Lee Kuan Yew. You once said that study the life and work of Lee Kuan Yew, you are going to be flabbergasted. I would be curious to know, how did you start your interest about Singapore and Lee Kuan Yew, and have you met Lee Kuan Yew in person, and if there is one thing the world could learn from Singapore now, what would that be?
Well, Lee Kuan Yew had the best record as a nation builder. If you're willing to count small nations in the group, he had probably the best record that ever existed in the history of the world. He took over a malarial swamp with no army, no nothing. And pretty soon, he turned that into this gloriously prosperous place. And his method for doing it was so simple. You know, the mantra he said over and over again, it was very simple. He said, figure out what works and do it. Now, it sounds like anybody would know that made sense. But, you know, most people don't do that. They don't work that hard at figuring out what works and what doesn't. And they don't just keep everlastingly at it the way he did. And again, he was a very smart man. And he had a lot of good ideas, and he absolutely took over a malarial swamp and turned it into modern Singapore in his own lifetime. It was absolutely incredible.
And he did not have, it was a one-party system, but he could always be removed by the electorate. He was not a dictator. And he was just so good. He was death on corruption, which was a very good idea. And in fact, there's hardly anything he touched he didn't improve. When I look at modern Singapore health system, it costs 20% of what the American system costs. And of course, it works way better than our medical system. And that's entirely due to the practical talent of Lee Kuan Yew. Just time after time, he would choose the right system. And in Singapore, you get a savings account the day you're born. And if you don't spend the money, you and your heirs get to spend it eventually. In other words, it is your money. So that to some extent, everybody buying medical service in Singapore is paying for it himself. And of course, people behave more sensibly when they're spending their own money. He just, time after time, he would do something like that recognized reality and worked way better than what other people were doing. And there aren't that many people like Lee Kuan Yew that have ever lived. So of course I admire him. I have a bust of Lee Kuan Yew in my house. I admire him that much.
Charlie, Ed Collins, he would like to know, what is the biggest lie currently being perpetuated by the investment complex?
Well, commission-free trading is a very good candidate for that if you want to emphasize disgusting lies. Commission-free trading is not free.
Michael or Shaggy would like to know, do you think it's best to invest in the common stocks of businesses early, or while they are more nascent and the industry is smaller, or wait until they are the clear winner of a more mature industry?
Well, I think Warren and I are better at buying mature industries than we are at backing startups like Sequoia. The best venture capital operation probably in the whole world is Sequoia's, and they are very good at this early stage investing. And I would hate to compete with Sequoia in their field. I think they'd run rings around me. So I think for some folks, early stage investing is best. And for other folks, what I've done in my life is best.
Beauchamp asks, Charlie, last year, almost every e-commerce, internet, and internet adjacent stock was up 100+%. You've said recently that Sequoia is the greatest investment firm ever. Do you think the digital economy has reached a tipping point such that, quote, this time is different, end quote, and that conventional valuation measures for these types of companies are dead? Or does this environment remind you of 1999? How do you reconcile the idea of paying 50 or 60 times revenue for a growing but unprofitable business with the more traditional value investing concept of a margin of safety?
Well, generally speaking, I don't try and compete with Sequoia. You can argue that I got close to Sequoia when, with Li Lu, we bought into BYD. That was not a startup, but it was so small and thinly traded that we were buying into a venture capital type investment, but in the public market. But with that one exception, I've stayed out of Sequoia's business because they're so much better at it than I would be, and I don't know how to do it the way they do
it. Michael Assail asks, of the various types of moats and competitive advantages which types do you think will be most important in the years ahead? And what combinations of competitive advantages can you imagine will create any new types of moats?
Well, that's too hard and general a question for me. The one thing I will say is that a lot of the moats that looked impassable, people found a way to just look. Think of all the monopoly newspapers that used to be, in effect, part of the government of the United States, and they're all dying, every damn one of them almost. A lot of the old moats are going away, and of course people are creating new moats all the time. That's the nature of capitalism. It's like evolution in biology. New species are created and old species are dying. And of course it's hard to negotiate in such a field. But there's no rule that life has to be easy on the mental side. Of course it's going to be difficult.
Vishal Patel in Toronto. Vishal Patel in Toronto says, I enjoyed your Caltech interview and wanted you to elaborate and provide more insights on your point of great investors and great chess players. How are they similar or different? And Vishal also wants to know, Charlie, if you have seen the television show Queen's Gambit on Netflix.
Well, I have seen an episode or two of the Queen's Gambit, and what I think is interesting about chess is, to some extent, you can't learn it unless you have a certain natural gift. And even if you have a natural gift, you can't be good at it unless you start playing at a very young age and get huge experience. So it's a very interesting competitive field. And I think that great investment, I think people have the theory that any intelligent, hardworking person can get to be a great investor. I think any intelligent person can get to be pretty good as an investor and avoid certain obvious traps. But I think that I don't think everybody can be a great investor or a great chess player. I knew a man once, Henry Singleton, who was not a chess champion, but he could play chess blindfolded at just below the grandmaster level. But Henry was a genius, and there aren't many people that can do that. And if you can't do that, you're not going to win the chess championship of the world, and you're not going to do as well in business as Henry Singleton did. I think some of these things are very difficult, and I think by and large it's a mistake to hire in investment management to hire armies of people to make conclusions. Better off to concentrate your decision power in one person, the way the Lowe partnership does, and choose the right person. I don't think it's easy for ordinary people to become great investors.
We have another question from Ankit Patel in Cupertino, California. Hi, Charlie. You identified the opportunity in electrification and invested in BYD. How do you think about the hydrogen opportunity for transportation, and how does it compare to the electric opportunity? Specifically thinking about trucks versus cars, will we have less gas stations or truck stops in the future?
Well, I hope we don't have less truck stops, because Berkshire Hathaway is deeply involved in truck stops. But of course, I think there will be more automation in transportation of all kinds in the future. I don't think I've got any great insight about hydrogen. I do think having a whole system to sell hydrogen is difficult. On the other hand, the buses in Los Angeles work on natural gas. All the buses. And it saved Los Angeles a fortune because gas is so much cheaper than gasoline. And so I've seen a whole bus system shift from gasoline or diesel to a gas, and so it obviously isn't impossible. But you have to create a whole new system of supply for it. And of course, I remember, I don't even know how much more difficult, how much more dangerous it would be to deal with hydrogen than it is to deal with gasoline, which is also a dangerous substance. No, you've reached the limit of my circle of competence. I can't help you.
Got it. We have a couple of Daily Journal related questions from shareholders. From Miles Marino, he wants to know, what would management do with a sudden windfall of profits? How would they think about current opportunities with low rates and low inflation?
Well, it's not easy to handle accumulated money in the current environment when the stocks are so high and many real estate parcels of real estate of certain kinds is also very inflated. So it's very difficult. And all I can say is we'll do the best we can. But when it gets difficult, I don't think there's any automatic fix for difficulty. I think when difficulty comes, I expect to have my share.
Norman Bergman would like to know, does management, in your opinion, have a moral responsibility to have their shares trade as close to fair value as possible?
Well, I don't think you can make that a moral responsibility, because if you do that, I'm a moral leper, because the Daily Journal stock sells at way above the price I would pay if I were buying a new stock. So, no, I don't think it's the responsibility of management to assure where the stock sells. I think the management should tell it like it is at all times, and not be a big promoter of its own stock, but
Tom Seymour, he has a question. In 1999, the year the Daily Journal bought Sustain, the traditional business employed 355 full-time employees and 61 part-time employees. In 2010, that was down to 165 full-time employees and 15 part-time employees. This year's annual report suggests that the traditional business has 97 full-time employees. Has the quality of the publications suffered as the employment levels have decreased? Or has the digital revolution caused enormous productivity improvements in those businesses?
well, of course the place is downsized. It had to, because the traditional business, newspaper business, is shrinking. And of course, Jerry, being a sound thinker, did the very unpleasant work of shrinking it appropriately and without bothering me or Rick, showing how wise we were to put him there in the first place. Has the quality gone down? Well, I don't think the quality in publishing public notice advertising has gone down. But I hardly think the editorial quality could go way up while the employees were going down. My guess is we have suffered some in editorial quality. Jerry, do you have a comment on that?
There are a number of factors that come into play here, and you mentioned technology. That's very, very important. Many of our systems are in the cloud, all except for the legal advertising system, which we had to build.
because nobody else has the volume that we have. Our editorial system, our advertising system, all in the cloud. Accounting is also in the cloud. And the disruption from the decline in newspapers has had a significant impact. Classified advertising is down significantly. In display advertising, for example, we now utilize a very friendly company that worked with us for 25 years, and now they are helping us sell advertising. Also, fortunately, before the pandemic, we got out of the conference type events, and we were not subjected to the problems of no conferences, nobody to attend. And when you look at what's happened in California, the price of real estate and rentals, we've reduced the number of offices we have, both for Journal Technology and for the Daily Journal. Very difficult to hire reporters in the San Francisco area with all the demands coming from the internet companies wanting to have editorial product. All those factors come into play, and also if you go back a little further, we eliminated California Lawyer magazine, and we had at one time an office in Seattle and one in Denver, and about the same time we bought an office in a newspaper in Phoenix, and that worked out extremely well. The ones in Seattle and Denver, difficult to break into the legal advertising system, which supports so many newspapers, not only in California, but elsewhere.
It's very hard
Charlie,
to have a shrinking business. And Jerry has done it magnificently well. And it was totally required.
Charlie, our next question comes from Mark Blakely. Do you believe the market is going through a long-term value slump similar to 1999, or do you believe technology has caused a permanent change in how companies should be valued?
Well, I don't know how permanent it's going to be, but it certainly caused a change. And of course, it's hard to know what the future holds in a complex system where you can't predict a lot of things. And generally, what people do is they have financial reserves, so they have some options if trouble comes, and they adapt the way Jerry has to required downsizings or required upsizings. One of the interesting things about the Daily Journal is that we made all that money in the foreclosure boom. So we were like an undertaker who suddenly got prosperous in a plague year. And it's a funny way to make money. And that happened because Jerry and I bought these little flea-bitten newspapers all over the state for just as a precaution to make sure we could serve public notice advertising wherever it arose in the state. And
One-stop center.
Yes, and that turned out to be a wonderful idea, and that's one of the reasons we made all this money. So the shareholders have been lucky to have somebody like Jerry here who could learn what he didn't know and fix it.
Charlie, Chris Demetra, he asked, you've spent much of your life contributing your wisdom to schools and hospitals. How would you advise these institutions to manage their endowments over the coming decades?
Well, the one charitable institution where I have had some influence for a very long time has a whole bunch of hotshot financiers in every branch of wealth management there is on the board. And that institution has two assets in its endowment accounts. One is a big interest in Lilu's China fund, which is a limited partnership, and the other is a Vanguard index fund. And as a result of holding those two positions, we have way lower costs than anybody else, and we make more money than practically everybody else. So you now know what I do in charitable institutions. By the way, that's not the normal outcome in America. The wealth management industry has a crisis on its hands. They really need the world to stay the way it is. And that isn't necessarily right for its customers.
Our next question comes from Randy Jeffs. It is estimated that the Gates Foundation has saved well over 100 million lives. Buffett's donations to the foundation has obviously helped to save many millions. Are Berkshire's managers aware that through their efforts to create business success at Berkshire, that they have been involved in saving millions of lives?
Well, I'm sure some are, but by and large, that's not what Warren is known for. He doesn't mind at all not getting credit for his charitable donations.
We have a question from Bergen, Norway. This comes from Knut Martin Carlson. He would like to know, is the oil and gas industry the new newspapers?
I don't think so. I think the oil and gas industry will be here for a long, long time. As a matter of fact, it'll be here for a long, long time if we stop using much hydrocarbons in transportation. The hydrocarbons are also needed as chemical feedstocks, and I don't think that hydrocarbons are going. I'm not saying that oil and gas is going to be a wonderful business, but I don't think it's going away, and I don't think it's like the newspaper business.
We have a couple more energy-related questions. One from Simon Jacobs. Actually, this is environmental. Do you believe global warming is an existential threat to humankind? And if so, how do you think society should address it, especially because poor countries require much more cheap energy to reduce poverty?
Well, of course, it's very hard to fix the global warming problem when the poor countries need to burn coal to stay alive and so on. And so it's a serious problem. And on the other hand, we have a fair amount of time to do it. And a rich civilization can afford to do it if we absolutely have to. If the seas were to rise 60 feet, which could happen in another 100 years or so, 60 feet, we'd have to build enormous barriers to sea entry. Florida would have a really serious problem. On the other hand, it could be handled. Bill Gates has written a book on this subject recently, which he concludes that it would be expensive, but it could be handled. And his conclusion is that mankind should just step up to it and do it. And I don't want to quarrel. I kind of admire the way Bill takes on these very hard problems. I tend to avoid the ones which I'm not good at, and I'm not good at a lot of different problems.
Charlie, probably the most popular question here, it's probably too many shareholders, but they would like to know the books that you're currently reading and books that you recommend.
I think I'll skip that one. Go on.
Sounds good. Okay. We have one from Christopher Sy. He writes, Ben Franklin said, were it offered to my choice, I would have no objection to a repetition of the same life from its beginning, only asking the advantages authors have in second edition to correct some faults of the first. If you were offered a fresh start today, what would you do differently in life and in investing?
Well, Ben Franklin was one of the wisest men who ever lived. And yet he made a lot of mistakes in the course of living his life. And of course, if he had a chance to do it over again, he would avoid those mistakes. We would all say that. And he was very amiable the way he talked about it. But of course, if we got a chance to do it again, we would do it better. And however, the number of people who ever got a chance to do it again is zero. So it's a very theoretical discussion. But of course, there's an old German proverb I've always liked, and it says that man is too soon old and too late smart. And that's true whether you're Benjamin Franklin or Joe Klutz. And we all live with that problem. And we're all pretty forgiving of ourselves too, which is probably a good thing.
Charlie, Lee would like to know.
I wouldn't change my life all that well. I think most people are assuming tolerable success in life are about as happy as they were ordained to be, and they wouldn't have been a lot happier if they were richer, or a lot less happy if they'd been poorer. I think most people are born with a happy stat, and their happy stat has more to do with their happiness than their outcomes in life.
Lee would like to know, Mr. Munger, your advice given on choosing a good spouse in poor Charlie's almanac is terse. You have said that the single best way is to deserve a good spouse, because a good spouse is by definition not nuts. That is true and makes sense. However, could you be more specific? You used examples of Lee Kuan Yew's good judgment in choosing someone with brains over certain physical attributes in your past interview. Could you give more examples, both good and bad ones, from your personal observations or through vicarious readings?
Well, I can't top Lou's example. In his early education, he was the second-ranked student in the school. He was that smart. And there was one woman who was a year older than he was, who was the first-ranked student in the school. So he married her. And of course, his son, who's a bright man, is now, Prime Minister of Singapore. A little wisdom in spouse selection is very desirable. You can hardly think of a decision that matters more to human felicity than who you marry.
Chris from Park City, Utah would like to know, Mr. Munger, given all of your donations to physics, what is your favorite way of applying physics to society's problems and also to investing?
I don't think I use much physics in solving my investment problems, but it occasionally helps me. Occasionally, some damn fool will suggest something that violates the laws of physics, and I always turn off my mind the minute I realize the poor bastard doesn't know any physics.
Paul Iani would like to know, how important is the analysis of company culture in the investment process?
Well, it's quite important. Part of the success of a company like Costco, and it's been amazing that one little company starting up not all that many decades ago could become as big as Costco did, as fast as Costco did. And part of the reason for that was cultural. They have created a strong culture of fanaticism about cost and quality and so forth, and efficiency and honor, all the good things, and of course, it's all worked. And so, of course, culture is very important.
Charlie, Jason Chin, he would like to know, you often advocate for learning from other people's big calamities and stupidities. What would be a mistake at the Daily Journal where we can all learn from?
Well, Jerry, what's the biggest mistake we've made?
Well, we don't think about mistakes. We take the situation as it is and try to solve it.
I can't think of a we paid high prices for some little companies in the course of trying to enter the court software business. But I don't think that's going to end up a mistake. God knows it was difficult, but I don't think it's a mistake. I don't think we have made a lot of horrible mistakes. Look around these real estate. We bought all these buildings cheaply. They're in a place that's gotten more valuable. Mostly and I don't think it was a mistake to buy the Daily Journal when we did, paying the price we did. We paid $2.5 million for it. We got a dividend of $2.5 million shortly thereafter. Everything you see is profit. I think we've coped pretty well so far.
Freddie from Istanbul would like to know, if you had a chance to make an addition or a revision to Poor Charlie's Almanac, what would that be?
Well, I don't have any wonderful new thoughts. You know, to the extent that my thoughts have helped my life, I think I've pretty well run the course. And I don't think I'm likely to have any new thoughts that are going to work miracles either. But I find that the old ways of doing things still work. I've been engaged in recent years in trying to create a better type of student dormitory. And I find that by working at that, I can actually make some improvements even though I'm old. So I'm kind of pleased that I'm still functioning at all. I'm not trying to move mountains.
A couple more questions left here. We have one. Do you believe any psychological personality tests, such as the Myers-Briggs type indicator personality test, to be of any good in choosing a compatible partner? Given that choosing a spouse is probably the most important decision one can make in life, could you please elaborate on the subject, and could you consider giving a talk on this particular subject, the most important decision in life, to benefit those who are single, perhaps including some of your grandchildren and great-grandchildren?
Well, you know, I had a failed marriage, so I don't think I'm in a perfect position to advise the young about marriage. And no, I don't have anything to contribute.
Charlie, Victor Liu from Los Angeles, he would like to know, what have you done to live such a long life? And if you could share the secret to living a long and healthy and happy life.
Well, I think I'm alive because of a lucky genetic accident. And I don't think I can teach you how to retroactively get a new accident yourself. And Jerry's lived a long time too, and I think we've both been lucky. No, I don't have any secrets. That I think I would have lived a long time if I'd lived a different life.
Any sort of wisdom, though, on what it takes to live a happy life? What are those kind of principles?
Oh yes, well, a happy life is very simple. The first rule of a happy life is low expectations. That's one you can easily arrange. And if you have unrealistic expectations, you're going to be miserable all your life. And I was good at having low expectations, and that helped me. And also, when you get reverses, if you just suck it in and cope, that helps. If you don't just fretfully stew yourself into a lot of misery. And then if there are certain behavioral rules, some of them, Rose Blumkin had quite an effect on the Berkshire culture, and she created a business with like 500 Depression dollars that became a huge business. You know what her mottos were? Always tell the truth and never lie to anybody about anything. And those are pretty good rules, and they're pretty simple. And a lot of the good rules of life are like that. They're just very simple. And do it right the first time, Lee Quinn. That's a really good rule.
I suppose we have time for one more question. It's been a year since the coronavirus pandemic came to the U.S. What have you all learned about running a business in the past year? Has there been anything that has surprised you? And what would be your best advice to someone starting a business now?
Well, I don't think I have a lot of wonderful advice about starting a business, but what we've learned in the pandemic is that we can do with a lot less travel and a lot more Zooming. And I don't think that when the pandemic is over, I don't think we're going back to just the way things were. I think we're into a lot less travel and a lot more Zooming, and I think the world is going to be quite different. A lot of the people who are doing this remote working, a lot of people are going to work 3 days a week in the office and 2 days a week at home. A lot of things are going to change. And I expect that, and I welcome it.
Well, Charlie and Jerry, this has been such an excellent shareholder Q&A, and I know our viewers really appreciate it. So we only have a few minutes left, and I was hoping maybe for the both of you, if you want to just kind of share some parting thoughts with the viewers who are watching all around the world.
Well, Jerry, we're really old, both of us. And I think both of us have done the same thing. We just suck it in and cope. We don't have any other secrets, do we, Jerry?
None. You have to be concerned about employees' lives. That's very, very important. And for example, here we must have 30 or 40 desks, and We expect many of our employees to always be at client court offices because we work with them very closely to make sure they get what they need. And so we do, as Charlie indicated, have a lot of travel, and that's been greatly curtailed. And we can't go to many offices because they're closed. And some of our technology, like e-filing, for example, the courts are closed. And we are very excited to look forward to enabling the courts to function as we know that they want to and will in the future. So you have to be a little closer to the employees' needs and desires and babysitting and all those activities that were kind of taken for granted in the past. It doesn't happen anymore. Everybody's got a different situation. Nothing is particularly obvious for everybody to do the same thing. And we have to function as an informal committee in that we have to bring our employees and our clients, staff together to work out what they already know and how we can help them do a better job and a more efficient job. So the people part has changed quite considerably. Being a small company, we're beholden to the guidelines of the county of Los Angeles and other counties. We have offices in all the major cities in California and also in Logan, Utah. And we are subject to the orders and directions of those counties, which before really didn't impact anything.
There's one thing that we're quite passionate about, and that is serving the customers who have trusted us. And we are really interested in doing a good job in Australia and in California and in all the other places where people have trusted us. You can hardly think of anything more important in life than being reliable for the people who trust you. And we're going to bust our ass to try and do a good job. And the Daily Journal shareholders will have to take whatever outcome comes from caring more about our customers than is at all common.
Charlie Munger and Jerry Salzman, I thank you so much for those nearly 2 hours of your wisdom on business, investing, and life. And I know our viewers at home appreciate it. Be well to you both, and more coming up on Yahoo Finance Live after this.
good news from the FDA regarding the Johnson & Johnson COVID-19 vaccine. This comes ahead of Friday's FDA committee meeting for final emergency use authorization. Angelique Emlani will join us with what happens next in just a few minutes. Also, National Association of Manufacturers President and CEO Jay Timmons is going to join us to discuss President Joe Biden's executive order to review supply chains for key U.S. industries. We also have Brandon Steiner from collectibleexchange.com on deck to offer us some alternative investing tips when it comes to buying signed cards and used games. We're ready to play ball with an hour to the closing bell. I'm Adam Shapiro.
And I'm Shauna Smith. Adam, taking a look at the markets right now, we're seeing a follow through of that buying action that we saw in the final hour of trading yesterday. Dow briefly crossing above 32,000 earlier this afternoon, helped by strong performance in three sectors: energy, financials, and industrials. Those three sectors leading the way today. Inside the Dow, Boeing is a big winner. That stock up nearly 7%. Followed by Chevron's a 4% gain. You can see the S&P up nearly 1% and the Nasdaq up just around 84 points, reversing earlier losses. A couple of names that we are closely watching in the final hour of trading. First up, I want to take a look at Lowe. So Lowe's was out with pretty strong quarterly results before the bell this morning. They beat on earnings per share. They beat on revenue. Revenue actually rose 27% to $20.3 billion. Same store sales, it was another impressive number from the company, up 28%. But you can see on your screen the stock under pressure, shares off just around 3% right now. A lot of that has to do with guidance. Lowe's cautioning that sales will likely decline this year following its robust growth during COVID. The stock has posted about a 30% gain over the past year. Flipping over to Fisker, it's a bit of a different story with that stock. Shares surging. It's a massive gainer in today's market's moves. Now, sales surging on news of a new deal. They reached an agreement with Foxconn. That's Apple's supplier. That's why you might be familiar with that name. Well, Foxconn is going to assemble more than 250,000 electric vehicles a year for the company. Now, assembly is expected to start in the fourth quarter of 2023. The stock hitting a new high earlier today of $23.75, trading just about $1 below that level, Adam.
Shauna, I'm keeping my eyes on right now some of the airline stocks we don't often talk about. We talk about the big four, but then there are the others: Hawaiian, SkyWest, Alaska. Bit of a mixed picture right now. Shares of Hawaiian were up 5% in the first half of trading. You can see now they're still up, but then shares of SkyWest, they've actually fallen, although they were up at the first part of the trading session. Shares of Alaska Air are up. They were up almost 2% when we started trading, but now about 1.5%. Here's what's going on. There was that Deutsche Bank note that raised their ratings from hold to buy on all of the airlines, the big legacy carriers, but also those three I just mentioned. In addition, they raised the from hold to buy Spirit Airways as well. So there's an expectation that we're going to see 1.4 million people traveling every day. This is coming from Helene Becker over at Cowen, the airline analyst, sometime after Memorial Day, which is the kickoff of the summer travel season. So there's a lot of pent-up demand to travel, a lot of expectation that the airlines are going to be the beneficiaries of that. Then there is Snap. Snap was trading up about 2% at the beginning of the trading session. It is now trading off. Just yesterday, we had the investor day in which they said they expect to grow their revenue by at least 50% annually for the next several years. That would be a significant acceleration, obviously, from what we've seen in years past. Also, Evan Spiegel, the CEO, who never sold Snap, probably a good decision, their market cap is pretty high right now, said that the gains are going to be fueled in the future by what he calls more engaging video formats and new technology such as augmented reality. So everybody's keeping an eye on Snap. But the other thing we're keeping an eye on has to do with Jerome Powell and the different situation that he has been following with the markets. Before we get to him, we want to get to Inez Ferre, who's watching the overall markets for us. Inez?
And Adam, Shauna, we are seeing the Dow right now that's up more than 400 points. In fact, we are headed towards a record close if we keep up this pace. Taking a look at some of the components on the Dow that are outperforming right now, you've got Boeing up more than 6%. Goldman Sachs also up more than 3%. Goldman Sachs hitting new highs after Wells Fargo lifted its price target on Goldman. Underperforming on the Dow, you've got Home Depot underperforming for a second day in a row. You also had those Lowe's results that Shauna was just talking about. And we're also taking a look at the semi space because this is in the green. You've got Applied Materials. It's up more than 5%. This is off of the Biden administration focusing on chip supply chains. And then looking out at the NASDAQ, the outperformer, one of the outperformers on the NASDAQ today being, of course, Tesla, more than 4%. This is after several days of declines for Tesla. Tesla, of course, also being tied to the price of Bitcoin, the movements that we've seen in Bitcoin. And just taking a look at Bitcoin right now, it's up about 5%. Shauna, Adam?
Inez, thank you. Let's check in with Brian Chung because Jay Powell was testifying for a second day on Capitol Hill. But then there was the surprise nationwide outage, which hit the Federal Reserve banking system. What can you tell us about this, Brian?
Yeah, absolutely. Well, kicking off things, I guess, with the major breaking news, I guess, that happened in the last hour. So the Federal Reserve did experience an outage in some of their key settlement systems that allow banks to essentially send funds, transfer funds to one another. Now, the Federal Reserve says that the outage began at 11:15 this morning. It lasted about 3 hours as of about a quarter after 2 p.m. Eastern time. The Fed said that the issue had been resolved and that users should have been able to get back into their settlement system just fine. But then the Fed clarified after that fact they were still in the process of getting that restarted. And it was only about 20 minutes ago that the Federal Reserve finally said that its major services like FedWire and the National Settlement Service were back online and had resumed processing their normal services. Now, the Federal Reserve has said that this was a Federal Reserve operational error, so not necessarily saying that this was a hack of any sort. That's definitely not the case based on what the Federal Reserve is saying. But again, about a 3-hour outage that essentially stopped banks and other financial services from being allowed to transfer money from one another. So definitely putting a little bit of a shadow on the chairman's testimony in the House Financial Services, which happened earlier this morning.
And Brian, speaking of that testimony, I think a lot of investors were watching. It was the second day in a row. His comments on yields got most of the attention yesterday. Anything surprising to you that we heard from Jay Powell today?
Well, not really. I mean, that's usually the case in the second day of back-to-back hearings. A lot of the same questions, a lot of the same answers from the Federal Reserve chairman. But of course, the outlook on the economy, a real major focus here. And the Federal Reserve chairman making it very clear that, at least for right now, the Federal Reserve wants to wait and see where the economy is going to go as the vaccine rollout continues. Here's what the Fed chairman said to the House Financial Services Committee this morning.
We're in a situation where the best thing we can do is get those sectors open as soon as possible. And in the meantime, give people the support they need so they can continue the lives that they've had.
And those sectors that he was referring to are obviously those high contact, oftentimes low income jobs that have been lost during the pandemic. And an interesting statistic from Lael Brainerd, a Fed governor that spoke separately this morning, the unemployment rate for the bottom quartile of US wage earners is about 23% as of January, which means that there's quite a hole to dig the economy out of, even though despite we have that 6.3% headline unemployment rate, it definitely masks the true state of job losses, especially among those that are low income.
Brian, thank you. We're going to keep talking about the Fed, however, as we move on with Leslie Falconio, UBS Global Wealth Management Senior Strategist. Thank you for joining us. And in a recent note, you talked about the 10-year yield moving sharply higher as inflation expectations decline. Help us understand what that means in the real world. And I mean the real world on every street corner other than Wall Street.
Well, I mean, what people are looking at, are in a sense real yields in terms of what your borrowing costs are, what corporations can borrow at, and what we're seeing now is this spike in nominal yields or U.S. Treasury yields, as in a good way, right? As financial conditions remain loose and the economy continues to grow, but we also have to look at what's happening with inflation expectations, or say the consumer's purchasing power. So as we've had these sort of inflation expectations rise, it is impacting what we call real yields. And one of the things that we look at in particular, and one of the things that we believe the Fed looks at, are things like the 30-year mortgage rate. Having the consumer and the not restricting the consumer is key. And when we look at what's happening to the 30-year mortgage rate that has gone up the highest in the past 3 months, that's something that we believe that not only Wall Street looks at, but obviously the consumer looks at. So when we enter this morning and we hit these rise in 10-year yields close to 1.43, it is rather eye-opening, just not only the level, but how quickly we got there.
Well, and Leslie, going off of that, you mentioned how quickly we got to the levels that we're currently seeing today. How worried then are you about a potential rate shock, or do you think some of the risk that we've been talking about over the last few weeks is slightly overblown?
I think it's a little overdone. Our opinion is the Fed does not taper this year, and we think that the 120 billion that they're buying a month, the 80 billion in treasuries, and the 40 billion in mortgage-backed securities, stays as is. And the reason that is because they don't want to see the 30-year or the 10-year treasury rate go too high. They don't want to see the mortgage rate go too high too quickly. So we do think that the move that we've seen in the past 8 weeks is much greater than what we anticipated, but we don't think this is going to be the 2013 type scenario because, again, as Powell has reiterated numerous times, yields are rising on the back of stronger growth or the expectation of stronger growth, on positive vaccine news, on the expectation that consumer demand increases during the second half. So financial conditions, what we refer to, remain relatively loose. So our expectation is not to have this large rise in interest rates much further from here, but you really need to see, not just look at the projections now, you need to look at the data. And the data, won't really be clear until the second half.
But the yields that we're seeing are still minuscule compared to what most of us grew up with or knew as adults. So what's that magic number at which point the Fed goes in to say, no, we don't want it going higher, or people in equity say, you know what, I need to go into fixed income? We're nowhere near that number.
We aren't, and you're absolutely right. And it's really difficult to say, a magic number. People have thrown around, if you want to look at things like the equity premium, maybe it's a 2% nominal 10-year treasury yield. But it really, again, depends on financial conditions. If the credit markets are doing well, if the dollar doesn't appreciate quickly, if people still have access to capital and financial conditions remain loose, then it's a healthy rise in interest rates. If we go to the point where interest rates are rising and the equity market is doing poorly, we see this widening in credit spreads, that's when the Fed might take a step back and say, okay, this could be a bit concerning, and maybe they do something such as a WAM extension or something to really mitigate that rise in rates.
All right. We look forward to you coming back and joining us again to continue this discussion about the Fed, because they're not going anywhere. Leslie Falconio is UBS's Global Wealth Management Senior Strategist. All the best to you coming up. In the next hour, President Joe Biden will sign an executive order to review supply chains for key U.S. industries. Jessica Smith has the latest on that for us from Washington, D.C.
Just around 45 minutes to go in the trading day. Dow, S&P, and Nasdaq all in positive territory, although we are off the highs of the day. The Dow briefly crossed above 32,000 earlier this afternoon. We're seeing strong performance in three sectors: energy leading the way, financials and industrials also helping propel some of the gains that we're seeing across the board today. Let's turn to the latest down in D.C. We have President Biden. He's meeting with a group of bipartisan lawmakers this afternoon to discuss supply chain issues. One of them, of course, being the current chip shortage that we've been talking about so much here at Yahoo Finance. Jessica Smith has a closer look at those discussions for us. Jess?
Yeah, Shauna, we saw President Biden briefly at the start of this meeting with the bipartisan group of lawmakers, and he talked a little bit about the vulnerabilities that we've seen in supply chains over the past year. He specifically pointed out those chips, that issue that we're dealing with right now, and then he talked about the PPE shortage that we saw at the beginning of the pandemic. So President Biden is signing an executive order today with the goal of preventing those types of situations. He's going to order a 100-day review of supply chains for semiconductors, rare earths, pharmaceuticals, and large capacity batteries. He's also going to sign a more in-depth review of 6 sectors: defense, public health, information technology, transportation, energy, and food production. Now, the goal of these reviews is to identify any potential problems in the supply chain and then be able to take steps to fix that problem, potentially get ahead of a problem. Lawmakers have been talking over the past few years about the risk of becoming too dependent on other countries like China for critical goods. So we'll see what they come up with in that meeting with the president this afternoon. And then we do expect President Biden to sign that executive order at 4:15. Adam and Shauna.
Jessica, what about unemployment benefits? I know that you spoke with Representative Richard Neal. Any insight on where we're headed with that?
Yeah, he is the chairman of the House Ways and Means Committee. So his committee wrote the provision in the relief bill that's heading through Congress right now that would extend $400 a week in that boost to unemployment benefits. It would extend those enhanced benefits through the end of August. His counterpart in the Senate, Senator Ron Wyden, wants those benefits to go an extra month, so go through the end of September. I asked Neal if he'd be open to extending the benefits, and here's what he had to say.
I think that we have to adhere to the rules of reconciliation. And I think that what the Ways and Means Committee put out and actually implemented in the CARES Act is the good mirror image that we want to create going forward. So I'm always open to the idea of improved legislation, but I think that what we did in the plan that came from the committee is pretty remarkable.
I know Senator Wyden raised the concern that they could expire in the middle of August recess, and so you have a cliff at a really bad time. What do you say to that thought process?
Well, I think that those are reasonable concerns, and if they can be addressed, we should. And at the same time, recall that I think there's a bit of a safety valve that's built into the legislation because some of the funds in other categories have not been fully expended. And recall that when we wrote the CARES Act, we were trying to buy time. And when you consider that what we did in December with the $905 billion package, some of that is yet to make its way into the economic system. So I think that I could be moved based upon a pretty accurate assessment. But I also think that it's important for us, but once we copper fasten this legislation, to go forward with it.
Would you be open to considering automatic triggers at some point for those enhanced benefits to avoid these cliffs that we see every little bit?
I think the challenge there is always one of the challenges you have in legislative life, and that is to make sure that you don't overdo it and to make sure that you don't underdo it. I think the nature of unemployment right now, given the pandemic, is considerably different than what we would believe to be conventional, largely because I think there are a lot of people on the sidelines that are itching to get back to work. And I think as the economy quickly improves this summer, that's likely to happen. I mean, most of us who follow this, when you consider that credit card debt has been paid down, that people have set aside some of this emergency money for savings. And I think as people make their way into the workforce, again, considering labor participation rates ought to be what drives the decision making.
So I'm open to talking about them. I don't know that right now, given we're on the precipice of getting this legislation done, we should do it.
Neil said he is optimistic that by the time we get to the end of August, there won't be the need for those enhanced benefits. So we will see what happens in the Senate. The House is set to vote on this bill this Friday. Adam and Shauna.
All right, Jess Smith, thanks so much for giving us that. Coming up next here on Yahoo Finance Live, good news from the FDA regarding Johnson & Johnson's single-shot vaccine. It's paving the way for approval maybe as soon as tomorrow. More on that when we come back.
We are roughly 35 minutes until the closing bell, and right now markets are in the green. We got the S&P 500, Dow and Nasdaq all trading higher. But then there's the positive news from the FDA as well regarding Johnson & Johnson's single-shot COVID vaccine. Angelique Kemlani has that, and what's on tap this Friday. Angelique?
Thanks, Adam. Yeah, so we got the FDA staff endorsing the emergency use authorization of Johnson & Johnson's single-dose COVID-19 vaccine. We know that a lot of hopes have been pinned on this one because with just one dose, it really reduces the labor intensiveness of vaccine administration and gets more people vaccinated with the doses that are shipped out. As it stands right now, we know that the vaccine efficacy has been a concern for some, looking at the difference between Moderna and Pfizer is roughly 95% and the 66% globally, 72% here in the US that Johnson & Johnson had. But a lot of experts are pointing to the fact that it is the prevention of severe disease and hospitalization that is really the key metric for looking at these vaccines and their efficacy. So that's one thing that is likely going to be a topic of discussion at Friday's Vaccine Advisory Committee. And that is the final step before the FDA actually issues the authorization. It's an all-day affair, and they're going to have lots of questions and discussions about about the actual formulation and how to distribute and administer that vaccine. We also know that with the manufacturing production, the U.S. contract for the vaccine is 100 million by June end, that's 100 million doses. Initially, they were slated to have 12 million by the end of February, but because of production slowdowns, they are only ready to release about 4 million doses as soon as that EUA arrives. Officials telling lawmakers yesterday at a House subcommittee hearing that 4 million are on tap, and officials today from the White House saying that of that 3 to 4 million, it's likely that some of it is going to go to community health centers as well as pharmacies directly, as well as the state allocation for doses. Adam.
Angeli, thank you. We're going to keep talking about this with a doctor who has quite an impressive resume. He used to work at the U.S. National Institutes of Health, also was a senior scientist and faculty member at the University of Maryland. Please welcome into the stream Dr. Farley Cleghorn, Global Health Director for Palladium. Palladium advises governments and different businesses on all kinds of issues, supply chain, health matters, and we appreciate your joining us to help us understand what happens next if we get the EUA for the Johnson & Johnson vaccine. What does it mean for all of us who are waiting to get our shot?
Well, first of all, thank you for having me. It does add to our armamentarium, that is our vaccine supply, to have another product that is relatively easier to use. As you've heard, this is a single shot, and it is what we call a vectored vaccine, an adenovirus vectored vaccine that you give one dose of. And the efficacy is 72% in the US against severe COVID. And that is actually way in excess of the benchmark that we set early on of 50%. Of course, people are comparing it to Pfizer and Moderna. The fact is, it's going to give you good impact. And the fact that it can be used as a single shot and it's stored at simple refrigerator temperatures makes it easier to use. So it can be sent out to pharmacies, to doctors' offices, to primary care providers, and to rural and under-resourced settings to make the task of delivering enough vaccine to people easier.
So, Doctor, then keeping all of that in mind, going back to the timing question of this, could this speed it up by weeks? Are we talking maybe even a couple of months? What do you think?
Well, I think, unfortunately, as you mentioned already, we are running into early production issues. That has, of course, happened with all of the vaccines that have been registered so far. As you heard, Johnson & Johnson have committed to 4 million doses by the end of this month and 100 million doses by the end of June. I think the national coordinating committees at the various levels of government will be working very hard with J&J and their vaccine subsidiary Janssen in order to make sure that there are no additional barriers to the supply chain, to remove the barriers that currently exist. And we don't have a lot of insight into what those are, but it seems to be just a matter of ramping up production.
Doctor, you brought up an issue that I think some of us refer to as vaccine envy. So let's say you're one of the people who gets the Johnson & Johnson single-shot vaccine. What do you say to those folk who might get that, but then try to go get either the Moderna or the Pfizer vaccine? Is that unnecessary? Is that dangerous?
It's completely unnecessary, and we don't have any evidence that it's dangerous yet. I'll give you an example. First, our advice is to everyone, you should take the first approved vaccine that becomes available to you. This is a bit of a random selection in that different vaccines, Moderna, Pfizer, outside of the US, AstraZeneca, now manufactured in India as Covishield. If those become available, then absolutely you should get them. There is no need to repeat vaccination with a more efficacious product. You will have good immunity from a single dose of Johnson & Johnson. And if you've had COVID before, as many people in the United States have, keep in mind that the US has had the largest impact from coronavirus in the world, meaning the highest death rate and the highest disability, meaning morbidity and mortality rates. Therefore, our objective is to get as many people vaccinated as possible. And that is something that is a logistical exercise as well as a scientific exercise of getting us more vaccines.
Well, and Dr., going off of that, it's clearly not just a U.S. problem. This is a global problem. I'm curious just to get your thoughts on the global vaccination efforts. Where do those efforts stand? And what do you think is the likely or realistic timeline for that?
Well, as you know, the only way that many countries in the world, we call them low and middle income countries, have to access vaccines is through a mechanism called COVAX. This is a partnership between the WHO, Gavi, which is the Global Alliance for Vaccines, and CEPI, which is the Coalition for Epidemic Preparedness. They are together co-managing this effort, which aims to raise funds from wealthy countries to do what is called advance purchase commitments from the very same companies that are making these vaccines, and to reserve those vaccines that they have purchased to allow countries that don't otherwise have access to vaccinate 20% of their populations. And that 20% represents frontline workers, healthcare workers, and those that are vulnerable from concomitant diseases. That 20% is an ambition. There have been many barriers, including commitments by rich countries, because rich countries are distracted by trying to vaccinate their own populations. Having said all of that, the first COVAX shipment went out yesterday, and Ghana received 600,000 doses of Covishield, which, as we mentioned earlier, is the Indian manufactured version of the AstraZeneca vaccine. And 600,000 to Ghana is a start. We expect, and they have committed, that all countries will be receiving this 20% over the course of March and April.
Dr. Farley Cleghorn is the calm in the storm. We appreciate your being here. And we should point out that he is the Global Health Director for Palladium. All the best. You want to check something that's making news right now. We're looking at shares of GameStop, which are trading up. It's GameStop, keep in mind. They're up about 50%. You saw Julia LaRoche with the Q&A with Charlie Munger, in which he referred to GameStop and some of the brokers like Robinhood. The quote was, this is a quote, "I think it's a dirty way to make money, and I think we're crazy to allow it. Nothing is free," he pointed out. Much more on all of that's coming up. But want to let you know next, VC investor Ellie Rubenstein on how her fund is helping make food options healthier and more accessible.
The COVID pandemic has brought health and well-being to the forefront. Here to talk more about that and what she's doing to invest in health and wellness, we want to bring in Ellie Rubenstein. She's the co-founder and CEO of Monetary Partners. And Ellie, it's great to speak with you again. I know that you recently led a financing round of $55 million to raise awareness for Avivo. And for some of our viewers who may not be familiar with the product, it's a probiotic for infants. My question, though, is what is it about Avivo that got your attention, and how does it fit into your overall investment strategy?
Well, first, thank you for having me back. It's nice to see you. So Monetary is an investment firm that is focused on improving human health through nutrition. And Evolve is our sixth deal to date. What excited us most about this is that the gut market has actually tripled in size, and we see the gut as the second brain. And one of the interesting things about this is you're now actually seeing a pathway about how food and biotech can merge together. My example of that would be the Aviva product. And what that means is that you have a product that is fully commercialized, it's available in consumer channels today, and it is science-backed. And that is an exciting thing for those of us that do believe in food as medicine. This specific product actually targets the newborn gut deficiency. And what that means is that if we invest in guiding the long-term health of the gut in a baby, we hopefully can prevent things later on like asthma, allergies, type 1 diabetes, or colic. And again, this is 90% proven that for babies that were born via C-section or mothers with antibiotic use, if you add the powder to the breast milk, it actually activates this B. infantis strain, which unfortunately most babies today are actually not born with. So again, by rewiring a baby's gut lining, you're actually starting to see new scientific cures that really are in the food as medicine channel. And for that, we're very grateful. One more thing about why it really...
I want to interrupt you real quick because I tried to open the link to read about Avivo, and I just want to make sure, because you do have a track record that speaks for itself favorably. But when you get to be my age, you kind of see some of these things come and go, So how forgive me, how is this not a fad, and what attracted to you as, this really is long term?
It's a great question. So I think one of the things that COVID has shined a light on is that only 12% of the U.S. is metabolically healthy. And so what we really have going on is the slow pandemic of the last 30 or 40 years, where 50% of this population does today have diabetes, hypertension, or obesity. And again, when you're looking at how you can start to take dollars that are spent on healthcare into prevention, the cost to states today to feed this, sick population, $11,100. And when we started looking at that from a healthcare standpoint, we said, where are the sound science where maybe if we could bring in consumer awareness, we actually can restore some of this, healthcare needs later on. And I think that one of the things that's so fascinating about a baby in this gut health area is that the science was what allowed us to back this. Again, Cargill Health Sciences, we led this deal. There are other investors in the deal, including the Gates Foundation and Johnson & Johnson. And what we saw was Monetary, given our consumer awareness and relatability that 6 out of 10 of us are women. We have 3 newborn babies in our firm that are actually using the product. And it's pretty transformative to be able to give a new parent a product where they can add it to breast milk and the baby doesn't cry. And more so, you're knowing it's prevention. So I think that that's the shift you're going to see is now this is about prevention and using food in order to do that.
Ellie, unfortunately, we're short on time, so we have to end it there. But we look forward to having you back again soon and speaking with you more about your other various investments. But Ellie Rubenstein, co-founder and CEO of Monetary Partners, thank you so much for joining us today on Yahoo Finance. Coming up next year after the break, the Dow soaring to a new record, crossing above 32,000 for the first time. We'll take a closer look at today's moves when we come back.
George C. is the CEO at Annandale Capital. He's joining us now because we were talking earlier about the 10-year yield hitting. It's now almost at 1.4%. You say it's going to be in a range up to 1.5%. Dare I ask, what happens to Jane and Joe Main Street if it crosses 1.5%? Any big deal?
Well, that's the pointed question of the moment. In fact, we were just talking about that among my team at lunch today, and I saw you had my buddy Ellie Rubenstein on right before me. So you're running with good people on this program, so I'm glad to be in the mix on that. I actually think the 10-year is going to go above 150. I don't know on what time frame, but I think it's not it doesn't require a whole lot of mental gymnastics to get you well over 150, and eventually that's going to really disrupt growth stocks. But I think the growth rate on the economy is going to be so intense this year because of this burst of activity post-pandemic that I don't think it'll derail the stock market immediately, but it is a very, very serious threat to multiples over the next 2 to 3 years. And I think we're going to pay a price for that eventually. I think we're going over 2 at some point. I don't know if that's this year or next year or the year after, but I think it's coming.
So, George, with that in mind, then, is it time to de-risk your portfolio? And I guess where would you suggest that investors invest at this point?
Yeah, we don't have good solutions for alternatives to investment-grade fixed income, to be plain. I just don't think that if you want an equivalent amount of risk, there's just not very many good options out there. You could look at midstream oil and gas pipeline companies. You can look at REITs. You can look at some private equity funding solutions that are on the debt side, and you can earn, on paper at least, a much higher yield than you would through investment grade paper or U.S. governments. But the problem is they're also much riskier. So we're going to shift about a quarter to a third of our fixed income portfolio into things like that, just to pick up a little extra yield. But we're going to give full disclosure and have our clients going eyes wide open that they're increasing their risk levels by doing that. There's no equivalent pari passu trade-off.
George, there are people talking about $100 oil again. So, some people will be looking at energy. But I got to ask you, when we get above 2% on the 10-year, this easy money has allowed a lot of companies that are on the gurney to stay alive when they should be dead, put a fork in it. Do you think there's going to be a lot of pain when that starts to happen?
I don't. I think that so much money has been raised that I think a lot of what I would call, like you said, cadaver businesses that really should be in the grave and not walking around still will continue to walk around. I think there's just so much debt money out there, and until that debt comes due in 4, 5, 6, 7 years, whatever the maturity date is, they're going to keep walking around. And you look at all the money being raised by SPACs and even some IPOs. Look at Bumble the other day, trading at over a $10 billion valuation for a company that barely makes any money. I think there's just too much money out there for there to be a whole lot of pain and agony. That will come in time, just like there will be a price to pay for all this federal debt we're running up at the same time. But it's a process. It's not an event, and we're just not. It's going to take time before really bad things happen. It's just not going to happen anytime soon. There's just too much euphoria. And there's too much liquidity out there. The liquidity is overwhelming, both at the governmental level and at the private company level.
George, I got to tell you, that old line from the 1980s, but wait, there's more, because you brought up SPACs and Charlie Munger. George C. But really, don't go anywhere, because wait, there's more. Charlie Munger, he says the GameStop trading frenzy is like horse race betting. He had some choice words, not polite. We're going to hear from Warren Buffett's right-hand man about that right after this.
GameStop shares, they are soaring this afternoon following comments from Charlie Munger. Taking a look, the stock has actually been halted right now. Shares soaring just around 103% before it was halted. Now, Munger, you probably know him as Warren Buffett's longtime business partner. Well, he's also the chairman of Daily Journal, and he was speaking at Daily Journal's annual meeting earlier this afternoon. Now, let's listen to what he had to say when he was asked about GameStop's short squeeze.
Well, it certainly does, and that's the kind of thing that can happen when you get a whole lot of people who are using liquid stock markets to gamble the way they would in betting on racehorses. And that's what we have going in the stock market. And the frenzy is fed by people who are getting commissions and other revenues out of this new bunch of gamblers. And of course, when things get extreme, you have things like that short squeeze. It's not generally noticed by the public, but clearinghouses clear all these trades. And when things get as crazy as they were in the event you're talking about, there are threats of clearinghouse failure. So it gets very dangerous. And it's really stupid to have a culture which encourages as much gambling in stocks by people who have the mindset of racetrack bettors. And of course it's going to create trouble, as it did. And I have a very simple idea on this subject. I think you should try and make your money in this world by selling other people things that are good for them. And if you're selling them gambling services where you rake profits off the top, like many of these new brokers who specialize in luring the gamblers in, I think it's a dirty way to make money, and I think that we're crazy to allow it.
More on this, we want to bring in Yahoo Finance Editor-in-Chief Andy Serwer. He jumped on to discuss the comments that we just heard from Charlie Munger. And Andy, I'm curious just to get your thoughts. We just heard Charlie Munger, the description that he laid out there for us, saying that the short squeeze reflects a horse racing mentality when it comes to stocks.
Charlie, what's your real opinion? I mean, never minces words, Shauna, at all. And, what's interesting to me, though, actually, is that many of the investors in GameStop actually agree with Munger. The Wall Street credit saying this is not an investment. This is just betting and gambling, and they acknowledge the facts. So this is not something that's going to make some of those investors get all hot and bothered. They acknowledge that, this is something
Andy.
they're trying to
Andy, I apologize for interrupting you. We're having some kind of technical issue and your audio is getting jumbled. We're going to try to fix that. But it really is remarkable, Shauna, when you consider someone as respected as Charlie Munger. He made the point that the world should be about selling good products to people that they need. And he didn't say Robinhood. He didn't say the free platforms on which people are trading. But when he referred to that as a dirty way to make money, that's not the exact quote, but he did say dirty money. I was sitting there watching Julia LaRoche, who was handling the Q&A on this thing, and I was like, oh, wow, that's going to resonate.
Yeah, and like Andy was saying there, I mean, he's not really one to mess up his words, and he's very poignant. He really gets to the point, says exactly how he feels most of the time. So I don't think it was surprising necessarily that he did share exactly how he feels, but some of those words that he used, I think, were a little bit interesting, at least. And Adam, it wasn't just about GameStop, and it wasn't just about the trading apps either. He also talked about SPACs, and he was calling out the surge in SPACs. And when he was talking about this, he was saying that he doesn't necessarily think that they are a great investment. He says that he thinks that this kind of crazy speculation in enterprise is not even found or picked out yet is a sign of an irritating bubble. And this is something, Adam, that you and I have discussed many times here with a number of our guests on Yahoo Finance, just about the rise in SPACs and whether or not it could potentially be a bubble and whether or not investors should be aware of some of the risk associated with them. Well, we're going to take a quick break because we have just around 5 minutes to go until the closing bell. We're back with that in just 2 minutes. About 2.5 minutes until the closing bell, we want to bring in Matthew Lazzetti. He's Deutsche Bank's chief U.S. economist. We're also joined by Doug Sandler. He's head of global strategy with Riverfront Investment Group. Great to have you both on. Doug, let me just start with you. The buying action that we're seeing today, Dow up just around 450 points into the close. What do you make of the price action that we're seeing?
I think we got that pullback that people were waiting for. And I think pullbacks in this day and age are going to be sort of 3 to 5%. We had that. We got the reinforcement by the Fed today, which is what I think has been the loud and clear signal really since 2009, which was they have the investors back. And Jay Powell reiterated that today and yesterday. So no reason to kind of be on the sidelines. And I think that resonates today with investors.
All right, Matthew and Doug, stand by. We want to bring in Inez Ferre because we are in, at least on the Dow, record territory, and plus oil at $63 a barrel. Take it away to the closing bell, Inez.
That's right. We are on set for a record close for the Dow. We are watching GameStop, which was halted for volatility twice this afternoon, up 103%. In fact, some of the heavily shorted stocks are up as well, double-digit percentages, Cost and Express and AMC as well. Redditors have been discussing the exit of CFO Jim Bell that may have something to do with the movement on GameStop, the sudden movement that we've seen, actually the biggest intraday movement in almost 3 weeks. Taking a look at the Dow, where we've been seeing the biggest gains today, we're watching Boeing up more than 8%. We're also seeing Goldman Sachs up 3.5%. Goldman Sachs touching new highs after Wells Fargo lifted its price target on the bank. We're seeing Home Depot down more than 2.5%. Its second day of losses. Lowe's also reported its quarterly results today. Lowe's was under pressure. And then we're also taking a look at the semi space, which is in the green today. NVIDIA will be reporting its quarterly results, up more than 2%. Applied Materials up more than 5%. A lot of this has to do with the Biden administration's focus on chip supply chains, and that's why you're seeing the semi space higher as well. Here's the closing bell.
Shaken, not stirred, a closing bell that sees us closing on the markets. We're going to settle roughly. The Dow is going to be up 424 points. The S&P 500 is going to be up roughly 40 points. And the Nasdaq is going to be up 132 points. Again, the Dow crossed 32,000 today. Also, sectors, want to mention, as was pointing out, energy sector up 3.5%. Oil at $63 a barrel. I want to bring back our guests and hit you with this, Matthew, because you are Deutsche Bank's chief U.S. economist, been quoting Deutsche Bank research in my most recent articles on airlines. But I got to ask you, oil at $63 and going higher, does that threaten the recovery in the United States or globally?
No, I don't think so at all. I think it's reflecting a pickup in demand that we're expecting to see. We just recently upgraded our U.S. growth forecast to 7.5% this year, expecting that you get a fiscal stimulus package around 1.6 or 1.7 trillion. I don't think that rising oil prices, rising gasoline prices are going to undermine that. We see households with very high savings rates. They're going to get a further fiscal infusion in the coming months. As the economy reopens, we'll be adding robustly new jobs to the economy. And I don't think that that's going to be undermined simply by the move higher in oil that we've seen recently.
Well, Matthew, what about what we're seeing going on in the jobs market? Because that's one area of the economy that has started to lag a little bit. When you take a look at some of the numbers that we've gotten in recent weeks when it comes to jobless claims, the number that we're expecting to get tomorrow still above 800,000. Does that cause you any concern?
The jobless claims data has definitely been the one area of disappointment and concern that we've seen recently. Now, there's been difficulties when interpreting that data, certainly with seasonal adjustment issues, some backlogs that we've seen. And so I think it's less reliable of an indicator of the real-time economy and labor market than we've seen in the past. I think really notably, last week in the monetary policy report that the Fed put out, they showed some high-frequency data for the employment side, and it actually began to rebound pretty meaningfully in late January and then early February. I think really as the economy begins to reopen more, as vaccines continue apace, and as this fiscal stimulus comes online, we will be seeing substantially better jobs data over the next several months.
Doug, you were a bouncer at a nightclub. I was the 16-year-old with the fake ID that said I was 78, not a good idea. Help me understand, because that was bad then, why bonds, I think you said bonds are still attractive with 18 trillion in negative yielding debt. Why is that a good idea?
Well, actually, the sort of bouncer analogy was that the guest list for the market party in 2021 is going to be a lot more inclusive than the guest list for 2020. Bonds, I'm not a big fan of. If we had to sort of rank asset classes, I'd have U.S. equity at the top. I'd have emerging markets as number 2. The rest of the developed international space at number 3. And a distant 4th would be bonds. I think if you have to own bonds, I think U.S. investment grade would be the way to go, because you are getting a pickup. You're sort of keeping up with inflation. And at the end of the day, all other bonds look even worse.
Matthew, I want to get your thoughts on the consumer, because it's interesting what we've seen when we take a look at the data that we've gotten over the last several months. Because when you take a look at it, the consumer's outlook on the economy has pretty much been flat, that consumer confidence number that we just got out. But when you take a look at what the market is anticipating, what investors are anticipating, that part of the equation has improved dramatically. How are you balancing that?
Yeah, I think that it's a really difficult balancing act, and it's certainly a difficult balancing act from the Fed's perspective. The comments that we got from Chair Powell over the past 2 days, Vice Chair Clarida today, Governor Brainerd, all skewed to the dovish side, noting that we haven't seen all that much progress in the labor market recently. We've had some mixed data, even though they did note that in the future we may be able to pick up in terms of economic activity. From our perspective, the weakness that we saw in the data and in Q4, particularly with retail sales, was to be expected in an economy that was seeing the largest wave for the COVID shock. Hospitalizations were hitting peaks. We saw a return of these restrictions that took place, and it just very naturally, I think, impacted consumer spending. I think we have a very different dynamic over the next several months. We have, again, additional fiscal stimulus coming online. We've seen the COVID wave receding, vaccines picking up, reopening is going to pick up. And all of that, I think, should lead to a very supportive dynamic for consumer spending over the rest of the year.
All right, we want to get to some breaking news. We have earnings results out from Booking Holdings. Emily McCormick has the numbers for us. Emily?
Sean, we're taking a look here at Booking Holdings actually beating expectations just slightly on the top line for fourth quarter results, but still posting massive year-over-year declines as we've seen the coronavirus pandemic continue to exert pressure on the travel industry. Now, we saw fourth quarter revenue coming in at $1.24 billion. That was just modestly above the $1.2 billion that had been expected, and that figure was down 63% year over year. And this is the fourth straight quarter that we've seen those year-over-year declines in sales for Booking Holdings. Now, on the bottom line, we had adjusted EBITDA losses coming in at $38 million. That was narrower than the losses of $41.7 million that had been expected, but again, swinging to a quarterly loss from a profit in the year ago period. Now, I want to highlight some comments here from CEO Glenn Fogel. He said, quote, "The travel environment continued to be challenging through the fourth quarter of 2020 and into January 2021 as COVID-19 case counts remained very high and travel restrictions were reimposed in many parts of the world. However, in recent weeks, we have started to see some improvements in booking trends that we will continue to monitor. Looking ahead, I am more confident than ever in our long-term future and in the eventual strong recovery of travel demand," end quote. Now, taking a look here at these shares, we are seeing them popping by about 2.8% in late trading. So getting a bit of a pop here with that top and bottom line beat. Shauna and Adam.
Emily, thank you. I want to go back to Doug. Given what we're seeing with pent-up demand, are the travel-related stocks danger zone right now? Because we keep hearing analysts say they're undervalued, and now's the time to consider adding them to your portfolio.
Well, I think that was a great example, which is they've had a tough time, but everybody you talk to, I talked to somebody today, he said, I just got my vaccine and I'm getting on a plane. And I'm not just getting on a plane, but I'm going to do that splurge vacation that really makes up for the 2 or 3 vacations I skipped in 2020. So I think you're going to see a massive sort of pent-up demand in the travel and entertainment business. I think people are going to go to restaurants, they're going to take their friends to restaurants, and they're going to have sort of those blowout trips that they've been saving up for and thinking about for the last 12 months. So my guess is the industry comes back maybe a little more quickly than people think.
Matthew, you mentioned the fact that you raised your GDP forecast for the year. When it comes to getting back to those pre-pandemic levels, though, and pretty consistently, how long do you expect that to take?
So I would make a very big difference between economic activity and GDP and the labor market. We think you get back to pre-virus levels for GDP by next quarter, Q2. And in fact, with this fiscal stimulus, 1.6 to 1.7 trillion that we've built in, we think you get back to even the pre-virus growth path by late this year and into 2022, which is, I think, really a remarkable development given where we were just 6 months ago or so. I would contrast that with the labor market. You know, prior to COVID, we had a 3.5% unemployment rate, the lowest level in 50 years. It's going to take longer to get back to those types of unemployment readings. We think that's probably unlikely until the end of 2022. So there is this very different timeline, I think, for economic activity, consumer spending, GDP to recover, and a longer path to recovery for the labor market.
Matthew Lozzetti, Deutsche Bank's chief U.S. economist, and Doug Sandler, Riverfront Investment Group's head of global strategy. Thanks to you both for joining us today. Coming up next, National Association of Manufacturers President and CEO Jay Timmons. He will join us to discuss President Biden's executive order to review supply chains for key U.S. industries. We're back in just 2 minutes.
President Biden meeting with executives from some of the largest businesses in the United States to discuss the supply chain. We want to bring in Jessica Smith and the problem some of these businesses are having. We know the story about chips and automakers, but it's more than just that, right?
Yeah, this executive order is looking at several other areas as well. President Biden today referenced the PPE shortage that we saw at the beginning of the pandemic. He said that was an example of something that he doesn't want to see happen again. So this executive order is ordering a 100-day review of several of supply chains for key goods like semiconductors, rare earths, pharmaceuticals, and large capacity batteries. The administration says the president will also order a more in-depth review of 6 sectors That's defense, public health, information technology, transportation, energy, and food production. The goal is to review all of these areas and then find potential problems and come up with solutions to make sure that these supply chains are not vulnerable in the future. President Biden and the vice president did meet with lawmakers a short time ago, Republicans and Democrats alike. And we did hear from one of the Republicans who was in that meeting, Senator John Cornyn. He said that the president was very receptive, as was the vice president. He said, "We're all in. We understand this is important not only to our economy, but also our national security." So it sounds like they were able to at least agree on some of the problems that exist right now. We'll see what kind of solutions they may come up with in the weeks ahead. Adam and Shauna.
I also want to get your thoughts just on a number of CEOs. I believe it's over 150 CEOs or executives calling on Congress to pass the relief bill. What are the details of that?
Yeah, more than 150 CEOs are calling on Congress. They wrote this letter to congressional leaders today saying that there needs to be a bill, a relief bill, modeled after President Biden's $1.9 trillion plan. The CEOs on this letter include the CEOs of Google, Goldman, Lyft, Blackstone, Wells Fargo, many, many others. The letter said that previous relief packages have been essential, but more is needed to make sure the recovery is strong and durable. The House is getting ready to vote on this legislation on Friday. And then if it does pass, as we expect it to, it'll move on to the Senate.
Jessica, thank you. We want to bring into the stream to talk about all of this Jay Timmons. He is the National Association of Manufacturers President and CEO. Jay, it's good to see you again. Very simply, what do you think? What do you think of what the president's done? Good, bad? What should we make of this?
Well, in general, I think the president is off to an extraordinarily strong start, and he's done a lot to heal our nation. I thought his remarks Monday night were heartfelt and poignant in front of at the White House, marking the occasion of 500,000 COVID deaths. For those of us who have lost loved ones, it was a compassionate and empathetic gesture that I think we've all missed. So I see the president really changing the tone and moving forward to kind of help us create that next world that will emerge after the pandemic. There are a few issues, obviously, that we have some concerns with, but overall, we're very pleased that the president is focusing on getting America's health back, getting the world's health back, and rebuilding our economy.
Jay, I want to get your thoughts just on the executive order that we're expecting President Biden to sign any minute right now. I know you've been very vocal just on how to strengthen manufacturing when it comes to the supply chain issues that we've seen over the last year. When it comes to chips specifically, or some of the other issues that we're currently seeing right now throughout the U.S., have you had any conversations with the president on how to address this? And I guess, what advice would you have?
Yeah, so we have had conversations with the Biden team, stretching all the way back to the transition. We put forward a plan last, I believe, August, strengthening America's manufacturing supply chain. And the goals of that document and that policy proposal were exactly what this president is talking about, ensuring that we are looking out for our economic and national security by strengthening and hardening those supply chains here in the United States. Look, I represent manufacturing in America. I want to see everything made in this country when it's possible. It's not always possible, but we can do better. And before the pandemic hit, you saw the results of a lot of policies that had been put into place, competitiveness policies that allowed manufacturers to invest and hire and raise wages and benefits right here in the United States. We want to grow that to even higher levels, and I'm pleased that the president's focused on this imperative.
Jay, but what are you hearing, for instance, when we talk about chip shortages and car manufacturers, GM, Ford having to slow down? I think a lot of us get worried, demand is high, prices are going to go up because they can't make all of the vehicles they want to make. You know, what are you hearing from the manufacturers? Are we going to have to pay more for stuff, or is this executive order going to help?
Well, look, I think you all used it in the intro to this. You used the term solution. Manufacturers always want to be the solution. That's what we do. we tackle tough problems, and when we have a situation where we do have high demand and less supply, there could be impacts on prices. But the goal would be obviously not to do that, because we want to be able to sell more of our manufactured goods to more people. So the key is, I think, and I'm glad the president is focusing on a lot of these issues. Chips is clearly an issue that has caused a lot of consternation. Medical supplies, another huge area of concern. We were engaged for the first 6 months of the pandemic just trying to find PPE anywhere we could in the world and get it to those hot zones around the country. So the focus on strengthening our manufacturing supply chain, I think, is exactly the right thing to do. And we're all in for that.
Can you give us any insight? I think we're getting the durable goods number tomorrow. What are you hearing from the manufacturers about demand for just about everything?
Well, demand is going. Your previous segment had a discussion about the demand for travel. I think there's a lot of pent-up demand right now in our economy. There's a lot of pent-up demand by people just wanting to get out. I'm actually in my office for the first time. You can see behind my shoulder. For the first time in an entire year, and it's almost like the aftermath of a nuclear war, right? I mean, it's completely silent here. I'm the only one here, and suddenly I have all these feelings rushing back about the things that we've missed over the last year. I'm one of 300 and however many million Americans are having the same feelings or wanting to get back into some sense of normalcy. I don't think we'll ever see normalcy again, Adam, like we knew it, but we will be building the next world. And what that looks like, I think, is really, it's limited only by our imaginations. And manufacturers will be front and center in helping us do exactly that. So yes, we can look at what is front and center to us today in terms of durable goods numbers or supply and demand. But ultimately, we're going to have to be looking to the future. I think that's what the Biden administration is doing. I think that we're looking at the COVID rescue package that they put forward, which, I'm pleased that the administration is focused on that. Hope there's a bipartisan effort to get something done. But next will be the rescue plan the recovery plan that they put forward.
Jay Timmons is the National Association of Manufacturers CEO and President. We appreciate your being here. So many of us purchase the products that your members make here in the United States. Coming up, it's next gen tech for our autonomous driving world. Neural Propulsion CEO on why their new system will take AV to the next level. That's after this break.
Taking a look at the technology that enables autonomous driving today, Neural Propulsion Systems has launched NPS 500. It's what they say is the safest and most reliable sensing platform for autonomous vehicles. We want to talk more about this with Behrooz Rezvani. He is NPS's founder and CEO. And Behrooz, great to have you on the program. Thank you so much for joining us. Congratulations on the rollout of this new product today. You say, your company says that it will enable the industry to reach zero accidents vision. How does this differ from what's already available in some of the other products that are out on the market right now?
Right. Like most companies today, they focused on level 2 autonomy, which, in those paradigm, people expect the driver to pick up, to jump and take over the driving. In the level 4, level 5, which we don't expect the driver to participate, we need, in that scenario, we need to be a lot more safer, have more time for the autonomous system to react. And in those kind of models, we extend the range from, for example, 250-meter sensor range to 500 meters. We were able to increase the adaptivity to scenes a lot more, and also we are able to see around corners, which is not done before.
So how will this change for those of us who are just regular drivers? If we don't want to go autonomous, without naming the automakers who might start implementing this, it could go in both kinds of systems. And I've got to imagine they're eager to get their hands on this.
Right. I think, as you pointed out, there is a growth for, there is a need for level 4, level 5. We've seen people are going to robo-taxis first and autonomous trucks, and we'll see shuttles that are going to take over a lot of the transportation. So the next gen would be the OEMs, manufacturer tier 1, that they would take over to want to bring their car into the market with full autonomy. Right now, there is no full autonomy. What we see is really level 2, which the driver is still responsible.
Behrooz, when we look 5 years, 3 to 5 years down the road, how big of an addressable market do you think you're looking at for this?
On the sensor fusion, which includes radar, LiDAR, cameras, your development, for example, predict a $25 billion market in 25. So it's pretty big. We expect that to grow to probably $50 to $60 billion by 2030.
Are there implications outside of just traditional vehicles? I mean, this kind of technology has got to be greater than just what we're discussing, the uses.
I mean, I think, as you know, it impacts a lot of stuff. For example, insurance paradigm, delivery in 24/7 of goods, especially post-pandemic. So I think the impact would be significant. I think we're going to see a change of behavior that we had not anticipated 5 years ago.
I need to bring up the fact that Tesla doesn't use this technology. And I think that's very interesting, because I think when a lot of people think of who is on the forefront of this, who's on the forefront of autonomous vehicles, a lot of people associate that with Tesla. Why do you think this is the case?
Well, they have Elon Musk. I mean, he is a brilliant marketeer and engineer. And so I believe he's been really driving and pushing the envelope for this technology to come to fruition. Right now, Tesla models level 2 plus, still the driver is responsible to take over at any time. And so I think from that perspective, he has fired the base, but they're still not there, obviously.
This gets to my question, though, about other uses. And when you live in a big city, Chicago, Los Angeles, San Francisco, New York, just walking is pretty dangerous. Would there ever be a pocket version of this technology that would alert people not driving about the bicyclist who's barreling down and about to run the light around the corner? That's what I'm getting at.
That's actually possible. It's in a different format. It would be like a network of cellular technology that could track you very accurately using GPS or GNSS to indicate where everyone is. So it is possible, and I think it could come into fruition.
There is Rezvani. Great to have you on the show. Congratulations on this new product that you're rolling out today. MPS's CEO and founder. Coming up, we're going to talk about collectibleexchange.com, giving us some alternative investment tips and why the memorabilia trade is red hot right now. We're back in just 2 minutes.
Emily McCormick standing by with earnings from NVIDIA. Tell us about it.
Adam, we're taking a look here at NVIDIA shares popping in late trading after the company reported record fourth quarter revenue. That coming in at $5 billion, up 61% year over year, and well ahead of consensus estimates for $4.82 billion in revenue. Now, taking a look beneath that headline, we also saw gaming revenue as well as data center revenue coming in at quarterly records, respectively, on both of those measures. Gaming revenue of $2.5 billion and data center revenue of $1.9 billion. Now, also want to highlight that we saw strong current quarter guidance on the top line for NVIDIA. The company saying for the first quarter of fiscal 2022, it expects revenue to be $5.3 billion, plus or minus 2%. That's also ahead of the $4.8 billion that had been expected. And then taking a look at these reported bottom line results, we did get adjusted earnings per share of $3.10, handily beating estimates for $2.81. Now, I want to highlight here that NVIDIA has been a beneficiary of the stay-at-home phenomena, as the need for more computers and other devices that need chips, as well as data centers, have really helped this stock. Also possible that NVIDIA could get and already has received a boost from cryptocurrency mining and the need for chips and data centers for those services. Now, on the other hand, we do know that there has been a global chip shortage. This isn't something that NVIDIA addressed in its earnings press release, but likely something that will appear on the earnings call later this afternoon. But for now, we are seeing shares of NVIDIA, again, trading higher on the back of these results. Shauna and Adam.
Emily, thank you very much. Want to talk to you about alternative investments, especially when it comes to sports memorabilia. That business, nobody knows it better than Brandon Steiner. He is the founder of collectibleexchange.com, and he's a also the founder of Steiner Sports. Want to ask you a quick question because I know you've got your winter auction coming up. This is going to sound macabre and impolite, but people are thinking it. When we get tragic news like what happened yesterday with Tiger Woods, and thank God he's going to recover from this, do you get a spike in the memorabilia tied to a star when there is an auto accident, that kind of thing?
You do sometimes. We didn't get that with Tiger because he still hasn't recovered from some of the other stuff that he's been through over the past, bunch of years. So from a collectability standpoint, even though he has come back and played competitively and done well, he's not somebody that people are quickly putting on their wall and collecting like they were previous when he had all these problems with drugs, drinking, the accident, the wife, and all the other stuff that the problems that occurred. So, yeah, listen, when athletes and celebrities die, like when Kobe passed away, that tragic situation, his autograph spiked dramatically. And then sometimes with somebody like Tiger, there was no spike, frankly, at all, because his situation from a licensing and collectability is flat, period.
Well, then, Brandon, so then who are the top athletes right now just in terms of memorabilia? Because I think that would be interesting because from my understanding, it's not always who is currently involved and who is currently still playing.
Well, it's interesting, like on Collectible Exchange, my new platform is 50,000 items that people are buying and selling. What I wanted to say was the Last Dance definitely pushed the NBA and those athletes that played in the 90s. It definitely pushed it up a notch. So you're seeing a lot of Charles Barkley, Dennis Rodman, all those guys that played with him or against him, Karl Malone, are a lot hotter. And obviously Michael Jordan is leading the way. And it's a very unusual circumstance. What I'm concerned with, and I see people coming on my site looking for all these great trading cards and all these collectibles, I don't want people to get too caught up with the bubble because I think the market is a little bit ahead of itself or a lot of it ahead of itself, doesn't have any regulation. I want buyers to beware. Like on our auction right now, we have incredible stuff, but you see stuff that's just going through the roof. We have a lot of game used. And to answer your question, the game used stuff is really getting a premium right now. People are loving it. Game used jerseys, game used footballs in the game that a player may have gotten at the end of a game, now selling it. You see a Derek Jeter glove. That's a $30,000, $35,000 glove. He only gave away maybe 4 or 5 his entire career. We happen to do all his collectibles in my old company. My new company, I'm happy to go resell some of the stuff that I sold to begin with. So the Jordan stuff is really hot. We're seeing a lot of NFL quarterbacks are hot, but maybe the bubble like a Tom Brady, who are people paying a super premium because he's hot. Cool to buy it, but don't be prepared maybe not to get all your money back when you want to sell it because it's way, way overinflated, and he has signed tens of thousands of autographs. You buy a Joe Montana helmet, he's signed over 1 million autographs. It's a great item, he's Joe Montana, but you're probably not going to get your money back. We see people coming here, bringing Collectible Exchange their collections, which we do buy and sell, and they're not getting their money back on a bunch of items because they overpaid.
Brandon, I'm going to have my brother call you because he's got a Dan Marino football, but I'm worried he signed 1 million of them. Let me ask you, though, it's not just the sports stuff because you've got like Beatles icons in the current auction. Yeah. I think it's a baseball signed by Sir Paul McCartney and then a drumstick, signed by Ringo Starr.
Yeah.
How much will these
Bill
go for?
Clinton baseball. If you look on there, I mean, there is a pristine Bill Clinton. I mean, you can see Bill Clinton stuff out there, but this is a perfect autograph. I mean, it's unbelievable. And you don't see a lot of Beatles stuff out there. Those guys did not sign a lot of autographs. Very hard to find. So we're really grateful to have that in the auction. This is a crazy auction. There's just a wide variety of things. Even if you're not a bidder, go to BidCX and just take a walk through memory lane. It's a really entertaining couple hours or hour of your time. It's that kind of auction. Also, I'm a Syracuse grad, so I put in a collection of a whole bunch of Syracuse stuff from all the great Syracuse players. So if you're a part of Syracuse Nation out there, you'll love the auction on Collectible Exchange. It's pretty cool. The business is really booming now because people are home. And what's great is you see a lot of people parting with their collections. And what's gratifying is you see a lot of younger people now interested in buying this stuff, which is always a concern of mine, having been in the business 35 years. Are the young kids going to be into it? Like, I know my son, he's like that. I've had enough of collectibles. But I'm glad I'm not gauging the business after him because a lot of the young kids are now doing it with their parents, collecting cards and collecting all kinds of products. I'll tell you one thing, by the way.
Yeah.
I haven't mentioned this to anyone, so this is the first time I'm mentioning it. I'm selling my collection. You'll be able to go on the site and see the preview in about a week. And I've been collecting for 40 years of stuff, since I'm 20. So and it's a pretty big collection. It's extremely very rare rogue stuff. So if you're really a collectible and you've collected Steiner in the past, you may want to go take a look at this collection. Well, it goes all the way back to Mickey Mantle and everything else.
Yeah, Mickey Mantle will get a lot of cash. I got to tell you, Syracuse 83 to 87. And I remember being in the Dome back when the Orange would take on Georgetown and Patrick Ewing. I don't know if I was there when you were there, but
I was there. I graduated in 81, but Georgetown, we don't really that's not really an actual school that actually exists. But by the way, I took the Dome off of the roof. They have now have a roof there. I took the Dome, and if you go on my website, you'll see all these cool products that we made out of the Dome. Right now, we're actually printing people's diplomas on the Dome if you graduated with the Dome. My graduating class was the first year of the Dome, and Coach Boeheim's been very generous in signing a lot of products. We've sold, there's probably about 80 or 100 different SKUs we've made with the Dome, pictures of the Dome that we've printed on the Dome. So if you're a big Cuse fan, you'll love this auction, or just pick up a piece of the Dome.
Sure. That useless trivia, the sound in Star Wars of the lasers was stamping your foot in between the columns on the outside of the Carrier Dome at Syracuse. I got to let you go, fellow Orangeman there, Brandon Steiner.
Well, thank you. Thanks for having me. I appreciate it. And
thank you.
I hope
we
you
can't
get, I hope you go. I'm looking for your name
inside the Dome when we would play Georgetown, the team that we won't mention. We'll be right back after this.
Time for your news on the move. Tiger Woods is awake, responsive, and recovering in his hospital room after undergoing major surgery following the car crash that we talked about yesterday in Los Angeles. It happened yesterday morning. Now, this is all according to a statement on his Twitter account. From what we know, doctors have placed a rod into the tibia of Woods' right leg and used a combination of screws and pins to stabilize his ankle and foot. Federal prosecutors in New Jersey have dropped drunk driving charges against Bruce Springsteen after a test show that his blood alcohol level was under the legal limit. Now, Springsteen was, however, fined after pleading guilty for consuming alcohol in a closed area. And Postmaster General Louis DeJoy apologizing at a House hearing for mail delivery delays over the peak holiday season. Now, DeJoy, who is facing calls from Democrats to resign, pledged that the Postal Service will, quote, strive to do better. Let's turn to the hotel industry. Following the death of longtime Marriott CEO Arne Sorensen, now the hotel chain named 25-year company veteran Tony Capilano as the next chief executive. Now, Capilano joined Yahoo Finance earlier today to discuss the company's outlook amid the pandemic and also how he felt to receive the call that he be succeeding Sorensen. Let's listen to what he had to say.
To state the obvious, it was humbling, but also energizing. If Arne were here, he would tell us to continue to move forward. And I think our associates, our customers, our guests around the world, they are anxious to help us achieve the sort of recovery that they hope for. As you and I have discussed, people are anxious to get back on the road. And part of my new responsibilities is to do everything we can to ensure that guests feel safe and feel confident as they start to travel again.
You know, I think a lot of people would still be surprised that Mr. Marriott, he's still at the company, he's the executive chairman. Have you had a chance to talk to him, and what has he told you about assuming this position?
Well, your first question, I think I've spoken to him a dozen times in the last 2 days. He is a very engaged chairman. He loves this company, and he is an extraordinary role model in terms of continuing to carry the Marriott culture forward. And I think that's been his principal message, that this company has thrived for nearly a century, and the fundamental foundation underpinning that success is this notion of putting people first, of taking care of our associates around the world. And he has encouraged me to adopt my own leadership style, but through the lens of that culture, which is really the company's true north.
You had a chance to really work with Arne hand in glove for many years. How did he help prepare you for this position?
Well, you're right, and it was a profound privilege for me. There are so many wonderful attributes that Arne had as a person, as you pointed out, and certainly as an executive and a leader. I think authenticity is an attribute that comes to mind. As Arne met folks, whether they were partners, associates around the world, they knew with confidence that he was engaged in the conversation, that he cared about them, that he cared about what they had to say. I think secondly, maybe intellectual curiosity. Arne was a continuous learner. You rarely saw him without a book under his arm. And I think it was that curiosity that made him such a global citizen and such an engaged leader.
Well, Arne was also a bit of a road warrior. I mean, on the road for over 200 days out of the year. How will you spend your first 100 days as CEO?
Well, I wish I could tell you I could spend all 100 on the road. That would be my strong preference. I want to get out and meet with our partners and visit our hotels and connect with our associates. Unfortunately, I don't have the absolute latitude that I had given the closing of some of the borders, but I will get out on the road as schedules permit. I've got a whole schedule of virtual meetings with our partners, with our general managers, with our business councils in the coming days. And I'll continue to engage with our senior leadership team around the world and make sure they have all the tools and all the resources to help us drive demand.
Talk to us about the state of the Marriott business. We've seen a rally this year in shares of lodging companies. Your stock's up close to 14%. Hilton's up close to about the same. Are you seeing green shoots of a recovery in the U.S., but also China? I know China is a very important market for Marriott.
Yeah, maybe I'll start with China, because I think China gives us all so much optimism about the near-term future of travel. As I'm sure you know, we have nearly 400 hotels in China. In fact, we just opened our 50th hotel in Shanghai. And because the country has done such a good job on virus containment, we're seeing occupancy levels return to nearly pre-pandemic levels. But we are also pragmatic as we look at other markets around the world. we see that when there are spikes in infection rates, it has a fairly chilling effect on demand patterns. We are, as you rightly point out, seeing some green shoots in markets like the US, certainly led by leisure transient demand, but we're seeing those green shoots in business transient as well, and that's quite encouraging.
The business travel environment, has it been changed forever because of the pandemic?
Well, as you know, Brian, lots of folks have lots of opinions about that. We tend to have our opinion about the future of business travel informed by what we hear from our customers. And while I think leisure will continue to lead the recovery, we are quite confident about the medium to long-term future for business travel, and we don't think there is a fundamental and permanent change in demand for business travel. In point of fact, what we hear from our business transient customers is they can't wait to get back on the road, to meet with their business partners and to meet with their customers.
It seems as though, just having followed Marriott through the years, since the Starwood deal, you guys are always getting questions on the number of brands. 30 brands in the portfolio? Do you still like the fact that 30 brands? Do you still like that fact that you have 30, or do you want to slim down a bit?
We love that we have 30 brands, and I think the principal driver of that love is this notion of breadth of choice, both from our consumers and our owners and franchisees. Our consumers have lots and lots of trip types, and they may very well in the course of a year for a business trip stay in one of our select brand hotels, and then they may take their vacation with their family in a premium or luxury brand. Similarly, for our growth partners, our owners and franchisees, they often want to continue to grow their portfolios within the Marriott ecosystem, and giving them that breadth of choice, I think, is a tremendous advantage for us.
I think the last time I talked to you was August 2019, believe it or not, in our headquarters in New York City. It feels like a lifetime ago.
That's right.
And we talked a little bit about the budding at the time home rental business. Now that business has now reached 25,000 units, luxury homes in many cases. Is that moving the needle financially, and what are your plans for that business?
It's not particularly material financially today. But we think it is a really important complement to our core lodging business. As you'll recall, when we launched in 2019, we only had about 2,000 units. Now we're 25,000 units. Ideally, by the end of the year, we'll even be growing across Asia Pacific.
We're going to take a quick break, but when we come back, Moderna out with new news about its booster shots. We have that for you in just 2 minutes.
excuse me, we want to get over to Angelique Kemlani. Breaking news regarding Moderna. What do you got?
That's right, Adam. So the company has announced that it is submitting its booster shots, specifically targeting that South African variant B1351 right now to the NIH in order to start clinical trials and clinical studies on that variant, on the booster shot specifically, as well as some other options that it's going to be able to roll out in terms of lower doses in order to be able to see what works best against this variant. I spoke to the CEO, Stefan Bancel, and he said that this record time in being able to produce an additional shot, a booster shot, and tweak it to particularly target that variant is just an example of how the new technology is going to be able to respond to emerging variants moving forward. Meanwhile, we also know that the production of COVID-19 vaccines is a concern, with Moderna now saying that it can expand its vaccine production for 2020, targeting 1.4 billion doses. That's nearly triple of its original goal of 500,000 in a year. This is all coming as the company is able to expand, not just because of equipment and also with its partners, but also because it's also gotten the hang of producing this mRNA vaccine. CEO Stefan Bancel again telling me that because of its ability to not just scale up, but also pay upfront for raw materials early on, they were able to really get this going. So there's a foundation now. So moving forward, not just with the production of the original vaccine, but also moving forward, if and when it seeks regulatory approval for the variant, it can also continue and start to boost the production of that as well. Adam.
Well, Anjali, just following up on that, just in terms of the production, what has Moderna done that has been so effective? Because we were just talking to a doctor in the last hour, in the 3 p.m. hour, and he was still addressing a lot of the production issues and a lot of the manufacturing issues that these companies are facing when it comes to vaccines.
Right. Well, Moderna really benefited by partnering up with the federal government. We know that it was one of the first out the door with a vaccine candidate, but also was able to lean on the federal government's use of the Defense Production Act. That meant that it got priority rating. So all the supplies, the materials, the equipment, things that it really needed to get moving and get to the front of the line, it was able to get. But in addition, it's also been able to learn how to scale up more quickly. We heard the president tell lawmakers yesterday at a House subcommittee that they're still learning the process of scaling up this new technology. But because it is a process that's largely synthetic, they're able to move more quickly and able to figure out how to become more efficient as more partners come online and as the existing partners scale up with hiring as well as with equipment. And like I mentioned, the purchase of all the stuff up front really helped move things along.
Angelique Kemlani with the update. Thank you. Shauna, we are almost to Friday, but we got to get through Thursday to get there. What are you watching tomorrow?
Almost are getting closer and closer to Friday. Adam, I'll be watching jobless claims. We're expecting to get that out at 8:30 a.m. Eastern time tomorrow morning before the bell opens. In terms of what we are expecting, you can see it on your screen. We're expecting an increase of 861,000 was what we saw last week. We're expecting 825,000 for the reading tomorrow. So this will be the 7th week in a row that we saw more than 800,000 claims. Continuing claims for the week ended February 13th. That's expected to come in at 4.46 million. That's up from, or down, I should say, from 4.49 million the prior week. What are you watching?
Durable goods. We're going to get that number tomorrow. We've seen them growing, every month for the last almost 8 months. A lot of this is the stuff that would last 3 years or longer. We're talking about cars, appliances, tools, but the expectation is we're going to see continued growth. And we were just talking with Mr. Timmons about the executive order the president signing on supply chain, what kind of impact this might have on the manufacture of the goods that we want to see in this reading, and whether there's been any impact yet, perhaps not. The chip issue was hitting the automobile industry, but I'm going to be watching that number. One thing else we'll be watching is the Dow closed in record territory. It closed today at 31,961. The S&P 500, 3925. It was just the other day. I think it was Credit Suisse was saying we will see the S&P 500 4,300 by the end of 2021. NASDAQ was up 132 points. We got you covered here at Yahoo Finance Live. We start bright and early, 9 a.m. See you tomorrow morning.